Good morning. I am lecture host and welcome to the Tradier Options Summit in partnership with Cboe. We've got a full day, couple house cleaning items before we get started. I'm not going to talk long. I'm going to get it over to Dan and Bill in a second. We're going to have a couple breaks. We're going to do some giveaways during those breaks. You're going to have to answer a question correctly. Kayla will be taking care of the answers, and the prizes will be $500 into your Tradier brokerage account. And one of the shirts I might be wearing during this whole broadcast. So we will give you details as that comes through. Terms and conditions apply. Comments, please give us comments, give us questions. We have people looking out after those. We love to have the questions. Each presenter probably has about a half an hour of presentation. And then we'll have some questions toward the end. We'll do our best to get to them all. Please be respectful in the comments. We appreciate it. Okay, without any further ado, let's get started. We're going to bring on our welcome address from Mr. Dan Raju. Dan, how are you? Good to see you. Tradier.
Hey, Alex, how are you doing?
I'm doing great. Are you ready for the summit number 4?
Yes, already.
You got a special little one. I know you're somewhere special with Mr. Capuzzi, and you're going to be doing a little combo deal here, right?
No, combos always work.
All right, I'm bowing out. You got the floor now. You good?
I'm good.
All right, take it.
Welcome, everybody. Thank you. Thanks for joining the 4th Tradier Cboe Options Summit. I can't believe it's already the 4th. We started like a year ago. We weren't really sure where this was going. But today, with thousands of registrants and so much demand for content, so happy to be a part of this journey. Before I say one more word, let me thank Cboe and the amazing partnership we have with them. We are a very simple mission, that is try to get the best awareness and the best education in the hands of traders like you and let you make your own choices. So thankful for the support we get from them. Before I joined this call, right, Tim from marketing, I'm sure you heard enough from Tim this last 1 week, just mentioned to me that a majority of the people who are attending this event are repeat visitors. That didn't surprise me. The way you have adopted Tradier ever since we started, it's almost become that what we do, you guys support us in everything that we do. So thankful for that, right? From the very first day, the one word that has carried us so far through all its ups and downs is that you guys have always stood behind it, right? That you give us the 2 most important things that you have, and that is your time and you trust us with your trading, right? And so we are so thankful, and we take that seriously. We get up in the morning every day and take that seriously. It is that special bond we have with you folks. Doesn't matter what the markets are, doesn't matter what happens in this industry. You guys have always stuck with us for the last 1 decade, right? So it is that special bond that has taken Tradier from a unique startup with an amazing technology to become one of the largest option trading communities in the market today. So thankful. And today, we are so happy that we are able to provide some of the best technologies and some of the best education that the market can offer. The bond that we have with traders like you, it's a very special bond. There is no hype. There is no venture hype. There is no autographs. There's certainly no chatter about changing the world, right? We have enough players who do that, okay? For us, it's a very, very simple equation. We get up in the morning, we put our heads down and work for you guys, right? And you guys respond with that, with absolute loyalty to us. And we have the lowest churn rates in the market just because of the way that special bond plays out between the 2 of us, right? Our mission from day 1 has been super clear. We always felt like the active trading community was forgotten. There was so much hype about all the young traders coming in. Great. But at the end of the day, the folks who are engaging in active investing, we felt like the market was neither offering them the choice nor they were offering them the price and value they deserved. So that was a mission for us. We got up in the morning every day and wanted to deliver that for you. Number 2 is we wanted to give you choices. We are not that vertical brokerage firm that is going to tell you what you want, but we're going to tell you where to find what you want. So that simple choice and price combination has made Tradier what it is today. And lastly is we embrace education like no one does before, right? We combine that education with great support. Anybody who picks up the phone and calls Tradier today, the very first time someone answers a call, you see the difference. We are serious. We want you. This is serious business, and we take that very, very seriously. It is this focus on education that has got all of us here today, right? 2023 is going to be a superb year for us. We're going to get hundreds of platforms coming onto the ecosystem. We expect to launch some amazing, the Tradier Hub. We're launching advanced portfolio margin and launching crypto. And we can talk about that later on the show today. And also and maybe if we can squeeze in futures, we'll try to do that this year. So thank you for all the support, right? For all this success that is there behind Tradier, right? There is one company and one relationship that's behind us that has made this success possible for over the last 7 years. And that is a relationship with Apex Clearing, right? Apex and Bill have been one of the forces that has led Tradier to all the stages of growth, right? They have stood behind us. They've offered some amazing clearing. And I know many of you folks may not even hear the word Apex that much, but I think it's very important for this community to understand that Apex plays a critical foundational infrastructure role for us behind the scenes, right? They share in the growth. At the same time, they are the reason why we basically go ahead and have been so successful, right? So I'm not going to waste any more time. I'm going to try to get Bill Capuzzi. I'm in his office. It's an amazing office here in New York. I can see some amazing views from here. So I'm just going to welcome Bill. Bill, can you jump? I'd love to get Bill onto the call. So,
what a great introduction, Dan. Thanks so much.
No, I tell you, right? I've known Bill for a long time. If there is anybody in this field when I pick up the phone and he'll say, "I'll take care of it for you, Dan," that's Bill, right? So that can-do attitude, right, that he leads Apex through. I've got some amazing questions for him. What I'm going to do is, Bill has got an amazing career, right? Even before Apex, he has burned his hands through all kinds of ups and downs in the industry. So what I'm going to do is I'm going to ask Bill, if you don't mind, Bill, you have an amazing career, right? Really stellar career for folks like us to look for, right? So give us some background. What is your background? How did you get here? What drives you every morning?
Yeah, great. Well, look, first, it's great to be part of this. Great for us to be partners, Dan. And I would tell you specifically around Tradier, it's an amazing partner for Apex. We'll get into the details of that, but it is an amazing platform. And I've known Dan, close to a decade now, and amazing entrepreneur, amazing owner of this company, amazing CEO in providing a solution. He talked about education. And again, we'll spend some more time on this. That's the core of Tradier, and I think it's really important because it's something that I think over the last probably 5 years, as we've democratized investing, really has been overlooked largely in the industries around education. Specifically, my background, the path to get me to sitting in this seat today is not a straight path, and probably not too surprising because it usually doesn't take a straight path. I started my working career as an environmental scientist, believe it or not. And I came out of college and I had this environmental science degree. What do you do? So you go to work. I needed some money. And so I started my career as an environmental scientist. And I quickly learned that was not my calling in life after a few years. And then what do? You go back to school. So I went back, got my MBA, and took a job at this company called DLJ. Donaldson, Luthringshausen, Créde, which was an investment bank in New York City, as part of their MBA program. And one of the assets that was owned by DLJ was this company called Pershing. And if you knew DLJ back in the day, it was this amazing investment bank. They did trading and they had the banking side, they did distressed debt. They worked on a whole bunch of really cool IPOs and mergers and acquisitions. And I got selected to go work at Pershing. And at the time, I thought it was the worst thing that could happen in my career. It's like I'm banished to Jersey City, New Jersey, circa 2000, and working for the bowels of our industry. And what I learned through that experience, amazing place, by the way. I still have amazing friends at Pershing. And what I learned at Pershing was that the sort of back end, the bowels of our industry were really messed up. That the guts of how Tradier does what it does, the behind the scenes stuff around account opening and funding and trading and settling trades and confirms and statements and tax. We're going through tax reporting right now, all the 1099s. It was just an incredibly manual, incredibly slow, incredibly people intensive part of our business. And so when we think about, okay, where do you go from here? It's like I learned the industry at a really detailed level of my time at Pershing and realized, hey, there's a better way. Fast forward, I left Pershing, found a company in New York called ConvergeX. It was while at ConvergeX when I got to know Matt and Jenny, the founders of Peak Six, who owned recent owners of Apex. Apex spawned out of a failed Penson, which was a public company. And I tried to buy Apex from Matt and Jenny back a number of years ago. And why? Because I knew what was possible. I knew that there was a better way. I knew that the solutions that were out there from a clearing custodial perspective were not akin to sort of this new way of investing, this new way that the industry was going to work. So I was not successful in acquiring the company, but they were successful in getting me to come over. So here I am, eight and a half years later, and having a lot of fun.
One question, a lot of folks, our customers, see Apex in the disclaimers. Okay. Mm-hmm. What is Apex? For somebody who has not heard who Apex is, there could be quite a bit of audience here who is not. As important as they don't realize that every trade they do goes through you. Yeah. What is Apex?
Yeah, so think of Apex as a fintech company, right? It's a technology-based company, and think of it as a platform. Think of it like Shopify or Twilio, but for investing. So effectively, and this is where the relationship with people like Tradier, right? There's roughly 300 firms like Tradier that partner up with Apex. This is like just a symbiotic and amazing partnership, right? So Dan and Tradier's job is to create this really cool experience for the end customer, for the trader, in the case of Tradier, and to provide amazing content and education. And for everything to happen behind the scenes is Apex, right, by and large. So what does that mean? When you open an account, you go into Tradier, you put in your name, you put in your address, you put in your social security number. That then fires through an API real time to Apex. And we do the interrogation to make sure that in case of Dan was opening an account, that Dan is who Dan says he is. And that you pass the rules and that we follow the right protocol in terms of opening that account. Then the funding. You want to connect to a bank, pull money into this brokerage account. That happens real time through the Apex funding rails. I keep going. The trading, you mentioned, all the trading happens through Apex. All the settling of trades, right? So for the audience, DTCC, OCC, these are industry utilities. Apex basically posts up collateral and cash liquidity to support the settling of trades for all of our clients. And then everything else that happens around us. So crypto, we built a business to support the crypto industry. All of the, like I said before, the 1099s, the tax reporting, any confirm, any statement that is sent out, all happens behind the scenes. So like I said, it's a purely B2B, fintech, tech-forward company that supports roughly 24 million end investors today. And we're sort of the best, worst-kept secret. And part of that, I go back to the symbiotic relationship. Our job is to support Dan, right? Our job is to stand behind Dan and make things happen easy, right? To make the account opening happen in seconds, and that funding and the trading, make the experience behind the scenes happen, flawlessly, and real time as best as possible. And for Dan to sort of be that person to manage the end investor, the trader, in terms of that education, the content, to make good investment decisions.
One question. See, I heard you. By the way, one quick fact: Bill has been voted by so many firms as one of the top 50 fintech innovators. Right? He doesn't. He didn't say it, so I just want to make sure I fill the blanks in. Yeah. So I just want to make sure you guys get it. He's an amazing guy. One thing, and I have had a little bit of history with this. See, one thing is, how do you run a company whose sole purpose is enabling others, right?
Yeah.
I mean, you need to have an enabler mentality. You want to make a comment on that? I see you using the word enabler in so many of your interviews. I'd love to get your comment on that.
Yeah, it's funny. I'm reading a new. It's not new. Simon Sinek's newest book. It's called Infinite Games, and the premise behind it is building a company not to win, not to be quote unquote number one, but to last forever. And part of the way to do that is to have a just cause. And I use my words, which is a purpose. What is the purpose of Apex? And we have a town hall every month with the entire Apex team. And I pick somebody from, we're all on Zoom, pick somebody by name from the employee base and ask them in their words, what's the purpose of Apex? And they use their own words, but the purpose of Apex is to help every person on the planet invest in their future. And it's a noble cause. It's a just cause. And the way we're doing that is we're not great at what you're great at. And we're not great at the end customer interaction, right? The tools in order to make those trades, the investment decisions that people need to make, the education around how to use those tools. Our job is all the plumbing, right? But the goal is the same, which is to help every person on the planet invest in their future. Just do it through that, again, like B2B lens, right? So you think about something like Shopify. I think about all of the merchants out there that leverage that platform to provide goods and services to end consumers. Same concept here.
So yeah, I see I think that enabling mentality is. I mean, we see that, by the way, guys. Whenever you guys have a problem or you guys have a question, right? In many cases, we actually call or reach out to Apex behind the scenes, and we see that. If you ask me, just as a customer, what has made them so good is that enabling mentality, right? How do you stay behind, not be in the limelight, yet let other people flourish? So that's an amazing business model. Well, you've been putting this aside. You've been in the retail industry for as long as anybody has been, right? And the last.
You're making me sound old.
What's that?
You're making me sound old.
I mean, all of us are getting there, right? So go see but the key is this. I mean, the last 4 or 5 years, ever since pre-pandemic, all the way up to today, right? I mean, the retail market has taken a totally different shape, right? Love to get your perspective about, what you've seen, what you're seeing today over the retail markets.
Yeah. So look, I think it's never been a better time to be a retail investor. Okay. Right. So, again, I will show my age, right? So when I was a young man, let's say it started back at Pershing around, 2000, you could open an account and put $100 in it and start investing in any stock you wanted, right? Fast forward even 10 years ago, even almost 5 years ago, you couldn't do that, right? Because there was, think about it, wasn't that long ago, there was commissions, right? So zero commission is gone. The concept around fractional shares, at least on the equity side, we're hoping, pushing on fractional options as well. But let's talk equities. You couldn't buy Berkshire Hathaway. It's too expensive, right? And so for the retail investor, John Q. Public, that had $1,000 to invest, the barriers to entry were still incredibly high. Not that long ago, pre-pandemic. Let's talk 2017, 2018. Right. Fast forward to today, it's an amazing number of companies out there, and again, we're proud of this at Apex. There's 300 different firms like Tradier that leverage Apex, all trying to solve some hard problem in our industry, right? To lower the barriers to entry, to create democratization around some aspect of our industry, right? So big part right now, big interest is around alts and around fixed income, which again have been things that have been really kind of geared towards high net worth, ultra high net worth. So the barriers to entry have all lowered, which is amazing. And you think about the explosion of the retail investor and the access through the pandemic. The one part which I give Tradier a lot of credit for, the place where I have really kind of railed on our industry through this pandemic is great. We've created amazing access to the markets. We have not properly trained and taught those same people on how to use the tools. right? And we're going to talk a little bit about options, but as a great example, right? Without proper training on how to leverage options as part of portfolio, it's why we end up in a situation where 2% of those 24 million people that are at Apex use options today. 2%. 28% of the clients, I said about 300 different firms, 28% of them actually are enabled for options, but only 2% of the people leverage options. And it tells you something. One, it tells you it's a massive opportunity, but a lot of it has to do with we have to teach people properly on how to leverage these tools. Because I think, and the audience knows this, to the untrained eye, options, futures, some of the more exotic products can become very dangerous.
But yeah, we see it, right? We, for us, it was the focus of, how are we going to serve that graduating investor who came in through the retail, and so it's education is, and we just realized very soon, education is at the heart of all of that, right? So I'm glad you guys are here today. I mean, hopefully you guys are going to have we've got some amazing speakers, by the way, which I tweeted about, as you guys know. So one interesting thing, Bill, is that we have seen in the market, while and this is a lot of data is there to show that, and depending on which slice you do it, what we're seeing is the young small account part of the business has kind of tapered off a little bit, right? Mm-hmm. While at the same time we see the more active traders more active than ever before, right? And they play in up bullish markets, bearish markets. Options is a huge instrument, massive graduation effect. And everybody on this call today are part of that story in some way, shape, or form, right? And any comment on the growth in options?
Yeah, well, I'll tie the two pieces together. So through the pandemic, people sitting at home, they get their PPP checks. There's no sports, there's no gambling on sports. What do you turn to? Okay, the markets are open, and so the number of casual retail investors that thought they were amazing investors, sort of proliferated. Through last year, we finally started to see the market sort of turn back, right? Which the market ebbs and flows, and we saw, like you said, a lot of those casual investors realize that, hey, this is harder than I thought to be a proper investor. I think it was ironic that there was some statistics came out around the Super Bowl that the number of trades, well, I'll say the number of bets made on the Super Bowl was at an all-time high because the access now to gamble because of people like DraftKings and whatnot have gone up. And so there's some of the market, I think, is tamped down the casual investor, but it's presented amazing opportunities because of the vol in the markets for people that actually do know what they're doing. Right. And so, and we see it just yesterday, the markets, were ripping. It creates opportunities, especially for people that are leveraging tools like Tradier, like the options within Tradier, to find yield, right, to create opportunities. And so, it's a great time to be a semi-professional, professional trader, given the fact that the markets are presenting opportunities up and down to create, again, volatility in the market.
Yeah, I agree. I really agree. I mean, okay, now I'm going to pick up a topic that Tim asked me not to touch, and that's crypto. Okay?
Yeah,
I know we have announced that we are launching crypto. We got like 20,000 people on the waiting list.
Yeah,
right. So there's still demand for crypto, right? As much as people have their their opinions, but they have an opinion about it, right? So give me your comments on. I know Apex has put its hand into the crypto field. I mean, we obviously have a relationship with you in that context. So help me understand what is your comment about what's going on in the crypto market right now? What do you see the future of crypto in the retail markets?
Yeah, look, so crypto started as this, sort of anti-government, decentralized finance, right? And the tenets behind it. Let's just talk blockchain. Let's put that aside. The concept behind blockchain have amazing applications just in finance, but think more globally. Specifically within crypto investing, I think what's happened is it's largely speculative investing.
It is.
And when you think about when you get past the Bitcoin, the Ethereum, and you get into some of the secondary, tertiary coins, it's even more speculative. And it's the challenge, I think, for us as operators and trying to do the right thing is that the goalposts weren't there, the guardrails weren't there, and I say that it's amazing. And I'm going to say this, but in the form of regulation.
Right.
And we saw what happens in 2022 without guardrails, right? Which is, the fact that people could loan their coin. Right? Forget about the trading. Trading is fine, right? Now you own some Bitcoin, and that you could get 12% on your coin. Like, how does that make sense, right? And you think about it, when it usually is too good to be true, it usually is. And in the case of crypto, without those guardrails, some of this stuff started to kind of fall apart, and then you started seeing sort of the unraveling, right? The Voyagers, the FTXs of the world, Celsius, and as a result, the entire cohort, the entire industry is now looked at as, okay, what is happening here? Can I trust this? And so now what's happening, and we'll see this in 23 and in 24, is now you're going to see, at least in the United States, you're going to see this vicious kind of push from the regulators, specifically SEC. There's a story out this morning in Wall Street Journal around stable coins.
Right.
And look, as an operator, Apex is provides the same platform that I talked about with equities for crypto, and we're proud of the fact that we do it right, dot I's and cross T's. And in the equities, the options, the futures world, it is a very established regulatory regime. Right? There's the SEC, there's FINRA, there's CFTC, there's a number of, and there's rules and regulations. But within crypto, you sort of had to figure it out, right? Without those guardrails. I think what we'll see is that there'll be a big cloud of dust over the course of the next 24 months.
Right.
I think there'll be a lot of regulation around things like stablecoin. I think that we'll find that a fairly large percentage of the coins that are out there will be deemed to be securities.
Right.
In which case, all of the operators in the industry will need to figure out how to operate within a securitized framework to some extent. And so we'll see lots of, I'll use the word kerfuffle. We'll see a lot of change. I think a lot of it's going to be driven from a regulatory standpoint. And then things will settle down. My prediction is probably sometime in the second half of 24.
Wow.
Where around that regulation, there'll be a lot more sort of guidance, a lot more clarity. And that's when the big institutions, right? You think about BlackRock, right? You think about some of the big asset managers that are out there. They should have an allocation of Bitcoin and Ethereum, but they don't in many of their portfolios because they're afraid. And without that regulatory framework, you're not going to see some of the bigger institutions step into crypto. Again, I see that happening probably second half of 24.
Do you see? I mean, I agree. I think regulation is probably one of the best things that can happen to crypto in the long run, right? So, but do you actually see on the non-crypto side too? I mean, there's quite some areas, and I see you comment on some of them all the time. So, on the non-crypto side, on the T+2, T+3, on the settlement side of things, and also on the whole, particularly the option side that we play in too, right? Do you see a lot more regulatory? And I'm not going to call it enthusiasm, but I'm going to call it a lot more regulatory, what I call as regulatory, maybe the right word to use is interest or focus on that area.
Yeah, look, last week the SEC confirmed the date. It's going to be Memorial Day of 24 to move from T2 to T+1.
Right.
I sit on the board at DTCC.
Right, I know that.
And that's a good move. That's a great move for folks on the phone. And just understand what that means is that when you buy or sell a security today, which is sort of crazy, it's 2023. And when we buy something, we buy a security, you have to wait 2 days to get your money or your security. Like, why? Why does that happen? It's sort of crazy, right? Because you go on Amazon, you press a button, something shows up at your house the same day. And the reason for it is, again, go back to why I sit in the seat, why Apex is so important to the ecosystem is the infrastructure is all built on old COBOL code, IBM mainframe and things happen in batch. And so the best we could do in 2024 is to go from T2 to T+1. The good thing for the folks on the phone is you'll get your money or you'll get your securities one day earlier. The reason it's not instantaneous like it is with crypto is not because of the likes of DTCC or the industry or the regulators. It's because of the big banks and like I said, that old aging infrastructure that supports batch-based processing.
Right.
So the best we could do is go to T1, which I think is obviously a good step in the right direction.
Right.
Ultimately, what you want is to buy a security. I have the money, I get the security real time, right? And that's, we have that precedent today.
Right.
It's called crypto. Right. I think the other thing, just one other part to this, which is payment for order flow around trading revenue. How the industry works today is retail order flow goes to market makers. Market makers provide tight spreads, and they pay for the privilege of executing that order. It's called payment for order flow. There's a lot of talk in the industry around whether or not that's something that should continue. The SEC put out a comment letter about this not that long ago. My sense of it, Dan, is that I don't believe it's going to change. I don't think that we're going to go away from the current regime, which is the leveraging market makers. And the reason I say that is because you got to be careful what you ask for, right? And I say this because the people that are listening to this, it's never been better for retail investor, right? And the likes of Citadel, everyone can rail on Citadel or Virtu or some of the other market makers, but it wasn't that long ago that the spreads were in fractions, and it wasn't that long ago when the spreads were 5, 6, 7 cents wide. And the fact that on liquid stocks we're talking about penny spreads, it's amazing. Right? It's amazing today versus what it was 5 and 10 years ago.
No, I agree. I think sometimes the industry tends to run in one direction, not knowing what it's asking for. I think this could be one among them.
Yeah.
One question, right? I mean, this is a question I think just came on the text, and that is, so any take on I see the regulators trying to play with interest rates in order to control inflation. I mean whether inflation will ever come back to the twos. I mean,
yeah.
Who knows and when, right?
Yeah.
But that being said, any take, I mean, what we see, at least in the active options trading spaces, we certainly see quite a bit of interest, very active involvement. And, do you see the volatility continuing for a while?
Yeah.
What's your take on that?
Yeah, look, here's what I think is going to happen. We were in an environment where zero interest rates is not good long term, right? And it was an unusual time. Money was free, and as a result of it, what ended up happening is people could borrow money for nothing, or close to nothing, and it got us through the pandemic. It created opportunities for people, but there's a cost, right? And think about all the people that borrowed money for free, and all the businesses that spawned. Let's just talk about the SPAC-palooza that happened in 2021. All those companies that you look at today, how many of them actually should be public companies?
Right.
Not many, and most of them are not performing incredibly well. And they were given money because it was free. It was easy to get access to capital, and it created weird distortions in the market.
Right.
Okay, so then the Fed starts to raise rates as inflation starts to pick up. I think we're close to the top. And I think what's going to happen over the course of the next year is we're going to settle into this period. And it's not going to go back to zero. It shouldn't go back to zero. I think we're going to settle into an area of like 2-3% interest rates, which is healthy for our economy. Right. Between here and there, there's going to be amazing opportunities for folks on this on the podcast. There's going to be lots of volatility between here and there.
I totally agree with you. Hey, so we're going to shift gears to our audience. As we have an API. There are probably 30 to 40 startup CEOs on here, right? trying to build out, trying to figure out what to do, right? And they're all using the APIs. By the behind our APIs are the Apex APIs and all that stuff. Yeah. So, but one question for you is it a good time, would you say, for developers and entrepreneurs to start building product, right? So one of the stuff that we try to do at Tradier is there's this idea that you could actually, this brokerage as a service that we have offered as an API and companies are building. We've certainly brought in a lot of basically young entrepreneurs or first-time entrepreneurs to come and launch product. But right now, they hear all this noise, they're really sure. Yeah. So what's your take of if an entrepreneur trying to build investing platforms, right? Whether it's simplicity or trying to drive data, what is your suggestion for them?
Yeah, so we see all walks of life. I talk to lots of entrepreneurs, lots of founders of companies, and have been for the last 10 years. And I think there's a couple of discernible patterns, some of which I think is unusual for this time frame. Here's what I'd say. First, you ask the question, is it a good time? Yes, so long as you're solving a hard problem, right? And I ask that question. I ask for business cases when I talk to people at Apex. Like, tell me what is the game plan? What is your problem that you're solving in the industry? Because if you're going to show up and be another version of insert here, right, your chances of success are probably fairly low. So one is solve a hard problem, right? And it can be a small, narrow piece, right? So I mentioned before about alts. Alts historically have been something that only rich people can invest in, right? Whether it's real estate or art or whatever. Democratizing alts, I think, is interesting because why shouldn't John Q. Public be able to access a private equity fund or a piece of art? Great, right? And I think there's lots of interesting things happening in the alt space. But again, solve a hard problem. That would be number one. Number two is do not let perfect be the enemy of just okay. And I see this oftentimes when people raise some money, and at the heart, at their core, they are product people and want this perfect product to support and solve their hard problem. And they go too far in terms of building this perfect product and burn through a lot of money without actually knowing whether or not it's going to work. So I would tell you that the second thing I'd say is fail fast, right? Is get a product out, do the A/B testing, get people to actually look at it and understand and give you feedback. And then the last part is have a game plan for actually acquiring a client. It sounds so simple, but you'd be amazed at how many people I talk with that have amazing product that solves a really hard problem and have no go-to-market strategy. And especially if you're in the retail end consumer, you have to have a strategy around how you're actually going to take that product that solves this hard problem and get to market and get people to look at it. Because it's not okay to just get 1,000 people to use it, especially if you're in sort of democratizing investing. You're talking about tens, hundreds, millions of investors is the goal. And part of what I see oftentimes is people build beautiful product, and the go-to-market strategy is one of those things that we'll figure that out down the road.
A question from the audience, which I think is interesting. So, the question is, Bill, when are you going to expand access to the Middle Eastern market? That's the question.
Yeah, look, so we're working on this. And I be really clear on what I say, working on this. We're working on providing the ability for companies around the world to access the U.S. market and crypto, right? And the reason I double click down on that is for me to go into the Middle East and build a product that then is going to provide Middle Eastern folks to access the Dubai market doesn't really add a lot of value. What people want to access is the U.S. And so we're going to launch this year in Canada. We've already launched in South America, in a number of different countries. We've launched in a number of countries in Europe, Australia, Hong Kong. The challenge with some of these places, you mentioned Middle East, is that that's a broad statement. You're talking about specific countries that have very specific rules around how Apex can support those companies there. And one part, Dan, you know this, is we dot I's, we cross T's. There's no gray area. We don't cut corners, which is obviously to your benefit. But that's part of what we do is we follow the rules. And so, some of these countries are harder than others to make sure we follow the rules.
No, I agree. It's by the way, guys, just like if you come to the Tradier office in Charlotte, we say always do the right thing. And Apex does exactly the same thing behind the scenes, right? Now, Bill said one thing, getting into Canada. I know there's so many of our customers. I mean, we get this request like 10 times a day, right? When are you going to get into Canada?
Yeah.
So
You heard
whatever you said is locked, and they all heard it. So it's good. So really excited about that.
Well, and I'll just tell you, it's really hard to get into Canada, and the reason for it is it's not technology wise. The Canadian government wants to lock down Canadian resident PII and keep it in Canada. And so it creates all kinds of challenges, which is why there's not a lot of folks up there offering product like there is in the States, because it's really hard to get going. So it's been a long, tough road, but the expectation is we'll get there.
Our customers will love it. I mean, it's there's so much what I call as value we can generate for that market. So, hey, I know, and we're running out of time. I know we got some amazing speakers. I mean, we got some amazing speakers, guys. We got the guys from Option Alpha later today, which Bill and I know. Some amazing, great speakers, folks from Cboe, from the product side. So, guys, we're going to get out of your way. I know you guys want to do deep dives. So, thank you so much. Bill, it's absolutely a pleasure. We dive so deep into options. You come and give us a totally different enterprise picture and market picture of things. Bill has been a great friend and actually a great support of Tradier. So, Bill, thanks so much. Thanks for taking the time.
Awesome.
And they lent me their office today. So,
awesome. Thanks, guys. Hey, how are you? I might have a couple more questions for Bill if he can sneak back in.
All right. He was slowly trying to get away. Look at that.
I know.
I was almost out.
You were almost out. Give me a couple. So some of the things that came by in the comments as you guys were talking. You caught, Dan, I know you caught the Canadian investor thing. That was a good one. I'm assuming that applies to UK and Australia. It's very similar governmental sort of hurdles there, I would imagine, right?
Yeah, we solved the Australian challenge already, and we're pretty close on the UK piece as well. Canada is particularly more challenging because of that PII requirement that the Canadian government has. Okay.
Well, that's good to hear that you guys are moving along there. Some of the other questions that came up, and I think it's gonna center around SIPC and that sort of thing. But they asked, is Apex approved by the government? I know the answers to these, but I'm gonna let you answer to the people out there. And then what sort of safeguards are in place, relative to Apex /Tradier? I think people are looking at safety there.
So first part is you mentioned that SIPC. Right? We have SIPC coverage. People's money is safe. This is again back to the symbiotic, the church and state relationship that we have with Tradier. Is our first sort of priority is to make sure that the assets are safe and protected. And so every client that's on Tradier is a direct client of Apex. I talk about 24 million people that we support.
Mm-hmm.
A big subset of them are Tradier direct clients, and they're directly my client. I hold their assets, and I am regulated by the SEC, by FINRA, which is sort of the broker-dealer subsidiary under SEC. And then obviously all of those utilities that I talked about, of which one I sit on the board of. So I will tell you, at least we talked about crypto as sort of a little bit of the Wild West. It's now coming into the fold. The rest of the industry, the equities, the options, futures, fixed income, mutual funds, those are really hardened around the regulatory regime.
Mm-hmm.
And that's a big part of what Apex does is dot the I's, cross the T's, and make sure that all the FINRA rules are followed, all the SEC rules are followed, and so on.
Okay. And then, so a Tradier customers' funds are technically custodied at Apex. Is that correct?
That's right. So
Okay.
what ends up happening is Tradier is the introducing broker. I'm going to be the clearing, is what's called clearing custodial broker, right? And effectively what it means is that if in fact there was a problem with Tradier, which there wouldn't be, but if there was, I'm holding the client's money, right? And they can come directly to me. Unfortunately, we've seen it happen where some of the partners of Apex go out of business. That account is open at Apex, and I know in the case of Dan opening an account, I'm holding your assets. And my job is to make sure that they're protected in the event that, for one reason or another, one of the partners that uses Apex, right, the likes of like a Tradier, if there was insolvency, that those assets are still there and that they could reach out to Apex and we would make sure that took good care of that end customer.
Okay, great. Another quick question. Does Apex provide direct market access? I'm assuming they mean options, but maybe it could be otherwise.
Yeah, we do. So we have some clients that decide that for one reason or another, rather than routing through market makers like I talked about before, that they want to go direct to exchange. Right? It really is by choice. I will tell you that I've been at this a long time. The costs associated, at least today, with going direct market access, it's called DMA, or direct to an exchange, is a lot more costly for a retail investor, just in terms of spreads and leakage in terms of information than it is to go to a market maker. But look, it's a choice, right? If those clients of Apex wanted direct access,
Okay, got it. Last one that I see here. What is the difference between Peak 6 and Apex? I know the answer to that too, but I'm gonna let you answer.
Yeah, so Peak 6 is a parent company, and I think the best way to describe it is it's a family office. It was founded 25 years ago by an amazing couple, married couple, Matt Holsizer, Jenny Just. They own the vast majority of Apex, and I guess just to double click down on that, myself, the employees, and Peak 6 own 100% of Apex. Okay. There are no outside investors in Apex, and it's been bootstrapped since the beginning. And back to Peak 6, Matt and Jenny, they sit on the board. I speak to them many times a day. They're really active in the business. They understand the business. They run separately from Apex. There is a separate business called Capital Management that trades options. So they understand the sort of the risks and the opportunities within this business, and so they're great partners for me in terms of thought leadership.
Okay, great. Well, very good. I think I covered most of those. Thanks for your time and your addresses here. This is awesome. A lot of great questions. Appreciate all you guys do for the industry here. This is awesome.
Thanks so much for having me.
Thanks,
Bill.
All
right, guys.
Thank you so much.
Thank you. All right. Next up, we have Mr. Markus Heitkoetter. I might get a little flack on how I pronounce that. We're going to find out in a second. He's going to give us a talk on some of the things that he does at Rockwell Trading. So let me bring Markus in. Hello, Markus. How are you? Can you hear me? You might be on mute.
Yes. I actually told Kayla, I know that I was supposed to be on the top of the hour, and today I'm getting new windows installed.
Oh,
so
perfect.
No. I told the guys, listen, at the top of the hour, you guys need to be quiet for 30 minutes because I have a very open house, so there's no way that I can hide anywhere. Oh. So when I'm going on earlier right now, that's absolutely fine, but let me go downstairs really quick and tell them, shh.
Okay, no problem.
And then I can come on and we can talk about it.
All right, good deal. Very good. There's the noise. Okay, so for now, what we're going to do is, don't forget, we do have the drawing coming up, and I think it's after Markus is done, if I'm not mistaken. Yeah, so we'll have our first drawing then. I will give a question. The correct answers will go into a pool, I believe, unless Kayla's going to yell at me in a second, and we will spin the wheel to see who wins that first prize. I promise the question will be around a certain flying bird type of option strategy. I don't know what that means exactly, but it's going to be on that. So start boning up, start getting into Chat GPT about your birds. So here, what's a bird strategy? Iron condor, butterfly. What else? Condors. So start thinking. So that's what it'll be on. We'll have Markus back in 1 second here. He is trying to tell the window people to be quiet. So hang tight in there. And if you have questions now, I can certainly answer a few questions if you want to fire some in the chat right now while we're waiting for Markus. Happy to do that. I had changed my shirt. One change. Remember, the first one was white. This one's green. Okay. And if you like a certain shirt, let me know. You might get it. So you won't get the one I'm actually wearing. You'll get the one that is in a bag. So, so stay tuned for that. And the shirts are provided by two places, Bad Birdie and NikkiC'sClothing.com. And I think I have a banner for them. Oh, there it is. So feel free to go there and purchase your own too. They're great shirts, especially if you're in the colorful golf shirts like I am. So they're super comfortable, very easy to maintain and wash. They're just awesome. But we'll be giving those away at the two breaks as well. I think Markus is getting ready here. Give us a sec. Sorry for the slowdown. I'm looking at the quotes here. So albatross. Oh yeah, the albatross. That's a good one. I forgot about that. Very good. I like that one as well. Oh, Markus, you're back.
I'm back.
All right. Are you ready to roll?
Yeah, we're ready to roll.
Maybe you'll roll through the hammering. Who knows?
No. I just asked them. Let's stop. There might be a little bit of noise in the background, but it's okay.
Do you need to share a screen at all, Markus? Or are you good?
Yes, I would love to.
Okay, go ahead, do that, and I'll bow out once you share your screen, and I'll put it up, and I'll chime in when we get back to the end.
All right. Let's see, entire screen, and let's go to this one. Cool.
Okay, let's see how it looks. Let's see how she looks. 1 second. Oh, let me add it to the stream. That's it.
There you go. Perfect.
Okay, I'm gonna go. Markus, if you need anything, just yell at me, and I'll come back in.
Oh, okay.
All right. Have a good one. I'll be back in about a half hour.
Perfect. Fantastic. All right. So welcome, everybody. We started a bit early. I thought that today, instead of preparing a bunch of slides, I show you exactly what I do, why I do this, and just a little bit of background. I've been trading for a long time. I love trading options. This is last year. So last year I made $155,000 in realized profits, most of it through trading options, $152,000. $365 with trading stocks, and I also got a few dividends. So how am I doing this? I'm using the wheel strategy, and we'll talk about this today. I know that today the presentation, or the day, the summit here, has a big, broad topic, which is trading strategies. And I thought that since we're kicking it off here almost, I know that I'm the second speaker, not the first speaker, that I provide you a little bit of a framework and a background as you go through the day that you can reference. And I believe that will help you to get the most out of your day. Does that sound good? So what I will do is, with this framework, I will actually show you what I do so that you have very, very practical examples. But instead of running through a bunch of slides and just click, and the next slides and woulda, coulda, shoulda, I thought I'd show you some real examples here. All right, cool. I just want to make sure that I see any comments, if there are any. Good. So you see, I have been trading for a long time, and as you know, I have a company called Rockwell Trading, so I'm working with a lot of traders. I also have a small group of traders with whom I work personally. That's our mastermind members. And this is where I wanted to see, okay, how can I help traders to get to their first $100,000, and then also to get to a point where they can build actually an income machine that generates income for life. And that's what I want to show you today. So what I did over the past few years is that I actually created this kind of map, because I believe that in the life of a trader, that there are 9 steps that you need to go through to have a really solid foundation, to have a solid trading plan, to get to your first $100,000. And I want to show you right now these 9 steps, and I want to give you very specific and practical examples of how I'm doing it and how I'm applying it to my very specific trading strategy. So I want to zoom in so that you can see it better. And here are the 9 steps. So I believe, first of all, that there are 3 phases. Phase number 1, this is where you need the fundamentals, right? I mean, every trader needs to know the fundamentals. You guys probably know this, but it never hurts to go through the first phase and make sure that you're ticking all of the boxes. So we will talk about this here in a moment, and I'll tell you what I think for the kind of strategies that I like to trade, what you need to know there. So then we have phase number 2, that's trading mastery. That's after you have the fundamentals, eventually you start trading, right? And that's what we do as traders. We place trades pretty much every single day. That's what we want to do. So we're going to talk about the bulletproof 100K trading plan, the unshakable trader, and the rapid trading improver. And this is something that I've been focusing on for the past, I want to say, year and a half, because I always treated trading as something to replace my income. If you know my story, I used to work for IBM. Yes, I was a corporate drone. And then at some point I decided no more. And I wanted to replace my income that I made with trading. And so this was my goal. But then I realized, no, I actually want to go one phase further to create generational wealth. And what does this mean? It basically means that you're building a passive income system that never runs out of money to build true generational wealth for your family. And I show you exactly what I'm doing here. So let's actually get started with step number 1. So the trading fundamentals, the rock solid foundation, right? I mean, and this is where, first of all, for me, it is all about what are my goals with trading. And I want to show you of what are my goals with trading. So here's the deal. I believe that in the life of a trader, there's 2 phases, right? We're trading either for growth, and I'm going to zoom in so that you see it in a moment, but I just wanted to give you an overview of these 2 phases. So we're trading for growth, and then at some point the account is large enough where we are trading for income. And so my goal is to trade the account to $400,000, which it is right now. So last year I started with $250,000. It is now over $400,000. And this is where I am planning, and this is where I'm zooming in right now. So for me, my goals are to make 60% per year. And again, why is this important? Well, if you talk about the perfect trading strategy in just a moment, you need to make sure that this trading strategy is supporting your goal. Now, 60%, this is where some people might say, well, I make this on a single trade. So why is this your goal per year? Well, this is where if you're trading a little bit larger accounts, as you know, trading is a function of risk and reward, right? The more you risk, the more money you can make. And this is where at some point I like to scale back risk. It's almost like a rocket ship, if you think about it, right? I mean, when is the risk the greatest? Right after takeoff, right? I mean, this is when they abandon it with just seconds on the clock because they have found something wrong. But then when you're in outer space and it only makes, right? This is when life is getting a little bit easier. So this is where, and again, your goals might be different. I think that if you're absolutely new to trading, maybe your first goal should be to shoot for 30% per year. Because here's the deal. Do you believe that it is possible to make $1,000 with trading? I mean, just type it in the chat right now. You type it in. Do you believe that it is possible to make $1,000 with trading? So you ignore all of these numbers for a moment. Just $1,000, right? Because if you think about it, let's say that you start with a $50,000 account, right? And you shoot for 30% per year. This means that you're shooting for around $15,000 per year. That's $1,000 per month. Right. And I think this is where it makes sense to have realistic goals and maybe set the bar a little bit low, because one of the things that I have experienced over the years, especially in the beginning of my trading career, the fastest way to lose all of your money is trying to double it. Might want to write this down, right? So the fastest way to lose all of your money is trying to double it, especially in a short period of time. If you're trying to double your money by the end of the month, it's very likely that you're risking too much and that you lose it all. So that's what I'm That's what I'm looking for. Now, as you get more experienced, right, you might actually increase your goal. So last year on the $250,000 account, I made, let's just bring up a calculator, handy dandy calculator here. So I made $155,000 and something, and divide this by $250,000. So that's around 62%. And keep in mind, last year was a tough year, right? The S&P was down, 22%. The NASDAQ was down 30% or something like this. So I'm very happy with these results. Anyhow, this is how you can grow your account to a level that you're comfortable. And as you can see, it's not happening overnight, right? This might take a few years, which is cool, which is fine. But this is where I then want to build an income machine, and we'll talk about this in a moment. So the Rock Solid Trading Foundation, this is where, again, you need to define your goals and then master some very basic skills. For example, for options trading, options 101 probably won't hurt, right? Because if you think about it, all of the difficult option trading strategies, we only have 4 building blocks, right? So you can buy a call, you can buy a put, you can sell a call, and you can sell a put, right? That's basically it. And all of the trading strategies that are out there are comprised of a combination of these things, then together with different expirations, with different strike prices, but you get the idea. So let's talk about the perfect trading strategy. What is the perfect trading strategy? And here's the deal. The perfect trading strategy doesn't exist. It's like the perfect car. What is the best car in the world? Type it in the chat. Let me know. What is the best car in the world, right? Is it maybe a Lamborghini? Is it Ferrari? Is it a Tesla? I have a Tesla. I love my Tesla, right? I just got back from a 14-day trip with my daughter Vivian. So we went to Florida because my daughter is actively sailing, and we have a 30-foot enclosed trailer where we transport her sailing boat. And the best truck for this job was our F-150, right? Because I love my Tesla, and the Tesla can't tow a 10,000-pound enclosed trailer. So that's where, yeah, I mean, Lightning Brick said it, the one that you like to drive. And it's the same with the trading strategy. So let's actually zoom in here a little bit more. You see, we go from a very high level where we go from this map, and now we are zooming in a little bit to the perfect trading strategy. So for me personally, it's the wheel strategy, and I'll explain this to you in just a moment, what that is. So how do you find the perfect trading strategy? Well, first of all, you need to make sure that you have written the rules down. And there's 3 sections. Number 1, you got to define what to trade, right? Number 2, when to enter and when to exit. And number 3, money management and position sizing. So that's an important part of every trading strategy. You don't have to go super complicated, but trust me, writing this down beats like, oh, I'm going to buy Tesla today. Or we just talked about cryptocurrencies. Let's buy some Bitcoin or Ethereum or Solana or Dogecoin or something like this, right? I mean, have a plan. What do you trade, when to enter and when to exit? Secondly, you got to know your numbers. You need to understand the profit potential as well as the risks. Every trading strategy has risks. I'm going to show you what I do today and what the risks are of this trading strategy. And you need to make sure that you're okay with, because this is where it goes back to what is the perfect trading strategy? The perfect trading strategy is the trading strategy that lets you sleep at night. If you're waking up in the middle of the night, staring at the ceiling and saying, what have I done? Why did I enter the trades? That's not a good trading strategy. Now, step number 3, how do you always got to figure out, does the strategy work for you, right? And therefore, I recommend that you take at least 40 trades according to the strategy on a simulator, or trade the smallest account possible. You know that you can get a simulator here, a paper trading account with Tradier. Super easy. Contact Lex, contact the team. Let them know, hey, you know what, I want to have the simulator, the paper trading here, well, whatever it is. They will set you up. That's a really, really cool thing about it. And you should absolutely do that. So before we actually look at my specific trading strategy, let's talk about the ultimate guide for broker selection, okay? This is where you need to find the best broker for your needs without paying too much in commissions. Now, obviously, this year is sponsored by the Cboe and put on by Tradier. I have several trading accounts at Tradier. I'm loving it because it gets the job done. However, if you are right now dead set on day trading futures, then Tradier is probably not the right brokerage for you, right? Because they are fantastic when it comes to stocks and options. Or if you want to really, I don't know, trade something obscure, this might not be the best fit. So it's really important that you find the best broker, because as a trader, you're a team of one. And you need actually the help of a broker and a good CPA. So we'll talk about that here in a moment as well. All right. So this is the foundation. You do this usually just once or once every now and then, because then this is where we go to phase two. That's where we do the daily nitty-gritty stuff. That's where we get into this. So let's talk about this. And we will spend probably most of the time here in phase number two, because I would assume that most of you are super interested in, okay, give me a trading strategy. I want to see a trading strategy. So how does it work? So, okay, step number 4 is that based on what you decided, what you like as a trading strategy. And trust me, I used to day trade futures. This is why I brought this up. In the beginning of my trading career, I did this. I had 6 monitors, right? And I had 6 markets up at any given time, and I had my platform up, and I was just trading fast and furious. Was sitting in front of the computer 2-3 hours a day easily, maybe sometimes even more. Now, as I'm getting older, I'm getting lazier. So right now, these days, with trading stocks and options, mainly options, I'm only spending maybe 15-30 minutes a day. And all I do is I have one laptop, which is my MacBook Pro, and then I have one external travel monitor because I love to travel. Okay, so this is where you create a bulletproof trading plan. And I want to show you mine. So this is a trading plan that works in any market condition, and this is where you want to do this without worrying of doing it wrong or losing too much of your money. So I'm in general using a tool. It's called the PowerX Optimizer, and I will show you more of the tool here in just a moment. But you see, this is where I have a trading hub here, and this is where I enter my plan. You can do this in a Google Doc. You can do it in a Word doc. You can do it in a notepad. It doesn't really matter. But now I want to show you what a trading plan looks like. And I'm zooming in a little bit so that it's a little bit easier for you to read. And again, there is these main sections: what to trade, when to enter and when to exit, right? And then money management and position sizing. And you can add some other rules. There's not too much here that I have in other rules. Let's actually bring up the other rules. The big one here is make a mistake, liquidate. That's one of my rules. When I realize that I make a mistake, immediately get out of the position here. So again, I'm trading the wheel strategy, and the wheel strategy is not for everybody. It has risks, right? I like every single trading strategy, and it has some requirements. And the main requirements is that you need to be approved for selling puts and calls. So talk to Tradier and the team there of how does it work, how to get approved for this level. You can probably not do it in retirement accounts, but I'm not quite sure. Again, this is where the Tradier team is just amazing. You can give them a call. They answer usually on the 2nd or 3rd ring, which is one of the big reasons why I love Tradier. You talk to somebody right here in the US, and you have somebody knowledgeable on the phone, or you can send them an email if it's not time sensitive, and they'll get back to you within a couple of hours. Anyhow, so what to trade? I like to trade value stocks. So what are my criteria for value stocks? They have to be profitable according to Google Finance. They have to have preferably profitable quarters, but profitable years are okay. 20 and 21 is an exception. We know that 2020 and 2021 was the pandemic. And this is where some companies were struggling. And I'll show you a very specific example of a trade that I just did. For me, paying a dividend. Yeah, that's the definition of a value stock. Tesla is not paying dividends, right? I mean, they're a growth stock, still a growth stock after all these years. Hold on. So, and that's for me a rule of thumb and should be obeyed. But if everything else checks out, no dividend is okay as well. The PE ratio for me should be smaller than 50. Market cap of 5 billion or more. It's okay to adjust to 2 billion until we make new all-time highs. See, companies that used to be worth $5 billion a little bit over a year ago when we made peaks in the markets are now worth maybe 3-4 billion. So got to be able to adjust your filter. But as you can see, I've written them down, right? What else? The strike price must be at support according to the lowest low indicator, plus minus a strike. You'll see that in a moment. I will only choose stocks with weekly options. I like to trade weekly options, and there's plenty of stocks. There's like 1,200 stocks or something like this. I mean, the Cboe does a great job of giving us here plenty of opportunities. So I don't need to trade every single option. I like weekly options. The earnings must be after the expiration date of the option. Stocks must have a correlation of 0.65 or lower with other stocks in my portfolio. No leveraged ETFs, no bio stocks, biotech stocks, no Chinese stocks. Okay, so let me show you what this looks like. So we come back to this this trading plan, but I want to show you a few trades that I'm in right now and that I recently did. One of the trades that I'm in right now that I just took last week is UNP. So UNP, Union Pacific. So first of all, let's take a look at the criteria here. So they need to have a P ratio less than 50 and pay a dividend. The P ratio is 17.98, and the pay a dividend and the dividend yield is 2.58. Then another rule here for me is they need to be profitable according to Google Finance. So I'm going to Google Finance. I'm looking at the quarterly statements. The blue one here is the revenue. The orange one is the profit. And yes, they're doing well quarterly. They're doing well annually. And look at this, even through 2020 and 2021. Nicely done, right? So they are doing pretty well. I also have an asset correlation tool, and I have, let's see, two other stocks in my portfolio right now, Google and CTRA. So I want to see if I'm adding UNP, that we do have a correlation of 0.65 or lower. What does it mean? Well, a correlation of 1 means that UNP is moving exactly like whatever stock I'm comparing it to, right? And you know that this is very rarely happening. A correlation of -1 move that means that they move in opposite directions. So for example, if Google and UNP right here had a correlation of -1, it means that whenever Google goes up, UNP goes down. If they have a correlation of around 0.47, as you can see here with Google, or 0.34 with CTRA, it means that it is not very highly correlated. And the reason why I like to do this, because I don't want to put all my eggs in one basket. Okay, so that's just one of the criteria for me. And this is where we go back here and we see market cap. Oh, let's take a look at the market cap here. The market cap is 123 billion, so definitely above my 5 billion criteria here. The earnings, so let's go to this here right now. Earnings must be after the expiration date of the option. I sold options expiring this Friday. As we can see, earnings are on April 20th. Today, as we're recording it, is February 22nd. So we have another 2 months, 57 days until earnings, so plenty of time there. So this is where it goes back to what to trade, right? So that's the first one here. So it checks all of my criteria here. So now the key question is when to enter. And I just want to quickly glance over and see if there's any questions that you have so far. Doesn't seem this way. That's okay. And I do believe that I have another 10 minutes or so. So let me just ask you, is this helpful information so far? Or are you enjoying this? Is this something that will help you not only during this presentation, but hopefully at the end of the day and watching these other presentations? Is this cool? Just let me know in the chat, or even better, click on like this video here, because we're streaming on YouTube. That would be fantastic. All right, cool. So let's keep going. Now, what I'm looking for is, and this is where a trade that I entered last week. That's where I sell put options. So why do I do this? Why would I sell put options? Well, because this way I'm collecting premium. And the cool thing is that UNP can do one of three things, as you know. A stock can go up, a stock can go sideways, or a stock can go down. Actually, I want to say that there's 5 different scenarios. A stock can go up a lot, a stock can go up a little bit, a stock can go move sideways, a stock can go down a little bit, or it can go down a lot. So this is where I want to see. By the way, you need to see this super huge weird bar. Do you remember when the New York Stock Exchange had some problems in the opening? They still haven't corrected it. Super annoying. This is the one bar where the New York Stock Exchange had some problems, and this is where they say, no, we just leave all the data there. Well, their decision, right? Not much I could do. Could probably email them or write them a letter or send them a fax, and they wouldn't care at all. So a few days ago, this is what I saw, that UNP was trading around 200. So I did sell the 197.50 put option. And by doing so, let me just show you, I received $1.80. So based on my account size and my position sizing, that's $1,440 in premium. Now here's the deal. This is for until February 24th, which is this Friday. So it's in 2 days from now. So if UNP stays above 197.50, nothing happens. I just keep the premium. Cool, no worries, right? If on Friday we close below 197.50, I still keep the premium, but now I get assigned the stock and I have to buy the stock at 197.50, and I'm okay. That's why I'm doing this research before, right? Do I want to own this stock according to my criteria? This is why I have a few criteria here. So you can see they're not too complicated. A trading strategy doesn't have to be complicated. This is what I experienced for myself. Whenever I made it more complicated, I messed it up. So this is where easy works best for me. Excuse me. All right. So if it closes below 197.50, I get assigned. And this means that now I own the stock and hopefully I can sell calls against it and collect more premium. Depends how close we are to the assigned price. As you can see, as of right now, today, we're at 192.35. So if we stay there by Friday, I might get assigned. I still keep the premium anyhow. So today is not all about the wheel strategy. I have some videos on my YouTube channel. You can do this, or I've even written a book about this. So if you go to my website, rockwelltrading.com, you can get the book. Just pay shipping and handling $4.95, and I'll be happy to ship it to you. Or you can watch some YouTube videos. I mean, the wheel strategy, it's not a new strategy. I'll be happy on my channel to explain you how exactly I trade it. So this is what I do there. So what are my criteria for the entry here? Why did I decide, if I overall like UNP, why did I decide to take this trade last week? Well, this is where it goes back to when I'm selling calls or puts, I want to make sure that I get at least 30% annualized ROI. And this is why I have my little nifty calculator here that calculates for me how much ROI, annualized ROI, would that be, with a very simple formula. It's not that complicated. So going back to here, here's what I like to do on Monday and Tuesday. I like to sell this week's expiration. Today is Wednesday. On Wednesday, I like to sell this week's or next week's expiration. This trade that I'm showing you, I entered last trade and I sold last week, and I sold this week's expiration according to my rules, right? Thursday, Friday, I like to sell next week's expiration. So that's what I do for selling puts and calls. The most important thing for me is that I get at least 30% annualized ROI. This is why I'm using this tool, the PowerX Optimizer, because it shows me right now, it scans the markets every 2 minutes and shows me, okay, what are right now some trades, possible trades here, and there's only pin duo popping up. But you see, I flagged it as trade never. Why? Because it's Chinese stock. And what do my rules say? See, my rules say, okay, no Chinese stocks. For example, Bubba. Or I could add it here, PDD, pin duo. It's another Chinese stock, right? It shows that I last edited right now. It's okay. So you get the idea. That's actually super simple. I like to keep it simple here. Okay, what else? Well, then for selling calls, after I get assigned, right, I sell at the assigned price or above, but I want to make sure that I get at least 30% annualized. Again, the 30% annualized for me is a big deal, and here's why. Right, because the goal per year for me is 30%, and then I personally like to trade on margin. And again, talk with Tradier about margin, right? I mean, margin is a double-edged sword. It can work for you as well as against you. When you know what you're doing, it's cool. All right, think about it like driving a really, really fast car, since we talked about cars, right? I mean, think about the Tesla Plate, right? I mean, would you give it to your child after they just learned how to drive? Probably not, right? And same here. So if you are absolutely new to trading, I don't think that you should trade on margin. However, if you're becoming a more experienced trader, margin is like adding fuel to the fire. And again, double-edged sword can work for you as well as against you, but this is why when you are trading with margin, these 30% are automatically doubling to 60%. And we're just talking about regular margin here, so nothing crazy like portfolio margin. This is where you can apply for a margin account if you want to do so. So this is why the 30% are for me kind of, yeah, that's the threshold. But this is where it goes back to, right? I mean, what are your goals? The rock solid trading foundation. See, this is why it's so important to have these goals. I just want to see, Lex, are we good? Can I go until 12:30 as planned, or do you want me to cut it short? Just want to.
You're good to go till 12:30, Markus.
Okay, I just want to make sure that I'm respecting everybody's time and not messing up your schedule. Because don't you hate these kind of speakers that are just hogging the time and go forever? So
all good.
Okay, good. Right. So again, this is where you need to have your goal and to be sure that you're okay with this trading strategy. I'm okay getting assigned. It's part of my plan. And here's why. Let me just show you again as I'm going to my trading log that I have here. So as you can see, last year, I made $90,000 selling puts and made another $63,000 selling calls. This is why I got assigned 36% of the time. So every third trade I got assigned, and I don't mind this at all. But again, the perfect trading strategy is the one that you're comfortable with. If you prefer not getting assigned or you prefer to trade credit spreads, that's absolutely fine, right? This is why we say this. Okay, let's move on here very briefly, and then maybe we can come back to the trading plan. But I want to make sure that I'm covering at least these other two. So this is where the unshakable trader, right? You want to use cutting edge technology to make confident and profitable trading decisions without wasting other hours analyzing options. And this is why I like to use the Forex Optimizer. You might use TradeHawk, which is an excellent tool, right? Provided to you by Tradier. So whatever you choose to do, it's fine. Just don't bring a knife to a gunfight, right? When you're trading against really, really smart traders. So you're trading against traders at Goldman Sachs, at JP Morgan, at Citibank, right? You're trading against traders that have been doing it for 20, 30 years. So you want to make sure these days that you're using cutting edge technology. And for me, that is the Forex Optimizer, because it gives me all the information that I need for my strategy, right? Because I see here at a glance, for example, you see the market cap, you see a dividend yield, you see the PE ratio, you see the next earnings, you see the strike prices, you get all of the information. I get all of the information that I need so that I can be a lazy trader, because I like to be a lazy trader. So let's talk about the last step here, step number 6. I don't think that we have time to go into wealth mastery today, but that's okay because we're mainly talking about trading, and that's the rapid trading improver. So you see, you got to find out what works and what doesn't, using a data-driven scientific approach to maximize your gain and minimize your losses. What does this mean? It's fancy for keep a trading log. And that's what I like to do. This is what I'm showing you here. This is it's a very basic trading log that gives me some important information here. But for example, I want to see how I did on a variety of symbols. And I want to see what was my most profitable trade. And my most profitable trade was an NVIDIA trade. Made $26,000 on NVIDIA. $25,000 selling puts. No, here, sorry, $9,000 selling puts, $16,000 selling calls. Now, if you look at NVIDIA, you will see that this is a trade that went massively against me. Why? Because I'm going to zoom out here a little bit. I got assigned at 220. I got assigned at 220. And look at this. It went all the way down to what? 110? That's a 50% retracement. But I'm not nervous about this. I'm okay with this. And again, this is where I know that I can use this to my advantage to make money. My most profitable trade. Let me show you my second most profitable trade. So my second most profitable trade was, I believe it was TPR. Yep, $17,000. $8,000 selling puts, $9,000 selling calls. Let's take a look at this one. TPR. I got assigned at 36 at one point. Right here. See this? Look at this. It went all the way down to 26. How much of a retracement is this? From 36, went completely against me, 30% down. But I'm okay with this because this is where I can make a lot of money selling calls. Anyhow, just wanted to give you an idea. And the other things is, we are just expanding on the trading log. But there's some important things that I know. How many times was I assigned? And here's one of the things that I really, really love. Look at this. But as you know, I'm a pro subscriber to Tradier, so I'm paying the $10 per month, and therefore these are just the fees. These are the NFA fees. Realized $155,000 in profits and paid $621 in commissions. Didn't pay any commissions, as you know, other than the assignment fee, which is $9. I paid this a few times. But this is where I like that a lot because it's next to nothing. And for an active trader like me, who also trades a little bit larger size, this is just perfect. All right. Lex, I know that we have 2 minutes, and I would just want to see if there were any questions that I can address here. And, let me just know in the chat if this has been helpful here. And again, I have a YouTube channel. Feel free to stop on by there if you want to dig deeper. Here, I crammed in as much as I could in the 30 minutes that we had together.
Thank you, Markus. Very good. Let me, I'm going to put us both on the screen if that's okay, and ask a few questions. Can you see this one here?
Yeah, what do you do if after assignment you subsequently cannot sell a covered call that delivers a reasonable return? Just hold for dividends. You can do this. What I personally like to do is, depending on how far it moves against me, I like to dollar cost average, right? To bring down my cost basis. So that's where I would sell more puts at a lower price to get assigned again, and therefore bring down my cost basis. So you can do this, and otherwise you might have to wait a few weeks, right? Like in every single portfolio, this can happen. If you're uncomfortable with this, you can think about applying a stop loss, for example, and say I'm cutting it loose. But that's a great question. Yeah,
good. Couple other ones. I know we're right at time, but let me ask a couple ones. You mentioned no biotech, no Chinese stocks.
Yes.
I think I know why, but what's the reasoning there? Would you say why those two? Too volatile, too crazy?
Yeah, I mean, this is when I already say go for value stocks. There we go. Go to values. Usually Chinese stocks are not necessarily value stocks. And as we have seen, the Chinese government likes to change the rules of the game. There was this education company, I can't remember, I think it was GSX or something like this. So they were doing great. Their stock price was in the 30s. And then the Chinese government says, you know what? All education companies should be non-profits. What happened to the stock price? Plummeted and will never recover, because now by default, and you see the Chinese government can do stuff like this. There was this the Chinese competitor to Uber who said, okay, we want to be the Uber of China. And the Chinese government one day just said, you know what? We have a new law that you cannot accept new customers. I mean, the stock price craters. It's just too irrational, because you want to make sure that you're comfortable holding the stock. And biotech, a lot of biotech is it's one-hit wonders, right? And if it works out, it's like EVIA. That's where, again, you have this 5xing, the 10xing, and that's what I've experienced in my career. This can happen, and you can lose all of your money, because if it doesn't work out, if they don't find a cure for cancer, if they don't find the new Alzheimer drug, it all tanks. So
Got it. Okay, good. One more, and then we'll let you go. Did I miss an explanation of option selection in following 30 delta, 30 days till X? I know you mentioned a little bit. What delta do you like to sell on the put? Is there?
I'm not necessarily looking at the delta. It's a great question, but you see, the Greeks are really Greek to me. They're too complicated for me. I'm just looking for how much premium I can get, and then for me, the most important metric is the PPD, the premium per day. Right? Because there's a difference whether you get $1.80 on an option that expires in 30 days, or you get $1.80 on an option that expires tomorrow, right? So this is where I use the premium per day, and then I use this annualized based on the money that I commit to the trade, and that's how I'm getting to the annualized RI. And yeah, I mentioned it. So on Monday and Tuesday, I like to sell calls that expire on Friday. On Wednesday, Thursday, and Friday, I like to look at options that expire next week. So I'm extremely short term here. This is why I like weekly options. And again, that's what fits my criteria. That's the best trading strategy. Is this the best trading strategy? No, it isn't. It's the best trading strategy for me. It's the one that lets me sleep at night.
That's perfect. And then lastly, how can folks get the trading plan? Is it through the website they can sign up for your service? Is that
it is somewhere on the website, the 100K plan. I need to double check. We were right now redoing it, but shoot us an email. I mean, support@rockwelltrading.com. If you want to have this, we'll be happy to do this. I don't have the link right now. Because like you know me, I'm coming here to provide value. I'm not here to sell you anything, right?
Well,
And I'm not here to say, if you don't trade the way that I trade, you will lose all of your hair, and your spouse will leave you, and your kids will never talk to you, and your dog and your cat will die. No, I'm just sharing what I do, and I hope that you find this helpful here. And if you do, you find me at rockwelltrading.com. You
Perfect.
text us, call us, email us, and I'll be happy to.
All right. Well, very good. Markus, thanks as always. You always give such a great presentation. Everyone always enjoys it. So thank you so much
Thank
for
you.
coming.
Thanks for having me.
Okay. Bye now.
Bye-bye.
All right. So I think we're at break number 1. After the break, we're going to do our question so you can get entered into the $500 prize and the shirt. So we'll do that after the break. I'm going to put up on the screen a little timer. It's probably going to be a little short of 10 minutes. So just be aware of that. And our next guest is in the wings. We'll talk about that when I get back. So I'll see you in about 10 minutes. It's nice when my mic isn't on mute. So we're going to get rolling here. What we're going to do is ask a question. I was just told that I should have asked a question while I was on break. So I totally messed that up, but I'm going to ask it anyway. So the question is, and I need you to write your answer in the comments. We will take all the correct answers, put them into the hopper, and spin the hopper. I don't know when we're spinning the hopper, but we're going to do it that way. So the question is there's a strategy called the seagull. Remember my bird analogy. So it's called the seagull. How many legs, not including the underlying stock, which is a hint, comprise a seagull? So throw that in there. We'll give you the correct answer in a little bit. And then we will put you in the drawing. So I am looking for the folks to tell me how many legs in a seagull. I see a few coming in. I love it. Keep them coming. Keep them coming. While we're collecting all these, we are going to introduce the next presenter. Her name is Créde Sheehy-Kelly, and she is an internationally renowned high performance and trading psychology coach. So everyone's probably thinking, wow, what does that all that mean? We're going to find out in a second. But she's fantastic. She and I have done some OBTV shows before. Just a great lady, really knows her side of the business well. I can't tell you how much the psychology part of trading is important. So and she's going to get into it in depth, I'm sure. So let me bring her out. Créde, hi, can you hear me?
Hi, Lexi, I can hear you fine.
Okay, I'm in a new place here. I'm like all over the board here today. I'm in a new office. So what I'm going to do is I'm going to leave and let you do your thing here. So I can give you full time, but make sure you tell the folks a little bit about yourself as well, because I just think it's fascinating and what you do and how you can help folks too. So really terrific. Before you start though, let me get the right answer for everybody. Oh, I'll do that after your spot. We'll get the right answer. Everyone will collect. So are you good to go?
I'm good to go. Yeah, ready.
I've got to add your this in there, and I'm going to separate out, and I can hear you. If you need me, just tell me to jump in.
Perfect. Thanks.
All right, Créde, thank you.
Okay. And there it's up. Okay, hi everyone, and I'm really delighted to be here. Markus is going to be a hard act to follow, so luckily my topic is completely different, so hopefully it'll be fresh in your heads and I'll do a good job as well. But I will warn you at the outset that I'm Irish, so I have the gift of the gab. So I'm going to try and keep this as concise as possible while still giving you as much value as possible. So I know that it's a short time slot, so I have a lot to cover, but we'll get there. And if there's anything that you want to know more about, of course you can ask in the questions, and I'm happy to elaborate on that at the end. So really quickly, just to give you a sense of who I am and why I'm here, I'm a high performance and trading psychology coach. My professional background was actually in sports psychology. So that was most of my career spent working with athletes, teams and individuals to help them win gold medals and championships. But for the past 4 years, I've been working almost exclusively in the trading arena with traders, so helping them to master their mental edge. So that's what we're talking about today. It's the psychology side of trading. I have 3 key goals with this talk today. So my first one is to make a case for why, if we're talking about improving your trading performance, by looking to pro sport, high performance sport is a good place to actually draw from, and how different paradigms from sports psychology and high performance sport can be applied to your trading and can help you to make more profits in the market. So that's the first thing, to convince you of that. The second one then is just to demystify the mental edge. Trading psychology can seem really abstract to people, and it sounds like a nice to have that is the icing on the cake, but a lot of people find it difficult to actually understand how to go about improving their trading psychology. So that's what I'm here to do today, is explain what the mental edge is, give you a very concrete sense of what it looks like when it's in place, and also what it looks like when it isn't. So what can happen in your trading if you don't have a sharp, strong, resilient mindset. And then finally, I'm going to talk about some practical tips and techniques that you can use to actually start working on your mental edge. So to give you some exercises that you can walk away from this presentation today with and start using to actually see results in your trading pretty quickly, you know, in the next week or two. So that's my goal for the session today. So let's jump into it. This is a sobering stat to shock you at the start of our presentation. Not to shock you, but it is sobering and it is worth noting. So only about 1% of day traders can predictably profit net of fees, and 80% of day traders will quit within the first 2 years. So also, I note that we're talking about day traders here, but that's just to say that the research just focused on day traders. That doesn't mean that swing traders are immune to these stats either. That's a pretty significant stat when we're thinking about people, you know, putting a ton of effort into trying to become consistently profitable, make full-time incomes from trading, all of that. So I'm not saying this to scare you or to demotivate you at the outset, but really what I think this stat shows is that there is a huge gap in trading. There's a lot of excellent information around how to improve the technical aspects of your trading. So better strategies, you know, better execution of your strategy, all of that. But a lot of people stop short just there. They work on mastering the technical aspects of their trading and they never work on mastering themselves. And that's really where the mental edge comes in. And to me, that is the difference. If people work on that side of things, it can elevate you to the peak of your true trading potential, as opposed to kind of leaving a piece of the jigsaw puzzle out. So why are we talking about sport when we're talking about options trading? I'm going to just compare these two. So compare and contrast, and to set up my argument for why it's a really important area to draw on. So obviously both are high performance domains. So, you know, you need to perform under pressure, and split second decisions can make or break your career in both of these. But the differences between them. So obviously the type of skill is different. In sport, it's mostly physical skill that's at play. So, you know, athletes have to be fast, they have to be strong, they have to be flexible, all of that. And in trading, clearly, it's more on the cognitive side of things. So it's your mental sharpness, it's figures, all of that. So there is a little bit of difference there. The parameters are also different in terms of performance. So when you're, let's say, in a football match, there's probably only a certain amount of things that can realistically happen in that amount of time. So well, whether we're talking about NFL or soccer, I'm going to say 90 minutes because when I say football, I mean soccer, but obviously it could be NFL as well. So there's a certain amount of things that can happen, which makes it difficult, yes, but there is some kind of constraints around it. In trading, I feel, or it's my interpretation anyway, that anything can happen. There's a lot more uncertainty in the market than there might be in a match or, you know, in an athletic championship. So in that way, I would say that trading is possibly even more difficult. And also one thing that I feel makes trading a little bit more difficult is that the performance window in sports, you have to perform in a certain amount of time and then you can switch off and you're done. So you finish the match, you go home, you do your recovery, you have a meal and you switch off, and then, okay, you might start training the next day if you're a professional athlete. But, you know, there is a constrained time frame upon which you have to perform in. For traders, you could actually be trading pretty much 24/7 if you were trading different markets, different time zones around the world, all of that. So it's kind of like you could endlessly be performing. So there's some of the differences, but let's look at the similarities. And this is really why there's such an overlap between the two and why we can draw on sport to improve our trading. The length of time that it takes to master both sport and trading is pretty long time. So people sometimes think that you can master your trading in a year, you should be consistently profitable within a year, and it's just not like that. So Malcolm Gladwell said that it takes 10,000 hours of practice in order to become a master in a certain area. And that's probably true in sport if we're talking about actually pushing to the level of professional, and also in trading as well. So it takes a long time. Both of them require a game plan. You have to know exactly what you should be doing. There has to be some structure around you know, what you're supposed to actually execute on the day in your performance. So in sports, that's your game plan for the day. In trading, that's your actual trading plan. You need to know when you should be getting into trades, when you're getting out of them, the strategies that you're using, all of that. Both of them require performance under pressure and intense pressure. So you need to be resilient and able to deal with that. Both of them have the person at the heart of the performance. So you can't separate the person from the performer. If there's something going on with you, the individual, stress outside of trading in your personal life, it's going to show up when you're trading, and it's possibly going to impact your actions in the market. The same is actually true for athletes. But the piece that I really want to focus on is that the mental game can be the difference between winning and losing. And that's true in sport, and it's true in trading as well. If you think of an Olympic athlete who has done everything they possibly can to be as technically proficient as they can, and they're up there with the best of the best. And then the difference between a gold medal and a silver medal comes down to split seconds, like a tenth of a second. Well, it's really about the mental side of things at that point. Who's the athlete that can deal better under pressure? Who can come back from mistakes better in the middle of a match? It's all the mindset side of things that can actually mean the difference between winning and losing, or winning and being a runner-up. Okay, so the point is that in order to be successful in both sport and trading, natural talent alone is not enough. You might be naturally talented, but it will never carry you right to the peak of your potential. Also, technical skill is not enough. So in trading and in sport, you can be as technically proficient as you want, but if the mental piece is missing, you're not going to be able to pull the best performance out of yourself when you're sitting there in the market as a trader. You need that to be in place. And sometimes people they underestimate the power of the mental edge. They think it's something just to add on as opposed to an integral part of your trading. So the mental edge, let's define it. It's the competitive advantage that you experience when your mindset, your emotions, and your conscious actions all support the consistent and successful execution of your trading plan. So that's really wordy, so let me break it down. It's basically when your thoughts, beliefs, emotions, and actions are all aligned, and they're all supporting you in executing your trading plan exactly as you want. So that's the definition of it. Excuse the blurry fire diagram here, but I just wanted to use it in order to explain the mental edge. So we know that for fire, you need these three things. And it's the same with the mental edge. You need each of these three core components in order to arrive with a mental edge. The first one is mental conditioning. So you want to actually work on your mindset so that you can get it to a place where it supports you in achieving your peak trading performance. And I guess when we're talking about performance here, what we mean is really profit. Like, that's the measure of performance. That's the bottom line. So in order to get your mindset to that level, what you need to do is work on your mindset. So you actually train different parts of your mind in order to strengthen them. And then you also want to have excellent emotional regulation. You need to be able to deal with your emotions when you're in the market. Emotions like FOMO, impatience, the urge to revenge trades. If you're in control of those and you're either not feeling the emotions, or if you feel them, you're not acting on them, that will allow you to execute your trading plan exactly as you intended. But we also need resilience. If we get to the peak of our potential in terms of an excellent mindset, excellent composure, we need to be able to sustain that under pressure. So when you increase your size, maybe when you're transitioning from sim trading to live trading, there's these steps up in pressure that are inherent in your trading career. And at each point, the pressure increases. And if you're not resilient to the impact of pressure, especially on your thinking, then your performance is going to crumble. So you can actually train to become more resilient to the effects of pressure. So that's part of the mental edge. And then lastly, at the bottom, we have personal well-being. So the person that you bring to the market, you can actually make sure that that person is optimized for performance. And I'm going to explain what I mean by that when I talk about a performance lifestyle approach. But basically, it's not just the actions that you take when you're sitting in front of your computer that are going to determine whether you're making money or not in the market. It's actually all these habits and routines that you have that support you, the person, things like sleep, energy management, even down to your hydration, your nutrition. These all have an impact on your performance. And if you're looking to be a full-time trader, make a really substantial income out of trading, these are things that you can't ignore if you really want to push to the full level of your potential. So what does it look like when the mental edge is missing or needs work? Basically, it all boils down to this. You have an excellent trading plan. You have very clear rules. You know exactly what you need to do. And then in the heat of the moment, you just don't do it. So you completely deviate from your trading plan. It's impulsive. Sometimes you don't even understand why you're doing it. You know, your conscious mind says do this, and then you find that suddenly you're jumping out of the trade too soon because you're feeling the FOMO or feeling the fear of the uncertainty in the market. So if you don't have a strong mental edge, or if it needs work, and usually it does need work, it's kind of an ongoing aspect of your trading that you'll always be working on. But if it needs a lot of work, let's put it that way, then your emotions will be driving your actions. So you'll be feeling FOMO, which could lead to being overactive in the market. You're taking too many trades. Could lead to revenge trading. So you have 3 losses in a row, suddenly you're trying to get back in the market. Maybe you're ignoring your stops because you don't want to accept that you're going to lose on a trade, and so you try and stay in there to keep it going. Inability to deal effectively with pressure. So this can look like doubting your trading plan. So when you see your setup appear, you don't get in, you don't pull the trigger. It could mean getting in or out of trades too early, and just even generally poor decision making. And then suboptimal mental performance. So having a lack of focus or attention, or the incorrect focus. So you're looking at the wrong indicators in the charts, you're looking at the wrong time frames, just your focus is not where it needs to be. But when it's actually in action, when you have a good, strong mental edge, I'm not going to read through all of these, but just basically, you have a strong trading plan. It's, you know, profitable when you backtest it, and then you can consistently execute like that, like a robot, every time that you trade, every time you're in the market. So that means recovering quickly from losses, being totally in control of your emotions. You're sticking to risk and loss limits. You've excellent discipline. And you're able to actually accept losses as part of the overall game plan of trading. If you have all of these components in your mindset, then you're going to be much more resilient, and you're going to be able to execute your plan no matter what the circumstances, even no matter what's going on within you, the person. So just to give you a flavor of the building blocks of the mental edge, what I want to get across here, and I know I don't have much time, so I'm just going to try and introduce you to a real top level view of this. But I've just broken down this diagram into these different blocks, but this is not exhaustive. So there's way more aspects to the mental edge. But just to show you, there's all these subcomponents that you can work on individually, which will all lead to improving your mindset for trading. So improving your trading psychology. And these can be very practical things, from just setting really effective short and long-term goals that focus on the execution of your plan as opposed to the P&L. That's a really practical part of it. Whereas some of the more in-depth parts of it would be working on knowing your trading why. So what is your what is your motivation for trading? And that's, if you know that in a really deep level, and if you've journaled around it, that will keep you motivated and confident even when you face a setback. Another piece of it would be, even from a very practical perspective in terms of mental training, having a mental preparation routine before you enter the market. So making sure that you're in the best state possible, physically, mentally, and emotionally, before you ever even sit down and take a trade. And that's something that you can do every day before you enter the market. So there's all of these different aspects to the mental edge, and they range from very practical to, you know, quite deep and digging into your psyche, but they're all important. So how do you actually gain the mental edge? This is the third part of what I'm going to cover today. So I'm going to draw on performance paradigms from sports psychology here. So basically, like I just said, it's not about just what you're doing when you're sitting there in front of the screen, when you're in the market, that's going to determine how much money you're making from trading. Just like professional athletes, it's not just what they do when they're on the pitch, like competing, that's going to determine their success, whether they win the championship that year. It's about all these small things that they take care of on and off the pitch that will actually culminate in peak performance. So they all add up and they become greater than the sum of the parts. And it's the same for trading. So I'm going to show this in a diagram in a second to make it more concrete. But basically, if you want to be the best trader that you can be, you have to think wider than just what you're doing when you're sitting at your desk. David Brailsford, I'm conscious of time here, so I'm going to just really go through this at a top level. He was the GB performance director for GB cycling in the 2008 and 2012 Olympics. And he was subsequently the director for Team Sky, so professional cycling. And he coined this term marginal gains. So when he was in charge, and they won a lot of gold medals, they were very successful. There was a bit of a doping scandal. I'm not going to comment on that. I think that this concept is really important for trading, and and sport as well. So I'm just going to talk about that. You can research the doping scandal yourselves. The marginal gains system, or the approach, is the idea that if you can seek 1%, 2% improvements across a whole range of areas, then the improvements will culminate together and become greater than the sum of the parts. So what he did when he was in charge of Team Sky and GB Cycling, he got the athletes to do things like bring their own pillows when they were traveling to get a better night's sleep, to wash their hands. They got someone in to teach them how to wash their hands better, well before COVID, and hand sanitizer, so that they could reduce the symptoms of, or the incidence of, illness in the team. So they took all of these tiny actions, and it turned out that they were highly successful. So they left no stone unturned. And you can apply the same approach to your trading. And I'm going to show you how really quickly with a very straightforward exercise in a second. But the mindset that we're approaching trading performance with is summed up by this quote here by Vince Lombardi. There's only one way to succeed in anything, and that's to give it everything. So this is, yeah, sure, it's not an approach that's for the faint-hearted, but it really is the way to approach trading if you want to get the very best out of yourself. So performance profiling, and I'm going to explain this in about 2 minutes, is a really straightforward exercise. It's a tool that athletes use to enhance performance in sport. And it considers performance from this holistic lifestyle perspective that we were talking about. It helps you understand exactly where your strengths are and where your areas for improvement are. And then it becomes a performance monitoring tool. So if you break down your trading performance in the way that I'm going to show you in the next slide, you'll be able to always assess like how you're faring, not even by looking at the P&L or your profit. It allows you to take a much more process focus as opposed to an outcome focus. And it shows you all of the different things that are in your control that you could work on to improve your trading profit. So hopefully this will be clear when I show you this diagram in a second. It also forms the basis of setting effective goals. So not trying to work on everything at once, but just picking the one thing that if you can improve that by even 3 or 4% right now in your trading. So it could be maybe the quality of your entries. That might have a huge overall impact on your trading performance and your profit. So it's about finding those quick wins and the most significant places to focus your attention in order to get more returns. So this is a trader performance profile. Basically what you do is you break down all of the factors that combine together to impact trading or to produce peak trading performance. You think of everything that's important and you split it into physical factors, mental factors, technical or skill factors, tactical factors, and lifestyle. So you're going to just basically draw out 5 columns, and then under each of those columns, you're going to think about what are the factors that if I was 10 out of 10 on these things would combine to produce peak trading performance. So in the physical side for traders, we're thinking of things that keep you, the person, well, optimal mental and physical well-being. So we're not looking for, super core strength and vertical jump height when we're talking about traders, but things like getting outside every day is important, having some exercise in your routine. Mental is obviously all of the very specific psychology factors. So motivation, decision-making, focusing on the execution of your plan as opposed to the P&L, etc. Technical skill, these are all the really, the nuts and bolts of your trading. So these are the technical pieces, like Markus was just covering. So things like the quality of your entries, your exits, your strategy, how you're managing your stops. Tactical would be more in terms of the very strategic aspects of the plan. So maybe having multi-market experience, understanding how the market changes, in long-term cycles, things like that. And then lifestyle, don't think of when they're thinking of trying to improve their trading. Sleep, one of the most crucial. In all of the traders that I've worked with, anyone who's not getting probably more than 6 hours sleep a night is setting themselves back when it comes to their trading performance. So that's one of the key things to work on. So you can see all the factors here. So this is an example. Usually it would be a lot more detailed when you actually go and do it for yourself. This is just to give you a start with it. Then you go, once you have all the factors, you go and rate yourself out of 10 on every single factor. And that's your current snapshot of where you're at right now. And that gives you a really good sense of where you're strong and what needs improvement right now. And that's much more so than just, I need to stop breaking my rules. This will show you exactly what you need to do in order to achieve that outcome. And then lastly, what you do, so we're talking about quality of focus, not quantity. We break it down into the 5 key things that if you could improve them to a 10 out of 10 would give you the biggest lift in your trading performance right now. And then once you've got those 5, you narrow it down to the 1 key thing to focus on. So for this person, even though they prefer to have a better process focus, they're not being very patient to wait for their setups to appear, it's actually the quality of their exits that if they could nail that would instantly bring them more profit in their trading. And so you can see that this is a really good exercise to start broad and get really focused and clear on the 1 thing you need to work on from a psychology perspective to see things uplift instantly in your trading. So this is, like I said, a very top level introduction to the idea of the mental edge and trading psychology. But I'm just going to quickly recap the takeaways. So the mental edge is the competitive advantage that you experience when your mindset, emotions, and conscious actions all support you executing your trading plan. To be consistently profitable, you do need technical skill, yes, but you absolutely need the mental edge. And both your mindset, emotional control, and the ability to perform under pressure, these can all be cultivated through conscious practice. They're things that are 100% within your control. So to actually start working on this, taking a systematic performance lifestyle approach is key. And self-awareness is basically the foundation of your entire mental edge. The more you understand how your thoughts, beliefs, emotions impact your actions in the market, then the better you are able to intervene and fix where that's not working. So whenever you're breaking your trading rules, you'll be able to actually look at that pathway and say, well, it's this belief that's causing this emotion that's causing me to jump out of that trade too soon. And it gives you a clearer sense then of what you need to do to fix it. So I would recommend for everyone that performance profiling is the very first place to start with it. It's a really simple exercise. And if you do it properly and actually take a few days to do it in depth, you will really see some value for your trading. So that's what I've got for you today. If this little introduction taster has sparked your interest and you want to just dive into it in a bit more depth, especially in terms of actually looking at specifically how do you fix when you're breaking your trading rules, which is the biggest pain point that I see with traders. They know what to do, they're just not doing it. This masterclass is absolutely free. It's on-demand access, and it will go into those ways that you're breaking your trading rules and what to do about it in a lot more detail than I was able to do in this short session. But that's what I've got today. So I'm happy to take any questions.
Hello, Créde. Thank you so much for that. That was awesome. I really appreciate it. Some of the things you've gone over with me and some of our shows has been just wonderful. So real quick, I know we don't have a ton of time. I maybe have time for one question, but the biggest issue that you see with folks, I see you have a question here on FOMO, fear of missing out. I know what my biggest weakness was, especially as an off-floor trader. It was like I wanted to be a part of everything. I wanted to be in every trade. I didn't want to lose, and as a result, it probably wasn't the greatest thing in the world. So is there anything that you can tell the folks that stands out the most that you see just time and time again, and it's probably a pain point and a hurdle that's maybe a little harder to overcome?
That's 100%. So the single biggest issue is when people are over-focused on the P&L as opposed to the execution of their plan. So everyone knows they should execute their plan. Like that's what they're going into the market telling themselves to do. But when they're actually in there, their true focus is on the P&L. What does that look like? That looks like, jumping out of a trade too soon because you're afraid that you're going to give back unrealized gains. It looks like feeling FOMO and wanting to be a part of everything because you're afraid that you'll miss out on the opportunity to make profit. It's basically every single way that you could potentially break your trading rules is linked back with an over focus on the P&L as opposed to the actual execution of your plan. So a huge part of what I do is to help people to not just know that they should be focusing on executing their plan, but actually put practical techniques in place to shift that focus so it's authentic. So it's not just something you're telling yourself to do, it's something that you're actually doing. And the best way to be able to do that is to really work at the practical level of setting, a different type of goals and training your mind. But it's also actually about understanding the deep subconscious limiting beliefs that are causing you to impulsively break your rules as well. So it's a whole package.
Great. Okay, good. Well, thanks so much for coming. This is really, really interesting. I appreciate it. I love this stuff. So we'll chat in the near future here, but thank you so much for coming on.
Thanks for having me, Lex. Really enjoyed it. See you later.
Bye now. Okay, so I am going to spin the wheel, I think. Let me see if I can do this. Let's see. Here's the wheel spin. I hope you can see the wheel spin. Oh, you can see the wheel spin. All right, so this is for the first question. The correct answer is 3. How many legs, not including the underlying stock, comprise a seagull? Okay, and the correct answer is 3. So I think if you got that correct answer, you're in this wheel somewhere that I'm going to spin. And if you come up, Tim and Kayla will figure out how to get a hold of you and get all the details. But I'm going to spin the wheel. Here we go. This is fun. And the winner is Sigma Show, whoever that is. So I think if you just in the comments just say, hey, I'm here or something like that, and then they will find you afterwards to get you the goods. So make sure you put that in there. All right, I'm looking. Perfect. Okay. Oh, there it is. We have a winner, Mr. Carlos, I believe. So Kayla, you take care of that. Our next guest is a gentleman named Guy Cohen from Wise Traders. Guy is he's accomplished everything, I think. So he'll tell a little bit about it, but he's created this OVI system that I hope we hear a little bit about. Professional money managers use it. Self-directed traders can use it. He's written books. He teaches a lot of classes, so he's a real wealth of knowledge in the option space. So let me bring him in here. Guy, how are you? Can you hear me?
Hey Lex, all good?
Good to see you. I love the trading cave there. That looks awesome.
It's wallpaper. I gotta be honest. But it looks great.
I love it.
I don't want to get rumbled by having fake wallpaper, but it is. But they're very nice.
Okay, good. All right, I don't want to take up too much of your time because I want you to get going into your topic. Are you going to share a screen?
I am. How do I do that?
Just go ahead and share it. Share your screen before I leave. I'll do that, and then you can go to town, and we'll have some questions at the end. I'll just jump in as we're getting close to the end.
I'm hoping it's gonna give me the right one. Let's have a look. I think it's this one here. Let's have a look. How's that?
I'm gonna bring it in. Is that it?
There you go.
Okay. All right, you good to go? I'm gonna jump out and let you go to it. Okay.
Okay, and then you should see that. Does that come up on the screen? Does the scribbling come up on the screen or not?
No, probably not. So you might have to kind of make a note of where you're pointing. But
okay, I can see that my mouse, but you can't see my scribbles. That's. Oh yeah, there you go. Look at that. Okay. That was me.
Okay.
Oh,
all good.
I think so, but well, you guys will have to tell me if you see me scribble. I love to scribble on here. Thanks very much for the intro. Really appreciate it. Sure. I know that you guys are a particularly well-informed crowd, so I hope to help you here. Disclaimers, I think you can just read that. I'm not giving particular trade advice here, so I think if you just have a look at those yellow highlights, I think that'll do the trick from here as well. But you know the form, how it is these days. Okay, so here what we're talking about today is what we call the 3 master keys of trading. If you nail these 3, then you'll be well on your way. In terms of my background, yes, I've had blue chip clients. I licensed software to the NYSE for 9 years via Euronext. I've done some data analysis for the ISE. They're both owned by bigger and better entities now. And yes, I've written some best-selling books in options. There's Options Made Easy. I've just realized I can't actually show you that. I can't actually. Maybe I can do this instead. Maybe that's what I can do. There you go. I'll do this. Instead of scribbling, I will just highlight my mouse like that. But yeah, Options Made Easy, 3rd edition, multiple editions, multiple languages, and the Bible of Option Strategies have been well received, and they're bestsellers. But I also, as Lex was saying, I've also developed a patented piece of software, a patented indicator, which is the driver for all the stuff we do in fintech, but it's also the driver of our managed funds that we are also doing on the professional side. So what I have to say for you today, you probably aren't going to hear anywhere else. Now, there are a couple of secrets to becoming a better trader. It was very interesting hearing Créde just earlier. So if she's here, I want to just say, Hello, and thank you for that presentation because it was pretty cool. One thing I would add to that is that your psychology will be better if you are able to control your risk. And by that, I mean proper setups for the stock and proper also, which also means your right setup for the stock. I will show you what I mean by that, and you can choose whatever setup you want. But we have a particular way that we do it, which also means your trade management has got to be right in terms of your entry and your exits. And I'll show you a bit of that as we go along. Also, the frequency of the amount you trade. And also, if you're going to trade options as well, pick the right options. Now, where we come from, I am an options guy. But one thing I realized was that to be a great options trader, you really need to be a good stock trader too. They don't work in isolation. They work best if you conduct them together. And the way that we do things is we like to think of ourselves as lions and not headless chickens. You don't need to be chasing every trade. And there's an awful lot of what Créde said earlier that's really applicable with what we do and our style as well. And we're very definite about our style. We have one style and that's it. So the three master keys of trading are market timing, stock selection, and your trade plan, which is managing your risk. And we're going to start with market timing. Again, maybe these can be made available for you a bit later, but market timing, if you can get market timing right, imagine how much easier the game becomes. Now, I'm not going to go through each of these calls I make on my weekly reviews, but if you look at the direction of those arrows and those dates and what the market actually did, and the S&P specifically, we're pretty good. That was in the latter half of 2022, and then this is 2023 so far. As I just push out these animations, we've been pretty cool, pretty good on the right side, and of course that helps our members enormously, having I guess faith in a market direction call that's usually pretty good. So market timing, I don't know whether you can wave at me or anything, but maybe just give me a wave, whatever. If you agree that if you can get market timing at least not badly wrong, you're starting off on the right foot. So that's what we think is a very important thing. So market timing governs what we do a lot in terms of our discretionary trading and also our automated stuff as well. That moves on to the sexy part, which is stock selection. And that's what we're going to talk about mostly today. So it's the second master key, stock selection. And by this, what we do is we follow what we call big money footprints. We effectively follow big money. That's what our entire strategy is about: demand and supply and pricing in such a way that we are likely to be following what big money is doing. And that obviously has a big impact on price moving forward. And those master keys, so those big money footprints are, and I'm just going to whiz them out here: volume acceleration. I'll show you these in detail. Price acceleration, then cross and hold of key levels, then scarce information. This is where my patented stuff comes in. So that's really important. And there are two others as well. One is called shrinking retracements. I will talk to you about that. And also consolidations where appropriate. My main use of consolidations is actually for risk management, but there are times where it can be also a potential big money footprint. Now, let's talk about scarce information as well. Scarce information is the driving force behind, Coca-Cola's formula. No one else has got it. They make billions from it. KFC's secret recipe. No one else has got it. They make billions from it. Obviously, some good marketing going on in there as well. But if you think about the diamond dealer as well, diamond dealers don't lose money, do they? And they are trained in diamond school. Now, you and I, who might have to buy diamonds once in a while for our partners or whatever, we don't know that much. We kind of know a superficial level, but they're the ones making the markup because they've been to diamond school. They know about the cut, the clarity, the color, the carat, the source, all those things that build up the value of a diamond. So, scarce information in these areas is transformational. It's life-changing in that sense. And we want to be able to use that in our trading if we can as well. Big money footprint number one is the presence of big money. In other words, recent volume acceleration. So when the stock price is rising, I want to see big volume spikes. And when it's falling, which are green, obviously, and when it's falling, I want to see big red volume spikes. And the reason is that the idea we're thinking here is that as price is going up, as these volume spikes are happening, there might be accumulation going on. Now, that's not going to affect the share float, but it might do. And if it does, if people are accumulating, then de facto, there are fewer shares available to trade, even though there's no metric available that will say that. And if there are fewer shares to trade and more people are going to be buying those shares, then obviously that's going to put pressure on the price going up. And it's exactly the opposite on the way down. I won't explain it in full right now because I know we are under a time restriction. So if you look at a very boring stock like GE and you look at some volume spikes here, I've actually painted in the big money footprint here, you see that this one here, with some other things I'm going to show you, was the starting gun for a very decent rise in that stock, 83% in 5 months. And with deep in the money, well chosen, what I call smart leveraged options, as in not risky options, decent amount of time, good delta, over 70 deltas, you're getting 300% with options as well. Now I'm calling that smart leverage. We'll talk about that in a moment. Second big money footprint is aggression. What I want to see already is prices that are already rising, okay, before I even get in. Now, this jump here from 20 to 30 might seem like you've missed the boat, but often when that happens and then the stock goes sideways, that's just the beginning of the ride. And therefore, I like to see that. Now, one of the reasons I like to see that is because of these eyeballs. When you get a big jump in stock price, it's going to send alerts all over trading desks and hedge funds and etc. everywhere going, hey, what, are we in here enough? Why aren't we in here at all? Or whatever. And particularly if this happens after earnings. When this happens after earnings, it's a particularly powerful signal. Again, in the right circumstances. Eyeballs are on it, and lots of eyeballs have the potential, of course, to create lots more demand on the way up or lots more supply on the way down. So you see that everything we're looking at is looking to build a picture of supply and demand pressures that we can then jump on board and take advantage of. Now, this is ATAER. Big rise here. It was post earnings, by the way. Earnings was quite close by. Post earnings, big jump up, doubled, went sideways and doubled again. So, and this happens over and over again. You don't, and often the catalyst for the first move can be earnings on that one as well. The third big money footprint is a cross and hold of key levels. Now, key levels can be as simple as a 200-day moving average or a 50-day moving average, even the 20 in certain cases when the market's going rampant. And again, we're talking about eyeballs. Here's what happens. Paul Tudor Jones made this famous hedge fund manager. He famously said that he wouldn't buy a stock unless it was above its 200-day moving average. So very simple filter. Look for stocks that have recently crossed and remain crossed through their 200-day moving average. You know that there's going to be a bunch of eyeballs on it. Now, in the right circumstances, that could also be the beginnings of a move to the to the upside if it's gone up and to the downside if it's gone down. And you also know a little bonus here that when it's just crossed that 200-day, even the 50-day, it's not overbought either. So again, this can be the catalyst for a stronger move moving forward. So this was Sarepta last year, and it goes up through the 50-day moving average here. Just look where that third big money footprint is, goes sideways and goes up 49% in 7 weeks. And the options were significantly more than that if you use smart leverage. And even here's earnings, here's another bounce, and then it goes up again after earnings. So we've got those three big money footprints at play: volume acceleration, price surge, recent volume acceleration, recent price surge, and recent cross and hold of key levels. Now, there are a couple more to talk about here. One is scarce information I talked about earlier. What if you could add scarce information to your armory? Well, this is what scarce information can do. It can do some pretty amazing things. This was Goodricks. This was actually a short squeeze, 25% rise in 13 days. And scarce information played one of the parts in that. Now, in terms of scarce information, here's what we do that Lex was alluding to earlier on. Let's have a look. We use options transaction data to analyze stocks. And since we've been doing this, there's a whole bunch of copycats, but none of them have got what we got. Now, here's the situation. Elite investors can often use options to build large positions over time. So we're talking about building positions, not hedging, but building positions. But identifying that likely position building activity is very complex. It's very misunderstood, which is why that most attempts you see to use options transaction data just simply don't work, and there's no metrics behind them. But if you really could identify likely options position building activity, then by definition, you are using scarce information, and that will give you a potential edge. Now, how do we have our edge? Well, I developed this indicator called the Options Volatility Indicator, or OVI for short, and this uses options transaction data in such a way that is so unique that it actually holds a US patent. And you can look the patent up, 10803-522B2. It's got my name on it. And it's a really simple indicator. It goes up and down from -1 to +1, takes in a lot of data and spits it out in a very simplistic way. But the way also has the advantage that we can scan, we can filter, we can create trading systems from it, which we do, but we can also trade discretionary in a discretionary way as well. So by definition, the OVI is scarce information, and it has real empirical evidence, unlike any other options indicator out there, because they haven't tested them properly. So over the last 3 years, we have actually run a portfolio on the long side, and all this is doing is trying to beat the S&P. That's all it's meant to do. It's all it's designed to do. Now, we're the blue line, real money, and the red line is the S&P, the benchmark. And so far, right now, after pretty much exactly 3 years, it launched on the 18th of 18th of February 2020, right before COVID came. That was fun. In 3 years, we're beating the S&P by almost threefold. Real money. Now, if you then extend it to add the testing period as well, same parameters, then we're beating the S&P since 2005 by 11.5x, or 1,047%. So this has got real empirical substance to it as well. So of course, we're talking about 4 big money footprints, not 3. And when you look at GE and you look that the OVI has got in, and by the way, I have to say, for compliance reasons, we make no future earnings claims. You may lose money, etc., as you saw from the very beginning. But we use this, and we have this nice big fat OVI while General Electric is forming big money footprint number 1 with a volume acceleration, price acceleration, and the recent cross and hold of a key level, in this case being the 50-day moving average. And if you can see those 4 footprints, that makes it quite easy for you. So we've got those 4 big money footprints there. And the same thing was happening with ATER. The OVI starts getting busy right into that second move, and you see the other big money footprints present. Sarepta, this one, also big money footprints there, big volume, big move through the key level, and OVI into that next and bigger move as well. And this is the way we look at things. This is the way we do things. Now, there's a couple of other big money footprints to show you. I'll just do that animation again. Watch carefully on the screen. There you go. You see those arrows? These are what we call shrinking retracements. And we could even draw another arrow here. But you've got a big down move, followed by, not that long after, a lesser down move, and then followed by the 6th big money footprint, the consolidation. But if I just go back here, this second retracement here with the number 5 on the footprint there is a smaller retracement than the one before, which potentially, in the context of big money footprints, could be teeing us up for a change in direction. And of course, you get that third, if you like, retracement, which also happens to be, well, footprint number 6, which is the consolidation in that case. And then away we go. We've gone through the key levels. We've had a big move. We've got recent volume acceleration. You see all the big money footprints are there. Now, not always, you're not always going to get them there. Otherwise, you wouldn't be trading that much. But you see what we're looking to do. We're looking to build a picture where there's going to be pressure on supply and demand. Now, can it go the other way in terms of, can you have a red OVI? You absolutely can have a red OVI. And obviously, that then conforms to bearish type of setups. And this here with Roku a couple of years ago has the big money footprint stimulating a 50% move down in the stock. It halved in just 15 days with these big money footprints there with that 200-day moving average. Here's CRISPR, looking kind of nice. You can begin to see the big money footprints there already. Decent move up, crossing the hold of a key level, OVI, and a bit of volume as well. But also here you had the shrinking retracements as well that you can eyeball as well. We actually are unique in being able to find those as well, even if they're happening over different time periods. That was a 30% move. And then this was Leg Mason. Again, you've got the shrinking retracements. You can pretty much already see them. Well, you can certainly see them now, and the consolidation in there as well as the other big money footprints, which in this case led to a buyout which was 34% in 3 weeks. But obviously the options were like 130%. So here's good rooks again, and let's have a look at this one. Well, here they are, the shrinking retracements, in addition to the other big money footprints. Again, there you've got your big volume. Here you've got your big move. Here you've got your cross and hold. Here you've got your OVI. Here you've got your shrinking retracements. And you've also, even just for good measure, got a sideways consolidating move as well. And this was, even with this kind of stock, this was a short squeeze as well. So this is our philosophy. This is the way that we do things. This is our trade plan. This is what we need to do. Now, in theory, a lot of those things you could go and do manually, depending on your algorithmic capabilities. OVI accepting, of course, you couldn't do that. But again, what would happen, and that would be fine, because you could filter for stocks, you could filter for options, filter for the recent price acceleration, volume acceleration, hitter key levels, even consolidations, but not the other two. Then you would go about verifying the charts manually for shrinking retracements and flags and this and that. Then you'd select the stock. Then you'd look to select the options. Then you'd implement a trading plan. And by that time, you'd have spent quite a lot of time doing all that. So ideally, we would rather fast track that and automate. And that's what we can do. Automation changes the game. We can actually find the right stocks and the right options with smart leverage literally in a click. For example, if you found Vertex doing what you wanted it to be doing, you would then do a visual check on it, and you would then trade it as per my safe trade plan, which we've got to come to in just a minute. General Electric, that boring stock which went up 80-odd%. Again, if it appears in your watch list or filter search, again, you can verify by looking at the chart for the real finite quality of it, and then you can easily find the affordable options, because we have the ability to do that with our own technology, VIP options trade fund, finding smart leverage. And by that, I mean deep in the money, plenty of time, but cheap as well. And obviously there's a definition for cheap. And in this particular case, the move on General Electric was, pretty substantial again, and that you have a trade plan. Now, this is fairly hurried, and I know that we started a little bit late with this, and I just wanted to make sure that we got through the content, because I want to make sure people after me get a good shot and not delayed. But if you want to know a little bit more about what we do with stocks and options, because we do believe that to be a good options trader, you do need to be able to select stocks wisely and correctly as well, and use logic as well. So we use the logic of supply and demand and pricing. Go to ovi.to/report. I'm hoping that can get on your chat somehow. Maybe I'll just type it in, ovi.to/report. Get this, it's a free report. And what it is, specifically, you'll see our methodology in there, but you also see 5 stocks that I've highlighted recently that could be explosive, bullish and bearish, that is, as well. And you'll see a little bit more about our methodology as well. So go and get that. Maybe I can pop that into the comments here as well. Oh, I don't know whether I can, but maybe one of the Tradier people can do that for you as well. So ovi.to/report. This is what people say. So we have quants, independent ones and in-house ones as well. And they say, using institutional standards of financial modeling, OVI stands up to rigorous scrutiny as a valuable, logical, and robust indicator, highly valuable in predicting broad market sentiment. Guess what? Market timing at the very beginning, and identifying stocks that subsequently perform. Stock selection. So we've done market timing. We've done stock selection. This is a professional investor. He's got a lot. He had lost a lot. Then he'd retrieved it. And then he said, by just adapting to your methods, putting some basic controls in place has saved me millions in losses. In fact, 12 million was his actual number in that. Now, he's a professional. He's a big guy, but he uses our stuff. And people, more in the retail space, they say the OVI is by far the best program I've ever done so far. And I love the personal relationship with everyone. And we are very big on that. Talking of which, we have a team. There's me. I have a quant team. They kind of rest in the shadows. But I have a research team, real people who you can communicate with. And then we have mentors such as Glenn and Chloe. Chloe's one of our star traders. Then we have Jay and Paul in support and mentoring. And then we have Charlie and Michael. And we have comms, Narishma, Brandon, and Duncan. So we're real people. We actually care. And people realize that. And we have real people, obviously, as part of our family of members as well. Good people, fun people, nice people, ordinary people as well. well. And we become friends with those guys as well. That gives me just a little bit of time just to get into the last master key. We've done market timing, or shown you the benefit of that. We've shown you the big money footprints that define our approach to stock selection. And now we're going to the trade plan. And the trade plan, once I give this to you, I can't take it back, but it is insanely valuable. Now, the first thing that we look for is it's got to be evidence. There has to be a trading methodology that is logical, that is testable, because a lot of them aren't even testable that you see out there, and is proven, that has got some actual substance behind it, tested substance with hands off. So we have that. So evidence. Now, in our world, this is what that means. It means big money footprints. Again, recent volume acceleration, recent price acceleration, cross and hold of key levels, OVI, but also shrinking retracements and also consolidation as well. Now, you don't have to have all of them, but you do have to have OVI. OVI has to be part of your situation here. Then it's all about entry. What do you need from your entry? Once you've got your setup, which is based on evidence, the way you enter a trade is really all about establishing control, that you are in control from the get-go. So we like sideways movements and consolidations because we can define our entry and we can define our initial stop. It's really important. That way we are in control from the get-go. The second piece, though, is what if the stock goes into profit? Insanely enough, this is where most people have the problems. They don't know where to take profits, don't know where to protect profits. We have a mechanism to enable you to defend and protect a profit early. That doesn't mean you have to take all your profits early, but it means you're going to defend, you're going to protect your profits early. The best way of getting to first base, bring first base closer to you. Okay, you can still do more, as I'm about to show you. So we want to protect our profits early. Don't allow a decent profit to turn into a loss. And when you're using smart leverage, and I mean smart leverage with stocks with low implied vols, deep in the money, you can afford to take profits much earlier. Think about it. I can teach you all this. And then it's the question of what happens if it keeps on trending in your favor. If it does keep on trending in your favor, you've got to have a plan and a mechanism for that too. And we have this stair-stepping kind of methodology. As the stock goes in your favor, you raise your stop after that. And if it's just not doing very much, you just keep your stop in place. It's pretty straightforward, easy stuff. But enshrined in logic. Our method is enshrined in logic and a bit of magic as well. Not magical numbers, but magic in terms of the OVI and our algorithms behind it, but then logic all the way with our trade plan as well. Now, I think we've been able to, Lex, get you, I think I started about 5 minutes late. The gift I'm giving you is that you are back on track because I think my end time here was, 1:40 p.m. And or I think we have managed to do that for you. That's my little gift for you. But just to say also, because I know how these things go, just to say also, if someone can put it in the chat, ovi.to/report, and see if you like what we have to say, because our mantra is we make options easier than ever before and easier than everyone else, apart from Tradier, of course. But we find that Tradier people like us too, and Perfect. So you can learn a little bit more about us and what we do there.
Cool. Thanks so much, guy. That was awesome. So we have time for a question or two, right?
Yeah. Go for it.
So. Would people sign up and become educated through daily interaction with your team, you and your team?
So yeah, we have programs. So we have obviously course programs, but we believe in also a sort of a joined up basis. So you don't just learn through listening to me and watching slides and all that. You actually learn by doing. So we actually have a software application online, don't have to download anything, that enables you to find big money footprint stocks and the right options with it. And it depends on which strategy you want to do, but if you want to do bull puts or bear calls, we can do that. If you want to just do straightforward long calls, long deep in the money, if you want to step in and do leg-ins to diagonals and other things, we do all that too. So we can be as sophisticated as you want, but we also like to be as simple as you want. We like to leg into complexity, but we like to start with simplicity. But get stocks right, then you will hammer options. And we specialize by doing really more predictable type of stocks with low implied volatilities. So we use smart leverage rather than crazy leverage.
Right.
And that way you're buying cheap options, not cheap because they're out the money. They're deep in the money and they're cheap. And then you get better leverage multiple as a result on stocks that are not crazy stocks as well. So it means that Apple, when it behaves, is a really easy stock to trade. And if you're getting the leverage on Apple, you could be starting off with 4 or 5 times leverage multiple, which means you can afford to protect your profits early. And this is all a game about protecting your profits early, getting that little, that little check in the box. So we're not looking to be crazy. We're not looking to we don't have any fear of missing out on crazy stocks doing crazy things, because we can do really good things with very predictable movements.
Got it. Okay, let me pull in another question. I'm not sure this is super pertinent to you, but I'll put it in there anyway. So give me your quick thought on that one, if there is.
Absolutely. So trading index options, the good thing about index options through ETFs or otherwise, they have very low implied vol. And when they behave, you can get ridiculous. I mean, you do that. When the IWM, say, does something, sometimes it just is very easy. You could be literally out the gate with 7x leverage multiple on a really straightforward setup. So I'm happy with that. Obviously, you can do spreads on those. And obviously, the bid asks are very tight on them.
Yeah. Okay. Terrific. Well, Guy, thanks so much for all that. That was very interesting. I really love it. We did post some of those links in the comments, and we'll do that in the final too. So
thank you. Good to see you guys. I know you guys are a very educated crowd, and obviously we're enjoying getting to know you.
Okay, good. Well, thanks again, Guy, for coming.
Thanks.
Okay. All right. Thanks to Guy for giving us that presentation. That's Wise Traders. So they had that running across. Next is our roundtable. So a little bit different. We're going to have a group of guests. I'm going to bring them on in a second, and we're going to talk about automation and retail trading. Okay. Now, let me bring the guys out here, and we'll introduce them in a sec. Did I get everybody? I think I did. Oh, I did. All right, guys. All right, we're gonna go around the board. Don't panic. We're gonna go through it. You're each gonna have a chance to tell us who you are. But I just wanted to set up the topic. So again, it's automation retail trading, right? Now I know some of you might not be in that lane. I'm one of those people. So guess what? I'm gonna play the guy not in the lane in terms of automation retail trading. But I know some of you are in the lane. So look at. All we're looking for is a nice conversation about that, and you might have opinions that are negative to automation, which is okay. We want to hear those too, because then Kurt's going to jump all over you. I'm just kidding. You're not going to jump all over everybody. So
I've got both sides.
I love it. I love it. So that's what we're going to talk about. We got 40-ish minutes or so, and we'll get into it. Now, one note as well. What I did is, since it's automation, I used ChatGPT to come up with the questions. So I don't know if anyone knows what that is. I didn't know what this was until 2 weeks ago. But I typed in, give me whatever. I got 12 questions, I guess, on automation and retail trading. It's amazing some of the ones that came up. So we'll see how it goes. All good, guys? Any questions?
I love it.
Okay.
Well, good.
All right, let's start with Kirk. I'm going to start with you. You're beneath me on my screen. So I'm going to start with you, and I'm going to go around my board, which would be Ed next, Fausto, then Scott. And then we'll kind of snake back and forth as needed. Okay. And sorry, one more thing. Please, audience, give us questions in the comments. We, obviously we'd love to have that on the panel. So fire away, make it tough, make everyone squirm a little bit. So, make it hard on us. All right, Kirk, go ahead. Sorry.
No, you're good, man. First of all, I appreciate it. It's been awesome watching everyone and participating in these. So it's awesome. I can't wait to chat about auto trading, obviously. So I'm Kirk. I'm the co-founder and CEO of Option Alpha. We have an auto trading platform originally launched as just education, and now we support a lot of traders trying to do some auto trading or try to do some hybrid trading. So,
okay, thanks, Kirk. Ed, you want to go?
Sure. Thanks again for having me. My name is Ed Kaim. I am the founder over at Quantia. We've been in business for about 10 years or so. Started off as mostly trade discovery, but now we provide a platform for the full range of your investment life cycle. So we really focus on everything that it takes from idea inception all the way out through postmortem reviews of your trade history.
Okay, perfect. Thanks, Fausto. How are you? Wait a minute, Fausto. You're in beautiful Jacksonville or something like that.
Yeah, I'm here. You can probably see it. It looks beautiful, right? I actually Peter just left and did a nice presentation. You were supposed to be here, but I think we're gonna have you here in March.
Okay.
We're doing another event here.
I travel well like a bad sandwich, so I'll be there.
All right. Anyway, I'm outside. I'm actually outside in the open air because we're actually running an on-site seminar, and I got my instructors and students in there, so looking forward to be here. But thanks for having me. First of all, some of you don't know me. My name is Fausto Pugliese. I'm president, founder of Cyber Trading University. Been doing this about 30 years. One of the original day traders that started, and we train hundreds of thousands of traders around the world. Just love educating people, teaching people the art of trading, how it works, electronic trading, understanding algorithms, understanding how to follow big orders. I was a market maker myself, and now I just go around and kind of teach everyone how to do it on their own.
Great, thank you. And Scott, last but not least, Scott from Ghost Traders, all in the my upper left. Sorry, Scott, how are you?
Great. And nice to see you, Lex. Thanks for having me. Listen, we specialize at Ghost Trades News in something kind of unique. When people used to ask us, as we educated around the world, how do I follow your trades? We now use automation through auto trade. And so people follow our publishing of the trades. It's auto positioned and auto compounded. So some unique things that I think come with automation that we can talk about in the short time that we have today. Great to be here.
Great. Thank you, everyone. Okay, real quickly, my background in the auto trading space. Okay, so many may know this. I started on the trading floor. I know most of these people said, wait, there was actually a trading floor. There was. I was on it. We did not do auto trading. Okay, so that came much later in my career, and we did evolve into that. So I do have a little background in auto trading. I'll tell a story later about it after a couple times around, but pretty interesting. Anyhow, so I do have a little bit of that going in my world. All right, let's start with this. From Chat GPT, number one, I'm going to start, Scott, with you, if that's okay.
Sure.
Okay. So in your opinion, benefits and drawbacks of relying, on an auto trading system, and it can be heavily relying or lightly relying, and what sort of things can be the benefits and the drawbacks in your opinion from something like that?
Yeah, we found the benefits were immediately it was effortless to investors. When we used to be able to post our trades and they were published, people would say, listen, I was in a school event for my kids or at a doctor's appointment. Can you repost the trades? And the market's moved, so that's not possible. So the fact that automation allows trades to be executed immediately now, pretty much immediately, has been great for our subscribers. And while we thought it might apply to only people that didn't know how to trade, we quickly found that people that do know how to trade recognize the effort put in. So they love the ability to have at least a portion of their portfolio following the trades, and they don't really have to do anything but open their account with the Tradier and take a look at their positions.
Mm-hmm. Okay, great. Fausto, I'll move to you. I'm going to go around that way. Benefits, drawbacks?
Yeah, no problem. So,
yep.
Well, obviously, it depends what kind of trader you are. So, like me being a day trader / a little bit of a swing trader, automation trading is really not, my in that, because we're sitting there watching the stocks trading. That you're not going to be that type of person that's going to be there and watch it closely. Then it might be something benefiting you. But for me, we're pretty much there all the time. I mean, we kind of more focus on following those orders. So there are these things that we kind of focus a little bit more that on the automated side, like on the algorithm side or all the program trading. But other than that, depending on what trader you are, I mean, like some people do like that automation system. For me, like I said, it doesn't work when it comes to actually day trading because you're there all day long. But like I told you, it's important that everyone tries a little bit of everything and you find out what works best for you.
Mm-hmm. Okay, great. And Ed, I think you might be on mute. I'm not sure, but
yep.
There you are. You're off now. So Ed, I know you're Quantia isn't necessarily in the auto trading space per se.
That's right. We're not auto trading, but we are we're huge fans of automation, though. So we subscribe to an investment discipline called InvestOps that we worked on with our customer base over the years, and it's all about applying a formal process to your trading approach. And this isn't specific to any kind of system of trading or whatever. It's just basically formalizing the idea of generating a view, planning a trade, entering trade, monitoring positions, adjusting them, cycling through that over and over again, and then finally ending up in a review phase where you're able to see how you performed and understand what happened. There's tons of automation throughout that process and opportunities for it. The place we kind of come up short is when it comes to specifically placing trades. We don't believe in kind of automating the process of placing trades. And I understand when the trades are being placed to follow someone else's trades, like that makes total sense. But I don't, I've never been a fan of it because, frankly, one of the big concepts behind automated trading that we've never really been able to crack is backtesting. Because I know that backtesting goes hand in hand with automated trading. And in our experience, whenever we've tried to productize something related to backtesting, we found that it didn't really help customers. It didn't put them in a position to be able to say, well, hey, this bullish strategy worked great up until about November of 2021. And then all the customers went bankrupt in the last year. So it's just one of those things where we will always, I can't imagine philosophically that we'll ever be supporters of automated trading, but automated investing, there's a huge aspect to that and everything else that goes into it that we are definitely fans of, because computers are great at watching the market for you. They're great at letting you know when certain signals hit. They're great at letting you know when your book is out of balance on delta or when your trade reaches a great profit potential. But of course, when you're trading options, you don't want to just throw out a market order to sell or to close because of the nature of liquidity and other things that are important for options trading. So I just want to clarify that we're definitely huge fans of automation, and it's been baked into the products for a very long time. It's just specifically, we have the firm belief that it should be a person. If it's your strategy, you should be the person that's actually placing that trade.
Okay. Love it. I think I have to move Fausto back in. I'm not sure.
He's changing locations.
He's changing locations. He's having a bad feed problem.
He did not like my opinion there.
He's
Moving indoors.
He's like, I'm out.
I'm sorry about that, but my get too far away from there.
All right, you're good. Okay, Kirk, now you switched on me. Now I've got to go think backwards now. So, Kirk, you're going to be Mr. Automation, I think. So what do you think about this one? Benefits?
I think on both sides. No, I appreciate it. Just to be clear on our side. So our platform is an auto trading platform where users, like traders, they're building their own bots. You can run your own automated strategies. You can do hybrid. So you could manually trade and then hybrid close, like auto close, like set your exits and then auto close. So I'm very much a believer, and I agree with Ed, that traders should be trading what they want, and you should specify that. I think, to get back to your question from ChatGPT, which I think was really kind of an interesting thing to do. I think the best and worst parts about auto trading is summarized around the trading plan and the unemotional side of it. So the best parts of auto trading to me are actually building a plan, having a plan that you have to start relying on, right? If you say you have a profit target and it hits your profit target, getting out, right? I think that having liquidity filters. I mean, I can't tell you how many people now start using liquidity filters and checking for open interest or anything else, right? So having a plan, I think, is great. It keeps you honest. It keeps you, straight up with your trading. I think that sometimes is a struggle for people to build a plan. And I think the downside to auto trading is you don't have that nuance. There's only so much that you can program, for lack of a better word, into a bot or a trading system. But all of the little edge case nuances that, probably you guys have learned over the years as traders yourselves, those types of things where it's well, yeah, I should probably get out of this position, or yeah, I should probably get, into this position, but there's no exact box that thing has fit into. So I think there's good things about auto trading and automation. And I think there's things that, rip people apart for sure. They get too complicated, they go down too many paths and they don't end up doing anything. So I'm definitely, I try to be middle of the road for it, for sure.
Okay, great. Believe it or not, the Chat GPT came up with this question. Okay, are you ready? 0 DTE trading. Is automation better for 0 DTE or worse? and why. So I can't believe it came up with that one. I couldn't even think of a new zero DT.
It's starting to trade. That's why they're all starting to trade.
Yeah, that's right. Fausto, you want to tackle that one? Zero DT, 0 days to expiration. So I'll start with you if that's okay.
Regarding about the automation?
Yeah, and from my perspective, listen, I was a market maker, right? So I'll tee it up a little bit. We would hate to trade 0 DT, okay, as a market maker. No chance. We don't want any part of that because our gamma exposure was too high and we're always hedged, right? So I didn't want any part of having to trade something that's binary in terms of movement ever. I wanted to be hedged, from my perspective. Now, maybe the bot or the automation piece can handle that bad emotion with a 0 DT. So that's what I think that's where the machine's going with this one, right? Does that make sense, Fausto?
No, it does. And what happened with me, I was a market maker on the NASDAQ. So we always had people always came out with these platforms and try to have these bots. And eventually they worked for about 2-3 days. But I hate dealing with them after a while because eventually there are programs out there that will find those bots and figure out how to do the opposite. So that's why I kind of don't like playing with that stuff. I always have I have brokerage firms and trading firms hey, I got this new guy that came out with this new algorithm, this new bot that's going to basically do for me. And he's like, it's great, it works great, but it's going to last about maybe 3 days. And then what happens, believe it or not, there are platforms out there that actually go out there and find those bots and will actually eventually learn it and then do the opposite and ends up costing you more. So that's why I kind of don't mess around with it.
Okay, got it. Scott, what do you think? 0 DT and automation, is it part of your wheelhouse with your gang?
I'm glad you asked that way because for what we do, Lex, it's really not. We typically are just trading the three main indexes of the SPY, Qs, and IWM, and it's usually a 2 to 4 day trade. So unless the person obviously is available in their account to be able to day trade, the 0 DTE would probably cut out a lot of the people that we have subscribers. So there's no limit to the amount of people have in their account unless they start to go 0 DTE, and that limits what they could do over a period of time. So it really doesn't apply to what we do.
Okay, good. Ed, any thoughts on the 0 DTE thing, whether it's automation or not?
Sure. I tend to avoid 0 DTE as a general rule, just because it feels like something that is more on a day trading side. And I typically, when people ask, I just, I tell them that when you have liquidity and options the way it is, even the best case scenario, you're still losing a little bit on every trade. And so unless you're going to just make a big bet one day and you're going to say, hey, I think that there's going to be a squeeze here from the 0 DTE, then I could totally see, taking a flyer and going after it. But I would worry about more automated trading there, just because the idea of automated trading always tells me, especially for something in such a small, finely tuned scope where you could physically be there, the advantage to that would probably be for more of a high frequency scenario, or at least an increased frequency over what you might do individually. And just, I would not want to add more volume to my book on a day like that, just when you're dealing with a little bit of loss on every trade. So again, no, I'm not an expert in that space, but just given the nature of those kinds of, that kind of trading, I would tend to just avoid it unless I specifically wanted to place a bet.
Got it. Okay.
But Lex, let me just add something in there. I forgot to also mention, sorry to cut you off, but we actually look at all that automation that's going on. There's all these algorithms that you guys seen. We focus on something that's called level 4, and you could see all those orders out there, and you could see them spinning it out there and placing it. But to build an algorithm, try to be part of something, it's a totally different. You're in a different world that you don't want to get involved. But seeing those orders, they actually, and like you guys mentioned, I'm a day trader, so yeah, we actually do focus on that because that's what drives these stocks up the way they do, because you're going to get these short squeezes that are going to come in. You're going to get, all these iceberg orders are going to come in. All program trading starts coming in, which you all know, Lex, you've done it being a market maker. It's when they come out at certain times of the day because the orders have to get filled. So, like I said, it all depends what kind of trader you are, but you should see how they actually work. And it's pretty cool when you see it on level 4, how it actually runs. But as for you personally to kind of get involved in that, it's not really recommended.
Okay. Kirk, how does your stuff work with the 0 DTs? Do you guys you see a particular strategy if people are trying to capitalize on those or no?
Yeah, a lot of traders. There's a big following of 0 DTE. I think it's it's a popular thing just in trading generally. So like personally, I don't trade 0DT. I'm more of a position trader myself, but that's just my conservative nature. But I think there's obviously some interest in people wanting to try and have some sort of aspect around 0DT or even like the 0 to 2 days now with a lot of the daily expirations and some of the bigger products. And I think it's interesting. I think it's, something that we definitely see people, kind of come in and out of, and I hope they don't put their whole portfolio in there, obviously, but we're just, we want to facilitate them and do what they, want to do trading wise. I think a lot of people, when they set up a bot or set up a strategy around it, they're trying to look for something that's range bound within a certain time early in the day, and then try to, grab a position and scalp a profit. That's usually what we see people try to do all the time. And I don't know if that's I don't know if you can, write checks to the bank all day and, pay your bills that way, but I know it's a popular strategy for, traders right now. And I think the growing presence of daily expirations, if they continue to grow and expand, I think we'll see more of those laddered entries out over time.
Okay. So what about how this automation evolves? So we're kind of, for retail trading, I think we're starting to see it more and more, right? And I learned something about retail trading that I didn't really think I knew until all this automation came about. But how is this going to evolve, do you think, for the retail trader? Right now we've got a set of tools. Do you see it growing in any peculiar way going forward, or maybe not so peculiar? Maybe the answer is it's going to keep going like it is. I don't know. So Ed, let me start with you on this one. How does automation in retail trading, how does it evolve into what's the next phase of this, if there is one?
Well, I think if it works, it kind of ends retail trading.
Uh-oh.
I mean, realistically, if someone comes up with a strategy that's automated and it works, I mean, I don't see them selling it to people. I mean, why would they, if they can just make money reliably on their own? Like, that's the unspoken reality of like any kind of like people you follow in on the newsletter front of things. And it definitely makes sense. There's a lot of people out there that give advice and they help you trade, but the whole notion of people selling you something for a few $100s when they could theoretically make an unlimited amount of profit on their own, it's going to be like this. Automated trading is kind of the new newsletter thing where, there's cases for it and there's people that'll work for a while and things that'll happen. But in my opinion, like if it does end up being that super successful, it kind of becomes what ChatGPT might end up being to things like Google search, where sort of what's the need for the middleman or the person at the end there. You just maybe you plow your money into some robo advisors or something like that and just hope for the best, or you just buy spiders and go home. So that's just my personal opinion on it. I mean, maybe things will change where some individual retail investor will find some edge that the market doesn't immediately identify with its millions of bots out there looking for things like that. But I just coming from tech, like I don't see that being the case. I think if it's going to happen, it's not going to be good for retail trading.
Makes sense. Scott, any thoughts on that? The future of automation and retail trading?
Yeah, I think our biggest concern, Lex, would be the lack of emotion that brings about. And so people get so used to the comfort level of having things executed on their own. They might start with us, let's say somewhere around 10 contracts in a trade in their account. And with the automated process and auto compounding, they're now up to 10, 20, 30 contracts. And we have to remind them sometimes saying, listen, as your account grows, it is automated that it's compounding in a good way. But, if you take any losses, it's compounding against you as well. So we help people understand it's important to maybe take some money out and distribute it further in your portfolio from time to time. So I'm always concerned the more automated it gets, the less emotion people just sit back and say, oh, everything's done for me. I really don't have to take a look at it anymore. And that's always a concern for us.
Makes sense. Kirk, what do you think the future for this thing?
Yeah, I think so. We wrote a piece when we first launched at least our platform, which I think it's important to differentiate. I think even in our conversation, there's like auto trading in its like the sense that people have now, which is like following a newsletter-ish type thing or, something like that, which maybe there's a place for it. Maybe there's not. I don't know. I'm not going to judge. Right. But then there's like having tools available that traders can use to automate certain parts of their strategies. Right. And so that type of thing I think is obviously here, and I think it's growing. We're obviously big fans of it. So, like I think that having tools as a trader, whether you use them or not, if they're at your disposal and they help you as a trader, that's good, right? Mm-hmm. We wrote a piece before called, it was right when we launched, but we said automated doesn't mean unattended. And I've always come back to that because I think that there is a point to Scott's point that he just made where people get really comfortable and complacent. I think you even see this in index funds with a lot of ETFs where it's just buy and hold for whatever, at whatever price. The index will buy everything, whatever the PE is. I mean, you see this like trickle down through even the largest funds, right? And I think there's a point which people have to continuously review their strategies. And so, yes, automation can definitely help, I think, right? Is it everything? No, like I said, but it certainly doesn't mean you should be unattended and you should be blind and just be like, okay, it's going to take care. That's never a good trading strategy, no matter who you are. So I think there is always concern that people put too much faith into something and don't even double check their systems, don't even double check what they're doing or their logic. I think that's always the concern for sure.
Yeah, Fausto, you might have jumped out for a second there, but the question was, how does this automation kind of evolve into the future? In your opinion, do you see any massive?
Well, for us, I would probably.
Yep. Go ahead. Sorry.
For me,
you may be having a connection issue. Fausto, you might be having a hotel Wi-Fi issue. Okay, I'll let him figure that out. Sorry. Yeah, so you guys all made good points on that. So the automation that I experienced was almost like flying an airplane. And I always use this example to folks is that a modern day airline can land and take off by itself, but there's still a pilot in the cockpit, right? Mm-hmm. So our system did exactly that. It landed, it took off, it did everything in between. Was it always profitable? No. Was it mostly profitable? Yes. But it was a workflow issue. And Kirk, I think you mentioned workflow. It enabled us to do so many more things at once versus the human element of buying and selling options on a trading floor, for instance. That was very difficult, right? So it exposed us to way more what we thought was opportunity by automating the process. And that's why we did it, because the markets became very efficient. The edge to what we did was way different. So we needed to find a new way to kind of conquer edge. And that was the answer, was to automate the workflow so that we could take advantage in many different places, what we thought was edge. I don't know if that made any sense or not, but that's what we did.
Yeah, I think everyone's chasing edge. Yeah, I think it shifts over time for sure. I mean, I think Ed said this, like all those edges that people get, maybe even 0DT was an edge for a while and maybe that's going away, or something new will come up for a little bit until that gets extrapolated and then that goes away. And I think that's, I personally, I think the tough part about being a trader is you have to learn so much. There's so much nuance, there's so much terminology. And then you feel like you get it and you have a system or a thing or a plan or whatever, and then it changes and the whole market, is new, right? And COVID happens and this happens and, volatility explodes and then it collapses. And it's like you have to reinvent yourself so many times. Mm-hmm. I feel like having, what automation maybe can do for traders is help make that reinvention process not so painful. Because I know I speak to a lot of traders who are like, I just don't even have the time to watch my positions. Mm-hmm. I don't physically have the time to watch them. Right. And that's an issue. And if you don't have the time to watch your positions physically, well, what is the better alternative? Just not watch them, not do it. I think there's got to be something that's better than doing nothing. So
yeah, no, I think that's a good point. Yeah. That's exactly right. I think what I've learned too, moving to the retail side of the equation is most people who trade actively in the retail side have a real job. And I'm not saying trading is not a real job, but they have another job, mm-hmm. and they get pulled away from managing their risk, frequently. So the automation piece seems like it really enhances their ability to mitigate risk in a lot of places. Scott, you seen any of that with the with your program? People who have they've got a day job and they're doing other things. And that you've provided a great tool to help them out.
Yeah, that's kind of how we have evolved because of that very thing. Again, we really try to help people understand that this is just set it and forget it. It should be just a small portion of their overall portfolio. But they love the fact that they don't have to sit in front of the computer. We're basically doing that for them. And since everything that we do is risk defined, we help them understand, the risk before any kind of trade goes in. So it's important, I think, for all of us that work with automation to remind our subscribers or our viewers, however we're presenting information, that they have to stay engaged with their portfolios along the way, because it's so easy, as we've already talked about, to just have that set it and forget it mentality. And now that people can do automation in Roth IRAs and regular IRAs as well, custodial accounts, and not just margin accounts, and they take on a whole new level of risk that sometimes they don't understand. So as long as I think we need to continue to be educators as a collective group to help people understand that this should never be set it and forget it, despite how great automation might seem at times. Right.
No, those are all good points. Ed, any thoughts on this topic with the entry exit kind of thing and the workflow part of it, meaning you kind of can manage entries exits much better perhaps if you have a second job you're working on?
Yeah, I mean, the workflow part of it is really where we focus, is basically on the discipline of the entire process of investing. And so the approach that we've always kind of taken is not so much that people open a position and then exit a position. It's more that you open a position based on a view, but that you're going to be managing that position over a long period of time. Generally, like, for example, you might open up a delta neutral position with a condor, and then you're going to roll legs and you're going to add in new positions, and you're going to see the skew change a little bit and sell some premium here and do things like that. And so that's sort of where we've always focused on that. And the necessity as part of that is an alerting system. So, an alert system that lets you know, hey, you're outside your delta range, or your gamma is getting kind of high on this side, or those sorts of alerts that are incredibly flexible. So you can define the exact positions that you want to be alerted about. You can define the properties, things like that, because you're doing your day job, which is what a lot of people have is in retail trading. And you just want that alert that says, hey, heads up, you just got outside your delta range for your book on XYZ. And this way they can go in, take 5 minutes off as a break, and look at where they're trading or however long they need to find the positions they need to adjust that book. And for us, it's not really about the exiting. It really is very much about rolling and managing, because in our experience, the majority of volume that comes through our platform really seems to be people who are managing positions over a long period of time, and where they learn to pretty much farm for a premium, or they learn to take advantage of low vol situations. So I believe the automation is really valuable up until the point where that specific trade is being selected and placed, because like I said, we've all looked back at our trade history and said, oh, that trade was a bad idea. What was I thinking? And the great thing about automation is it takes the burden off your shoulders, because you can say, oh, that's right, I wasn't thinking. I made a rule 4 months ago, and then it just triggered. And so that's the kind of thing we're trying to help people kind of get all the advantage of automation up until the point where they're going to, pull the trigger, so to speak, in order to make the actual decision that's going to change the trajectory of what their portfolio is doing.
Right. Yeah, all good points. Thank you. Fausto, what about the alert mechanism in terms of you? It seems like you like to have a hands-on approach to it, not so automated as some of the others, potentially, but maybe having an automated alerting system to let you know about certain, pain points or entry levels that now you can go assess, as the human in the room, let's say.
Well, what's nice about being human is that if you surround yourself with other people that are good traders around you, they'll look out for you also. So like we run a professional trading room. So like if anything happens or you're in a position, it's nice. We'll send an alert, whatever it is. But like in our type of trading, like if you're not going to be there, you shouldn't be in the position in the first place, because it's that kind of type of trading. It's not about, if you're a swing trader or you're an options trader, obviously you're not looking at, the early mornings or late afternoons. That's really what day trading is all about. So it depends on what your style is. And like you said earlier, trading is not a full-time job. Most people do have a second job. I definitely don't like to teach people that only have one job, and that's trading, because then they feel desperate, and it takes time to learn how to trade. But the most important thing that we kind of work with is if you surround yourself with good traders, you surround yourself with good people, and you know this, Lex, because you are a trader on the floor. You want to hang out with people that know what they're doing, and they're going to look out for you. I mean, you don't want someone that's going to, screw you over and not do the right thing by you. And it's all that's kind of trading is, and that's on the equity side, and that's basically what I'm doing on the equity side. But on the option side, I mean, you could have that. You could have the order, the limited orders out there, placing them out there. You could do that. But on the equity side, if you're not going to be there, you shouldn't be in the position in the first place.
Yeah, good points. Okay, let's talk about. We have just a little bit of time left. Let's talk about emotions. The reason I'm bringing emotions up because the Chat GPT did. That's not true. It did do that, but I'm going to bring it up too because one of the things that we found in our trading business, and we taught a lot of traders, again, back to the manual era, right, was that what defined a great trader was the ability to control that emotion, okay? And what made a bad trader was someone who was overwhelmingly just a prisoner to emotion, right? And we had both sides of it. We had the ones who were outstanding and the ones who were not outstanding. And it always centered, we thought, on the ability to control that emotion, okay? So I guess my question is automation probably controls emotion a great bit, but what are your thoughts around that part of it? Ed, I'll start with you. Emotion and automation, it seems like it goes hand in hand. An easy one maybe, but maybe there's something I'm not thinking about that automation can solve, or maybe it hurts. I'm not sure.
I mean, yeah, there's a good point there. I mean, if your entries and exits are being automated, then your opinions don't really matter too much, right? It's kind of at that point how you feel about a given position doesn't necessarily impact how you're going to feel like holding on to something. So you don't, you want to. The classic example is when you're down on a trade and you don't want to exit because of the sunk cost fallacy. But I think that this also becomes kind of a reverse thing where I think emotion sometimes gets confused with what I guess I'll call common sense here, which is like sometimes you'll see a stock, it's at 100, let's say. And the advice you'll get will be, okay, if this ever drops below 80, it's a definite buy. But the thing people kind of forget is you're making that decision today. By the time it drops below 80, the circumstances have probably changed pretty drastically. And the reason you wanted to buy it when it was at 100 may not be the same thing they are now. And so making that decision by putting in the buy order today at the limit of 80, that could be one of those things that seems like a great idea right now, but you do want that in the moment decision and then that common sense to come through to say, like, this may not be the right thing to do at the moment. And that's one of the things I worry about with specifically the order placement. I love everything else about the automation process up until when you're actually making that final decision. Like, I think you need two people to turn their keys at the same time in order to enter or exit that trade, just to be sure that you have the right process. But once you've made a decision that you're going to exit a position, for example, then automation can be a great tool to ensure that you actually do get out of it. But I just don't think that you necessarily want to make the decision about when to exit way before the circumstances of that exit actually come to light.
Great. Yep. Good points. I was the best exiter of all time. I said I should exit now, and I just doubled up. I always got in more. I was like, yeah. I need a machine to do this for me. Terrible. Kirk, what do you think about the motion part of this and the automation piece?
Yeah, no, I think valid points across the board. I think there's a misconception that automation removes all emotion, and you can't do that. Like, it's impossible to do that. And so I think what you said about just managing your emotions better is probably the better, North Star metric for people to follow. I think there's a world where, and we see it, I do it myself, where you do hybrid trading. Like, it doesn't have to be fully automated. And to Ed's point, if there's something you want to set up where it just needs to alert you to a potential opportunity that you investigate more, like, set that up and then, choose what you want to do or not. But I think the emotion side is definitely a challenge for people. What we see people do now, and I don't know if this would probably be the same for all eternity of all automation, is now they blame their automation thing, right? Their own strategy that they set up. They're like, the automation didn't do it. I'm like, well, that's like your automation that you set up. So like your thing did exactly what it said. So I think there's this ability now for people to offload their emotions, good, better, and different, to technology. And that's dangerous because then I think that puts them in a box where they're now fighting against technology versus understanding that the hammer didn't hit you on the head, like you swung the hammer and hit yourself on the head. Like that's how I see people doing it. They're blaming the hammer for hitting their own hand, but they're the ones swinging the hammer. So I think that's a new emotional paradigm that we all have to start to navigate as we move forward. So.
Yeah, great. Scott, any further thoughts on this one?
Similar to a lot of things we've talked about, but we've told people for years that there's nothing more emotional in life outside of your family than the almighty dollar, right? And if you don't have rules, I think the whole panel would agree. And trying to connect with everybody that's listening today, you have to be systematic and unemotional in your trading. Automation allows that. If you back tasted and your rules follow, it doesn't mean you're going to make money on every single trade, but being a rules follower helps eliminate the emotion, and automation, goes a long way to helping people there, at least for part of their portfolios.
Right. Okay, good. All right, let me take one more here, and we're going to have to go to another contest, I think. What sort of tools are out there for, that retail traders can grab onto in terms of, this automation process, let's say? Is it all technical kind of trading, MACDs and that sort of stuff, or is it a host of things? Kurt, you might be involved with the most, so I'll start with you, I think.
I don't want to spend our whole time here plugging Option Alpha, but I would say that any tool for me and traders that can try to tackle it from whatever angle the trader needs help with. So I think it's pretty natural for people to have alerts and tools and scans and things. Even platforms can do that. They can most places you can have a technical alert or this or that.
Sure.
I think when it comes to tools that help you evaluate position size, liquidity, things like that, kind of those more specific cases to a trader before they get into positions or even as they're evaluating it, I think those tools are more helpful. So obviously we put a lot of focus on things in that, nature, like, how checking to see if you have enough capital, checking to see if it's a certain percentage of your net liquidity. Like those tools I think are very helpful. So I'm a fan of those. So.
Okay, good. Thanks. Fausto, any tools that would be great in your world for managing exposure?
A couple of things. First of all, I wish I could answer the question you asked before about the psychology part about it. Because,
go ahead. Throw your answer in there while you're at it.
Because what's so funny? That happened to us this morning when we were trading, here in our onsite. We had actually funny you guys bring it up. We were trading AI. And the thing I always understand is that one thing that I learned, the students being here, like when you trade with other people, like when you're online, you don't really know the expression or how you should act or how the person that really is a good trader takes personal. Like me, everyone's like, wow, Fausto, you're so calm. Like you're not freaking out. And you can't take things personal. If you take things personal and you try to get even and you're going to trade it again, you're going to end up blowing up your account. And that's one of the big issues everyone has to understand, that, all this automation stuff, you at the end of the day, you have to hit the button and you got to know how to get in out of the stock. You know how to get out of the stock. If you can't do that, trading is not for you. So don't always think that this automation stuff is always going to work out for you. And getting back to you, the tools that what you kind of using, like for us specifically, when it comes to as a day trader or an equity trader, like I do a lot of presentations for NASDAQ. And NASDAQ wants you to know how to trade the market. So you got to know how to trade on their book viewer. Some people don't even know what that is. You need to know how to read the level 3. You need to know how to, we used to trade, and you probably remember, you used to trade on an internet machine back in the day. People don't even know what that, you can get that. And we used to pay $1 million after you see an exchange. Now you get it for like $15-20. I'm like, really? Yeah. And it's just, those are the kind of automations that you want to see that are out there. But I did a whole presentation. I think you can always see those things how we do it. But those are really the tools that we focus on. Like if you're a beginner and you want to equity, start out with the NASDAQ book viewer. It's $15. You basically have a seat on the floor. You get to see all your orders out there. You've got level 4 out there too. But the key is here, is what everyone mentioned, the emotions. If you can't, they say, if you can't take the heat, get out of the kitchen. Trading that, you can't get emotional. If you get personal, you're going to double down. You're going to, like you said earlier, I'm just buying more shit. You can't do that because you're blowing up your account. And the whole idea is we're not trying to make money in trading. We're just trying to survive. The winners come later. It's you just got to survive, and that makes it a great career.
Okay, good. Thank you, Scott. What about you? Is it any tools that are more valuable than others in the automation piece?
Well, I think this is going to be captured with the word information, Lex. I mean, one thing that is not captured as part of automation is information and news. For instance, we exited our trades this morning and chose not to trade through the Fed speaking today, which looks like it affected things very much. But if people would focus on two things with their automation, and that's news-driven events and certainly controlling their risk, managing their risk, those are the two things that really have to be applied with automation to make sure you have the best opportunity to make money on a consistent basis.
Mm-hmm. Great. Thanks for that, Scott. Ed, I'll end with you here, if that's okay. Mr. Non-automation. I'm ending with you.
Oh no, like I said, we're huge advocates of automation. It's just specifically the trading. That's the only place where we don't go on it. As Scott mentioned, newsworthy events and risk management are two really big places for automation, especially around alerting. The third one that comes up a lot is exit conditions, and so just people saying like I hit a profit target or my book's at a certain location and I just want to close it, or I want to basically that endpoint thing. That's a big third one that we get a lot of requests for and people need help implementing. But I mean, I think that the whole process of automation, there's so many opportunities for it throughout the investment life cycle. So it really just comes down to kind of picking and choosing the places where you want things done for you. Like a lot of people will watch, a business channel of some kind in order to get their news, to see what the views are in order to go into place trades. And maybe they're a little bit behind by the time they get that news, but that's the process of them receiving something, right? Whether it's through news channels, whether it's through email alerts, whether it's through newsletters or whatever it is, however you get your idea for a trade, as soon as you're getting into that position, a lot of it has to do with you managing it personally. And then all the things that you care about, whether it's interest rates decisions or decisions around upcoming earnings, dividends, all the things that options investors care about. And so anything you have to get you that information in a faster and more efficient way is automation that's going to help you be more successful, in my opinion.
Great. Good. Thanks for that. Okay. Well, I see we're at the number, the magic number. Thanks, folks, for coming on the panel. Really interesting. Really appreciate it. I think Chat GPT did okay. We'll review it again. So that was fun. I really appreciate your insights and your participating in this. So
thanks, Lex. Appreciate it.
Have a great day, and thanks again.
Thanks. Good luck.
Thanks for having us.
All right.
Keep learning. Keep learning.
Thank you. Okay, now I think we have another break. So I am supposed to ask a question so that you can win. So here's what we're going to do. If I buy a long call and I sell the same strike put, equal numbers, same expiration, what strategy is that called? I'll accept a couple answers. So, and that if those who get into the spin could win $500 deposit into your Tradier brokerage account and a Nikki C's clothing shirt. So give me your answer in your comments. It's buying a long call, selling the same strike put, same expiration, same number, all quantities are the same, in the same expiration. What is that? Long call, short put, same expiration. What is that called? So we'll get that in there. And I guess, Kayla, I'm supposed to go on break now. So let me make sure. Bubba, you can't answer either. I see you over there. All right. So we're going to take a little break here and we're going to come back for Bubba. So give us about, I won't use the whole 10 minutes. So it'll probably be about 7, even though I'm going to put the 10-minute timer on. All right, back in action here. We have coming up next. Actually, we're going to spin the wheel is what we're going to do. So had a lot of good answers, a lot of right answers, some not so right, but it's okay. It's okay. I think our next guest is going to set us straight on this one. So let me do this. Hang on. I hope I'm sharing a screen. Yes, I am. Ready for the spin. Here it goes. $500 into your Tradier brokerage account and a Nikki C's clothing shirt. Here it goes. Love the wheel. Peter shoots. Kayla and Tim will take care of that for you. Peter, don't worry. Congratulations. Thank you for playing and getting the right answer. Perfect. Okay. Let's move along. Our next guest, he's famous. I'm telling you right now. I know he's famous. Mr. Bubba Horwitz, my Vegas friend. He is going to talk about the phases of something. I'm going to bring him on and have him tell us that too. Bubba, welcome. Hi. What's going on, partner?
What's up, buddy? I see you changed for the next my segment, so that's good. I'm happy to see.
I put a little crypto. I put a little Tradier crypto on here for you. Just
you got rid of the sport jacket. You got a sweater on now.
I got a sweater on now. I know you like Mr. Casual, so I want to go a little casual for you.
You know, well, listen, it's all good. What's going on?
Not much. How you doing?
I'm doing great. I'm doing
good.
Great event.
Thank you.
Enjoyed the last segment. And just one thing I will add into that: trade the news, you lose. That's what I tell you.
I love it. You are right. You are right.
Because the news is old, baby.
The news is old. That's for sure. Are you ready to fly? I'm gonna, God.
I'm ready. I was ready about 3 days ago. I'm ready. Can I share my screen?
You can share your screen now.
What do I hit? Present?
Yeah, hit present, hit share screen.
Okay.
So just for the folks who don't know Bubba, which I don't think there is anyone who doesn't, Bubba is a fellow Chicagoan like myself, grew up on the trading floors in Chicago, one of the first market makers in the SPX pit at the old Chicago Board Options Exchange way back when. I'm not trying to say you're old, Bubba, like I am, but
I am old.
We've been around a long time, so there you have it.
What screen am I sharing here, big boy?
I don't see anything yet. Hit share screen.
I did, but it gives me. I got 6 screens, so it doesn't tell me give me a choice of monitors. So
it should pick the one that you.
Let's see. Present.
The share screen.
Share screen, and it shows share screen.
Yeah, find the screen that it is and click on it, and then hit share.
I got it. Okay.
Yeah, and then it should come. It's going to pop up to me here, and I'll get you going.
Okay. All right. Entire screen. Oh, there we go.
That's better.
Got it. So I want that screen right there. Share.
Yep. Watch this. Would you look at that?
Yeah, and then the science magic.
All right, good. So I'm gonna disappear. I'm gonna let you do your thing. I'll come on.
You're going out to the pool. I know you'll
going out to the pool.
You'll give me a full report.
I'll give you a full report. So about 3:10 or Eastern time or 2:10 our time.
Or 12:10 where I'm at now in Las Vegas.
That's right. I forgot. All right, go at it, Bubba. You're the best.
Yeah, great to be here. And what's up, everybody? Always a pleasure to work with Tradier, and they are by far the greatest equity broker that there is, and soon to be crypto, and soon to be more. But always a pleasure, and one of my luckiest days to get involved with them years ago. But today we're talking about building a strategy for building a strategy for the rest of your trading life. Okay, I mean. There's trading, there's investing. There are many facets that are involved in the investment or trading community, depending on what you're trying to do. And there's a lot of things that we have to talk about. We're going to go fast, so you can always email me if you have questions later. And there's always a disclaimer. Now, I don't know if I need it here or not, but I always put it in, because whatever I teach you today does not guarantee that you're going to make money tomorrow. That's the crux of it, right? Past results are not indicative of the future, but really, what I want to talk about is the first thing you have to have in any part of trading is plan, right? You have to have a trading plan, right, Sergeant Belko? But a trading plan, which has to use goals that you have. And remember, when you're setting your goals, the goals have to be of attainable. Okay, setting ridiculous goals like saying I got $5,000, I want to make 500,000 next year is not an attainable goal. Okay, saying I got 5,000, I'd like to turn it into 10. That's attainable, but you have to put goals, and you want to put goals in steps so that you can attain them, reward yourself, and move on. You've got to always manage risk. I mean, trading itself is like a game. Okay, and if you know any games of math, poker, bridge, backgammon, gin, okay, which I play them all. Those are all games that are high probability games. Okay. And if you're the better player, you're going to win eventually. You're just not going to win all the time. So you must make sure that you're always managing your risk until you get to that point. Your risk should only go higher as your account grows higher. And you're going to use a percentage of your account on trades that you make. You have to have a strategy that you're going to use. What's your strategy? There's if you're using options, now I trade options, futures, commodity, stocks, I trade everything. Okay. But let's say you're using options. Okay. There are millions of option strategies that can be combined. Lex put one up that was the synthetic stock or risk reversal, which we use all the time. It's a way to create a better position and take away some of the disadvantages of options where you can actually leverage yourself a little bit. But you have to know the strategy that you're going to use and how you're going to use it and when is the right time. So you need more than one strategy in your arsenal, depending on what's going on in the overall marketplace. You got to know how to enter, okay? And more important than the entry is knowing where you're getting out if you're wrong, okay? That goes back to risk management, right? The trade management, you're going to manage that trade. Now, there's different ways to manage as well. You can sell premium in an option. You can sell a spread that you're looking to take it to zero and just let it expire. Or you're going to trade a strategy that is going to gain and not sell credit and actually be long debit. So you're going to have to look for an entry and an exit to get out of that trade. Okay. And you're going to analyze your trade. So what you really want to do is you want to analyze what is the best trade to make at the time. Okay. And that, to me, gets determined by what we call the phases of the market, right? So first of all, when you make a trade, you've got to decide whether you are investing or trading. Too many of us in the past have had two things. One was a trade, one was an investment. The one that we took as an investment went in our favor right away, and we said, we got to take the profit, we take the money. And the one that was supposed to be a trade, that was supposed to be managed properly, and if it went against us, we get rid of it. We said, we'll put it in our account, we'll hold it as an investment. You don't want to do that. That is not the proper style. Okay, weak stocks, weak futures, weak commodities tend to get weaker. Okay, so you want to hold the strong and you want to pick on the weak. So it's something you want to keep in mind. But what I think is important, and the number one thing that I use every single day, whether I'm trading on a 4-minute, my futures models, which I trade every morning with my members from 8 to 9 Central Time, or whether I'm hedging or whatever I'm doing, I'm always using what I call the phases of the market. We all are aware of the very fancy indicators that are out there, and there's a bunch of them. And again, if you use an indicator, great. But remember, nobody has yet to develop the magic indicator. Okay. It still takes your interpretation without opinion. Okay. And the easiest way to do that is to use what we call, again, the phases of the market. And all markets are born out of a congestion or a consolidation phase. Okay. That is, congestion is known as the greatest time of uncertainty. What I'm going to do is I'm going to show it to you in live time right now. Okay. I'm going to show you in live time right now. Now, this is Tesla, for example. Okay. And Tesla on a daily chart was in consolidation, making double tops and double bottoms back in here, right? This is something that you recognize, so you know that the markets are uncertain and they don't know, the market doesn't really know which way it's going to go, nor do the traders trading it. And you're having a battle between the bulls and the bears. And what you want to remember is that inside of that consolidation range, trading is very tough. Time decay becomes much faster as the markets sit. Volatility drops. It becomes a very tough market to trade, especially when you're trading as a retail trader. Retail traders want to trade with the trend. We need to get bigger hits. because we know that markets consolidate about 65% of the time when the year is all done. But as you look at the market consolidate, it churns back and forth, making a top, bottom, top, bottom, top, bottom, and eventually, the market will break out to a trend. Now, breakout doesn't mean up, it doesn't mean down. It's going to break out and pick a direction, okay? If it's going higher, it's going to make higher highs and higher lows. If it's going lower, it's going to make lower highs and lower lows. And your recognition of that is going to be tantamount when you're starting to trade, okay? Because it's going to help you manage your trade as you go through. And when you look at back to the real time, so Tesla actually did break to the downside, right? So we broke down below support. We found a spot to sell, and we held on to it and sold it and made some money potentially, okay? And what you're going to look, and you're going to watch this market and look for the continuation of that trend, and you're going to continue to find levels as the market goes down. So as we watch the downtrend, what happened right in here in this area? Well, Tesla went into consolidation again. So number one, that's your first red flag of where you're going to start to manage your trade and decide, where do I want to put my stop order, or where do I want to take my exit? Now, just full disclosure, myself personally, I don't ever set targets, okay? I let the market tell me when it's time to get out, and I use stops and I adjust my stops as the market goes in my favor, okay? And what I'm looking for is I'm looking for areas. If I'm long, I'm looking for areas of support, and I want to go just below that support to set my stops. If I'm selling, I want to go just above resistance. So right here, I get a red flag. So I have to make a decision. I'm not going to get out, but I am going to move my stop down somewhere right above where I can identify resistance. Well, fortunately for me, Tesla broke to the downside once again, continued. And look what happened in the middle. Once again, it formed a consolidation phase. And then once again, it continued lower. So again, now it did eventually find a bottom. And where did it find the bottom at? It found the bottom in a consolidation phase. Okay. And then it broke all the way back up, and it reversed and did everything exactly the opposite of what we just looked at. But what you're looking for is the market's going to give you clues. So as I switch over, and here's something that I do, and this is what I do every day. So I want to share this with you. Okay. These are 8 different markets. These are 8 different futures, okay, that I trade every morning. Okay. And I trade them live. And what we're watching for is we're watching for the last phase of the market, okay, which is what is known as the blow-off phase, okay? And the blow-off phase is when either FOMO or panic ensue, okay? The buyers become so desperate to buy, they'll pay any price, or the sellers just want to get me out, okay? And there was an old floor saying, which Lex will verify, if you can see their tonsils, give them whatever they want, they're wrong, okay? And that is what we call the blow-off phase of the market. And that is when price and volume amass to stick out like a sore thumb. For example, okay, as you look at the NASDAQ, here you had a straight pullback blow-off to the bottom, okay? Now, it wasn't a very good trade if you'd have made it, but it was a clue that there was panic selling. We just had the Fed minutes come out, okay, a few minutes ago, like right here, okay? And you can see this action. So there's a lot of volume here, but there's no conviction to price, okay? So there is no trade there. So what you're looking for is you're watching now for the market to redevelop a pattern. And right now what we're seeing down in here is we're seeing the market consolidate again. So in the euro currency, right now, it's going to make a decision. It's either going to break out of the congestion to the upside, or it will continue the downtrend. I don't know which way it's going to break from here, but I do know that it will break out one way or the other at some point. And you go up to, again, you can go to any one of these crude oil, okay? It was in consolidation, broke to the downside. So you would be short here in crude oil, and you'd be looking for, this is your resistance. So that would now be your stop, but your initial stop is set based on movement that is expected. Now, how do you know how much movement is expected? Well, you can use the average true range for that time period, right? You want to use a time period so that you're comparing apples to apples. You're putting yourself in an overall position that this is what the market has shown and proved to me over the time period here, that I indeed know that the crude oil moves about 60 ticks every 4 minutes. So that would be my initial stop. And the stop that I would be using would be above the high if I was short, or below the low if I was long. And then from that point on, I would then make adjustments to that stop based on movement. Now, I'm never going to move my stop to lessen my loss. My first move of any stop is going to be to break even. Okay. If I get stopped out, I get stopped out. It happens all the time. You know, I don't worry about the stop outs. I worry about the trades that I can make. And as you're watching right now, you can see that you're potentially getting a little bit of panic. But when you look at these charts right now, why would I say I'm not really seeing any panic right here? Okay. And I don't think I can see the chat of everybody, or maybe I can. I don't know. Maybe I can see it over here. Oh, I can see it. Oh, there you go. Hi, guys. Okay. So if I'm watching this, I'm seeing that this looks pretty ugly, but I'm not getting a big amount of volume. So I'm not really getting a panic sell, which would indicate to me at first blush that we're going to sell further down. Okay. Now we may not, but until I see either a market consolidate, like I'm watching in the euro currency right here, or I see it continue to blow off and I see a spike in volume. Okay. I am going to continue to stay if I am short in my short position. I happen to be short the euro currency right now, and I'm going to stay in that position as long as I can. My stop is right now is just above here, or just above this resistance level. Okay. But again, right now, as we've seen and been witnessing recently, volumes have been rather light in the afternoon. So let's just go to a bigger chart, and let's actually go to, we'll go to the Dow future. Okay. So what do we have in the Dow future right now? We've got solid consolidation for how long? For 3 months, we have been stuck between about 33,000 and about 34,500. Eventually, that's going to break one way or the other. Okay. So do you have a trade? Okay. I don't use stops, but could you use the EM off the option chart? You can use the expected move. Okay. Now, again, the expected move on an option chart is a little harder to figure now. The easy way to look at the expected move is either Thinkorswim puts it in for you, or you can just take the at the money straddle, okay, and multiply that by 1.07. That will tell you the expected move for the expiration. So as we're looking at right now, the SPY straddle, okay, the SPY straddle for today, okay, because obviously they have dailies, which is one thing I want to talk about. The SPY straddle for today, and so we're 398. So the 398 straddle is trading at $1.40. So right now I can tell you that we're expecting a $1.50 move based on the option prices right now until the end of the day. Okay, $1.50 plus or minus. Which direction, I don't know, but plus or minus $1.50. Okay, so but when I look at consolidation, you know, what kind of trade, if anyone wants to take a shot at this, what kind of trade? I was in Bristol Myers on the floor. Yes, I was. I was in Bristol Myers. I was a superior, but I ended up in the OEX for the longest part. Okay. If you looked at this chart, okay, and you were going to, and I said, you must put a trade on right now, what kind of trade would you put on? Anybody have a clue of what they might want to do here? Okay. Because there's a lot of different choices of what to do, but what might you do? Okay. And I know that I have a clock I'm up against, so I'm going to have to speed it up a little bit. But what I would do is I would sell a put spread here. Okay. I would sell a daily put spread, which I did. Okay. Actually, I'm doing it in the SPY because the diamonds don't have dailies yet. But I would sell a put spread here because I'm going to bank on the fact that we've been in consolidation for so long, okay, that it's going to go back up from here. Even if we're going lower, I should see some sort of a rally. Okay. And I have been trading the dailies on a daily basis. Every time we go to one side or the other, I'll sell either a call spread or a put spread. Okay. And sometimes I'll turn them into an iron condor for the day. Okay. But based on what I'm watching here, I can only be a buyer right now. If it breaks down below, then I can look to potentially be a seller. But my guess is that we might see a bounce. Okay. Now, again, full disclosure, my overall positions are pretty net short. Okay. I wouldn't buy a long put here because, again, my expectation is that the market's going to pop a little bit. Even if it's going lower, I think I get a rally. So I don't want to fight against the position and be forced out before I have a chance to let the trade mature in my favor. So I'm not going to short into the bottom, and it may very well not be the bottom. Again, I can't predict. I can only base my decision on the chart and the price action in front of me. Okay. Now, we certainly could break down through this today. We've just violated some very key numbers in the S&P. So certainly, 4,000 is a very major number. So if this closes below here, then I'm going to be a seller at 4,000 all day long until it proves me otherwise. Because we are now breaking down out of this consolidation. Now, this is not an official breakdown yet. Now, what I would personally do, okay, is I would go, here's my daily. I'm breaking down. So I'd go to a short-term chart and then use that as my guide. And a short-term chart, like during the morning when we're trading, I'm using a 4-minute for my long-term and a 1 minute for my short-term. Okay. So in my business during the morning, a long-term capital gain takes 4 minutes. All right. But again, the strategies you want to use, and this is the part I'm trying to get to. I tend to get a little bit away, is do you buy calls or puts? You sell calls or puts? You buy debit or you sell credit? Okay. Well, in my opinion, I never want to buy debit. Okay. I want to create a trade that may have a debit to it, but I don't want to buy debit spreads. If I'm going to buy a spread, I want to sell the credit spread, the corresponding credit spread, because I have a better opportunity to make money. Okay. Because I don't need the movement necessarily. I just don't need it to go against me. But if I can take a spread, for example, an Apple, okay, and sell a $5 wide spread for $2, okay, if I got to buy that debit spread for $2.50, what's my risk? My risk is $3 on the short spread or $2.50 on the long debit spread. The difference is on the short credit spread. If I'm doing it right, time is in my favor, and every day that goes by, it's harder for the debit spread to pay off. So I always want to sell credit, or I always want to create trades around what the markets are looking like. And what I believe is by using the phase of the market, okay, you can put yourself in a much better position overall and start to sell credit. And the other rule that I like to use is when I sell credit spreads, okay, I want to get 40 cents per dollar. I could care less about those big probability numbers. Everybody tells you, oh, it's a 95% probability. Well, you know what? 95% probabilities go broke too. Okay. I got to get 40 cents per dollar. And if you do the simple math behind that, okay, if the markets can consolidate 65% of the time and I'm collecting 40%, that's a net 105%, which means that I do it properly. I should be able to enhance my yield by 5% on an annual basis. Okay. And that means that and that doesn't count the extra bonus I might use of the daily stuff and other things that I'll be able to sell credit against. Okay. And that is something that I want you to learn to understand. Okay. Is if you use the market into your favor, into your benefit, and you're using the phases of the market, forget about the news. The last time I watched the news was about 6 years ago. And if you know me, you know that I'm on air quite a bit, but I don't ever watch because all the news that you're getting there is either BS news of somebody talking their book or news that's already old. Okay. So I'm a trader. That's what I do. I trade for myself. I trade my own money. I don't trade anybody else's money. So I'm using these same phases of the market all the time. And the biggest one we use in our morning session is the blow off, because that usually figures to give you at least a chance at a V-shaped recovery, which is the biggest opportunity to make money. Okay. But again, when you're trading on a regular basis, what you're really looking for is the opportunity to pick your spots, find the right key spot for yourself. Again, they're not always going to work, okay, but know how you're going to defend when they don't work. Okay. There is defense mechanisms, and then figure out, is it worth defending or is it better to take the loss? Right. There's people that have, put on big positions that after it's already lost 99%, they say, well, how do I protect it? I said, well, where you want it when it hit 100% value? Okay. Now you want me to help you protect it at 99% loss. There's nothing to protect, right? You have to think ahead. You have to set your risk parameters based on the size of your account. Okay. Everything has to be in collaboration with the amount of money that you have. If you get over leveraged, what do you think happens? You go broke, because at some point when it goes wrong fast. Okay. And that's why leverage is a good tool, but a dangerous tool. And which is why we create synthetic stock, right? The example Lex gave earlier, buy a call, sell the put, that is actually the stock that creates 100 deltas. But what we do, if we're long, we'll buy a put below to lock off the risk on the downside and the margin requirement. Okay. Or if we're short, we'll buy a call up above. But what we're trying to do is, again, it's always, this business is about managing risk, understanding the price action, where you are, what phase you're in, okay, and putting yourself in the best position. So now look what happened here, where we were going. So we had that big push down, and we kind of held, okay? Now, again, I'm not saying that they're going to rally or anything here, but they kind of held, and this could be a potential bottom. But I have no trade personally here because there was not enough volume for me to get involved. But certainly I could see that this potentially could be making a bottom versus while my euro currency is still breaking to the downside, which is a good thing because I do have a position. Okay. But if I go here again, so here I'm watching the S&P, or here I'm watching the Dow, and the Dow is still sitting right on that support line. Okay. So I think that is the key. What you're doing, if right, 100%. It's if this happens, what am I going to do? Okay. I wrote an article about that once. If, okay. The whole key is protecting yourself. Okay. You got to protect your money. Okay. And the only way you can do that is to have a reasonable plan that puts you in a position to be successful. Okay. Can you pull an option chain? It would help figure out what you're doing. I could, but I don't have, let's see if I can do this. I'm trying to figure out if I bring this. Let's see here. I don't care. You can see my account. I don't give a shit. Okay. Here's the SPY option chain for today. Okay. Here's some of my positions. Okay. These are all risk reversals, by the way. Okay. This is one of my accounts that trades automatically. Okay. And so when I told you right now, so if I look at the SPY straddle, okay, it's trading at $1.33. So if I multiply that by 1.07, that tells me the approximate move for the next 43 minutes is going to be $1.43 one way or the other. Okay. This is TradeHawk. This is a great platform. I love it. I love the way they laid it out. And they do good stuff there. So, and I don't want to bring up anybody else's platform, but again, any questions you may have, feel free to fire them now. I got 2 minutes left. If you have questions, fire them not. If you can't get the question out now, you can email me at bubba@bubbatrading.com. I'll be happy to answer any question you want. Oh, look at this. Another beauty change, a shirt and a jacket. I can't hear you, but unmute yourself, big boy.
That little mute thing gets in my way. They told me to mute myself when I go off because I talk too much. No, great job there. What I was going to ask you is, I thought you were doing the synthetic long with the protective put with that strategy, and I think you are, right?
I do both. We do a lot. I do a lot of different things, but I really, I'm always willing. That was Tradier's platform. That was TradeHawk. There's the developer of TradeHawk right there. You're looking at them, and another change of clothes. I've been playing with the dailies, and I really like the action of the dailies, and they've been really good. From again, even when I go against you, if you're getting the right amount of credit. So I'm flexible enough to change in midstream in what I want to teach, right? Mm-hmm. And I think the other was a little bit more complicated. And I thought this time we teach them the basics of the phases so that they can take advantage of the credit that they can make. And then we can get into another time we get into the bigger stuff, or they can come to another webinar. I mean, again, there's only so much you can teach in 30 minutes.
I know. You learned the whole business in 30 minutes. Go figure.
Well, how about 6 months? It was 6 months until I made any money on the trading floor. I made my first initial living playing gin and backgammon.
We had a lot of that card playing in the annals of the
that's what we did. That's what we did when there's nothing to do. And by the way, can I just say one more thing here? When there's nothing to do, don't create a mirage and find something to do. Okay, some days aren't tradable. Okay, don't trade if it's not tradable. You're only hurting yourself. Okay, I just want you to understand that. Okay, that if you trade when there's nothing to trade, you're putting yourself in jeopardy for no reason. And trust me, every mistake I talk about, I've done them all. Okay, I've made every one of them maybe 100 times.
Yep. No, it's one quick question before I let you go, Bub. I know we're out of time, but
I'm not out of time. I got all day, but
I know you have all day. I get that.
I know you guys are.
What do you think? What's the biggest difference off floor trading from when we were on the floor back in our day? What did you have to learn differently?
You have to learn how to let trades run. You have to learn how to take your losses. We always learn how to take our losses. You have to learn how to let your trades run a little bit longer. Trying to be a short-term scalper as a retail trader is very challenging. Even with the great commission rate of Tradier, it's still challenging because you're not making enough. Okay, you have to really develop from, on the floor trading, you could be a scalper, you could be an arbitrager, we could do anything, right? Because we always had an edge on one side of the trade. So we could wash it out and lock in the money. As a retail trader, you can't do that. So you have to be able to make your winners have to be bigger now because your number of losers is going to be more over time. It's just again, if your win percentage is 90%, you're not making enough money. You're trading too tight. Okay. And you're not letting yourself make any money. That's my biggest advice.
Makes sense. And how can the folks find you?
Bubba at BubbaTrading.com. You can email me directly. Or you can go to the website. But if you have a question, just email me. I will answer it. I answer everybody because I like to teach. I like to help out if I can.
I can vouch for that. You do like to teach and you're very good at it. So awesome. What does that last one say?
Who is the FCM for Trade Dog? Apex.
Yep.
Is that right?
What does that mean?
Full clearing member. That's the member that clears your trades. Apex.
The Apex it clears. Trading brokerage is the broker part.
Trading is a broker, but Tradier is not an FCM. They broker through Apex.
Yep. So. All right, Bubba. Thank you so much for that. We'll catch up down the road here.
Thanks, everybody. I appreciate you all, and thanks for listening. I hope you learned something. And again, email me at Bubba@BubbaTrading if you have any questions. Lex, thanks, brother. Appreciate it.
Thanks, man. I'll talk to you later. Thanks, Bubba. All right. Thanks to Bubba for that. He's always got some colorful tales to tell as well. Next up, we have Mr. Robert Hocking from the Cboe. He is SVP and Global Head of Product Innovation. And I'm going to let him explain what all that means to him. But I know our next guest is really knowledgeable in the volatility space, and we're going to talk about implied volatility and do a little bit deeper dive here, the two of us. So let me bring Robert in. Rob, how are you?
Good. How are you guys doing?
Good. Can you hear me okay?
Yeah, I hear you perfect. How about on my end?
Yeah, sounds great. So we're going to take a little jump into the volatility pool here, I think, right?
Yeah, ready for it. It's tough following Bubba, though. I'm not going to lie.
He's something else, man. I know that. I agree. So first of all, before we get there, let's talk a little bit about you. So tell us a little bit about your background in the business. I know you've traded as well as you're doing some innovation now at Cboe. So give us a little background real quick.
Sure. Thanks for that. Yeah, I'm a longtime vol trader. Spent approximately 10 years trading index vol for Goldman Sachs. Directly out of college, and then spent another 10 after that for DRW, a large proprietary trading firm here in Chicago. And during that stretch, spent decent amount of time on the Cboe floor as a pit trader. Spent some time in the VIX pit, and as you mentioned, I'm now head of product innovation for Cboe.
Great, good. So, do you miss the trading days?
I do. There are many days, especially I'm sitting here listening to Bubba going, so many of the things he said, I was like nodding my head and then going, man, I'd love to get back into it.
Yeah, no, it's I miss it too. I'll tell you, if they gave me a single listed open outcry again, I think I'd put the sneaks back on and the funny tie and get back down there.
Exactly.
So, all right. Well, we're going to talk about volatility, not necessarily implied, but just kind of a combination of both. So I'm going to ask a few questions, and we're just going to have a little back and forth, I think. So again, just a warning. We probably have all levels of understanding, so I'm going to take it kind of slow, and I really encourage the audience to ask questions here, especially ask some tough ones on volatility, because volatility can be a tricky little subject. So we'll try to unpack it as best we can here in the short time we have. Let's just start out with implied volatility. Okay, what is it? How's it calculated? We don't have to get into the super mathematics of it, but what's your best definition of implied volatility for in options for the folks?
Yeah, sure. I usually look at it as implied vol as just the statistical measure of how much a security's expected to move over a future period. So you can think of it as kind of the market's forecast for how much a price will move. I think it's always important to note that implied volatility is kind of based on, or not kind of, it is based on probability. So it's an estimate of generalized price movement, but it is not a prediction. It doesn't tell you which way it's going to go. Generally, how's it calculated? Implied vol can be determined using an options pricing model. Probably one of the most widely talked about is the Black-Scholes model. In the Black-Scholes model, you have basically 6 inputs, 5 of which are directly observable. So you have underlying price, strike price of the option, time to maturity, risk-free interest rate, dividends, with the last of the 6 being the implied volatility piece. Therefore, you can back out with the 5 directly observable inputs. If you take those as constants, you can back out an options price. With an options price, you can back out what the market's implied or expected volatility is.
Mm-hmm. Okay. So I had a lot of questions on this, back in the day when we were doing this and we were DPMs. And we would inevitably get a new product, right? And the new product would come out and we would have very little idea of what implied volatility to append to that model to price our options. Is there a best method to doing that? How do you think, besides supercomputers nowadays and figuring all that out, what's a good tool or, kind of a good thumbnail of how the traders would do that back in the day? Come up with a good implied volatility to start trading, because they're going to take the other side of all the trades, right?
Absolutely.
So it's got to be pretty good.
I think, there's a variety of different ways you can do it. Obviously, if you're not the absolute first into the market, you can obviously back out what other people are doing. And I think a lot kind of use that as a guideline today. But if you are the first into a market, I think really you start to look at similar products to the one that you're about to trade and back out implied vols from those, and kind of start to hone in the pricing of what you feel good bid ask, areas you're willing to commit capital based off of, kind of the surrounding market.
Mm-hmm. Okay. Yeah. So we typically did exactly what you said, I think. And I would say back then the tools weren't nearly as good as they are now. So we played a little bit of see how the wind was blowing and see where the supply and demand leveled out. So inevitably you're always wrong in the first trade. Right?
We use the word triangulation a lot, taking multiple inputs and trying to get to the closest guess possible.
That's right. That's exactly right. Okay, so implied volatility versus historical volatility. I think sometimes people call it realized, but maybe there's differences. Let's talk about that and what the differences are, and how do we use that as a retail trader or someone interested in the markets if they're using volatility.
Absolutely. Implied is just forward looking. It's a guess on how, volatile a particular underlying might be. So you can think of it as an estimate. Historical or realized, as you mentioned, is all backward looking. It's known because it actually happened. And so I think those are the two biggest. If you look at something like the VIX, which I know we'll get into, that's a forward-looking estimate of a 30-day implied number. So what is the market estimating that the price movement is going to be, as opposed to realized? You're just backward-looking. This is what happened, and that's why you always hear that kind of reference, implied versus realized. Mm-hmm. Where are we going versus what has happened, and how do those two combine? Obviously, if you're buying implied vol and it realizes more than the level you bought it, That's a good thing. You're making money on that. If you're shorting vol and let's say you sold a particular implied level and it realizes less, that's obviously what you're after on that end.
Right. Yeah. So when I first started, I had my mentor explain it to me this way: the implied versus realized. He said, "Let's sit up in a building in Chicago and look out the window, and you tell me what sort of clothes people are wearing relative to temperature. Is everyone in a bathing suit? And what does that imply about the temperature outside? Is it hot or is it cold?" Which I thought was, I got that as a dumb
absolutely.
kid. I'm like, oh, wow, that makes sense to me. That's implied volatility. And go look at the newspaper and look at July 4th and what the history is of July 4th temperatures. And that was more the realized part of volatility. I thought, yeah, that kind of stuck with me. That kind of makes sense to me. I get that. And there's also fakes. People could be out in their bathing suits, right? And it's really cold out there. In which case, that was like me always buying high volatility and the stock never moved. So that was no good.
That's right. Or you're at a Bears game.
That's right. So what kind of things can make implied volatility move? I know subtle changes I'm not looking for, but larger changes in implied volatility. What sort of things cause that to escalate or even collapse, for that matter?
Yeah, I mean, in the form of, call it index options like SPX, it's generally large economic related things. So it could be changes in inflation, unemployment rates, geopolitical unrest, supply chain issues like we saw in COVID. Those are the big things that are driving kind of that estimate for what you think future price movement is going to be. But really, to be honest, it can be anything and everything that is in the market. They're all inputs into what that implied vol expectation is.
Yeah, and some of those things, especially in single name stocks, can be earnings sort of news related, right? Or they might be producing a new drug that's coming out. So you get implied volatility shocks in those sort of events, right? So
that's right. Yeah, it's kind of like just information in general is an input into implied vol. Like as somebody gets more and more information about the future, it's obviously going to affect your opinion of how much something is going to move. So anything that is an input with regards to understanding more information, I think really affects, drives the implied volatility that you're using.
Right. And you mentioned implied volatility can be a predictor of future movement, right?
I think, yeah, I usually steer away from predictor. I more say, like, I guess you can use it in that sense. It's just letting you know, and at least in the case of the VIX, I always like to use the VIX as an example. It's the market's expectation. So if you're backing out implied vols from SPX options to say how much something is going to move, that's just what the market's telling you their best guess is for the range of movement into the future. So is it right? Not necessarily. There's plenty of times it's wrong. It's just the best guess at that moment in time for what we're expecting future price movement to be.
Okay. Yeah. And then is there an effective way to hedge your implied volatility exposure? Someone asked that earlier, and I just want to make sure we cover that. Is there a best way to do that?
I guess that's a hard question to answer. If you're trading something like SPX, yeah, I mean, you can hedge your implied exposure by obviously trading different forms of strategies throughout the options. If you're short implied vol, you can buy things like straddles or strangles. Now, I always have to give the disclaimer, specifically working for the exchange. Yep. I do not give investment advice, so please don't take this as investment advice. Get in trouble if I don't say that. But there's plenty of different option strategies out there that can be used, whether you're short downside exposure. You can hedge that short implied by buying downside puts. You can buy a lot of what even Bubba was talking about with spread trading, all of which are different avenues for effectively trading implied vol based on what your underlying exposure is, whether you're long, short, downside, upside, at the money. You can use any number of different option strategies to hedge against your existing exposure.
Right. do you find with, I'm sure you get a lot of folks asking you these sort of questions, right? Especially through the exchange or what have you. Do you find, is there a common misconception about implied volatility that you see sort of regularly when it comes to, trading and position management? Anything that comes to mind around that?
I think, probably the biggest is kind of that predictive discussion that we were having. Is, historically there is, there's been a relationship between, let's say, increases in implied volatility versus downward movement in the market. But that's not always the case. Like there's times where those relationships break down. I think the important thing with implied vol is that you're just predicting a future range of movement that can be up, that can be down. And quite frankly, it can be right, it can be wrong. It's just that it doesn't imply direction, which is, I think, where most people probably get themselves into trouble.
Yeah. I think someone asked me this a while back, but if you have, a stock that consistently moves up $2 every day, it seems like it might be a lot, depending on the stock price, I suppose, but it probably isn't. You probably have volatility collapse in something like that, right?
That's right. And I think some of that you could even look at with regards to different market environments with what we've seen in VIX. It's like some of that is the idea of how the move happens in the market is very, very important. So you look at a time like in 2020, around the COVID outbreak, first initial outbreak, we had a market environment where if you were to look at the beginning of the year to the end of the year, the market actually rallied. However, we had a 1 month 34% drop in the index, and that skyrocketed the VIX because there was a lot of unknowns, and then there was just that quick downward movement, obviously spiked implied vol. Now you compare that to something like we've seen in 2022. Yes, the index is down, call it 20% on the year. However, that happened over basically January to October, which is when we hit our low in 2022, happened over 10 months and then a slow rally back in the end of the year. Now, two very different market environments. The higher implied actually came from the 2020 with the large spike relative to a slow grind like we talked about in 2022, where I think the average VIX in 2022 is like 29 versus 25 roughly, or 29 and a half versus 20, something like that, 25, 40. So obviously how the move happens factors in dramatically to what that implied vol, forecast is.
Yeah, no, that's good points. Let's switch over to the VIX. I see, God, the time goes fast. So talking about the VIX, so everyone on TV calls VIX the fear indicator, right? And I'm not sure that's necessarily so true. I'm not sure how Cboe feels about it, but tell us about the VIX. How is it priced? Again, we don't have to get too mathematical, but what's it based on? How do people use it? What is it? What should we know about the VIX at a high level?
Sure. Yeah. The VIX is an index that measures the expected volatility or implied volatility of the S&P 500 index over the next 30 days. So it's a 30-day forward implied. There is no realized component in the VIX at all. It's just a purely implied measure. And it's calculated using the midpoint of real-time S&P 500 index options, or SPX options. And we take basically intraday values are based on snapshots of the SPX option bid-ask quotes every 15 seconds. And that, by backing out that implied volatility calculation, we're merely taking the option prices and saying, this is what the market is telling us implied vol will be over the next 30 days.
Okay. And I just want to make sure we're clear. We're using the SPX options to compute this, right?
Correct. And it's the whole, it's basically the range of options puts through at the money through calls. And so you use those. I'm not going to get into the formula and the calculation right now. You can find all that stuff easily if you search for it. But it's basically taking a weighted strip of options to take out that implied vol calculation. And it's telling you what the 30-day estimate will be over the next 30 days. So it's looking at two different option baskets of SPX options to get you that exact 30-day implied number. That's why the VIX index itself is not tradable.
So, and when you say the VIX index, you mean the cash price?
Cash price, correct.
So that's the computation that you just described. Yet for trading purposes, each VIX month has its own future appended to it and trades off of that future. Is that correct?
Correct. Yep.
Okay. So then you know where I'm going to go here. We're going to go into the contango backwardation world now. So people throw those two terms around relative to VIX a lot, right?
Mm-hmm.
Right. Are you able to, can you explain a little bit about what both of those mean?
Sure. I mean, they're actually really simple. So contango is, if you were to look at the VIX futures term structure. So as you said, each future has it, or each call it month has its own future. If you were to draw that out over the term structure, contango is just an upward sloping term structure. We're actually in contango most of the time and actually in contango today as we speak. So if you look at the front month future, call it around 22.30. Okay. The next second month future, 22.80. Next one, 22.95. Next one, 23. It's that upward sloping term structure that's referred to as contango. Backwardation, you can imagine, is literally the opposite. So think of, we would have been times of backwardation tend to be where there's a big market move, let's say COVID of 2020. The front month spikes because there's a lot of near dated uncertainty. The front month spikes, and now you have a downward sloping term structure. So you can think of very high short term vols that level off and come down in a downward sloping factor. What factors in here is kind of the mean reversion aspect of volatility. And so as you're always looking, the longer dated VIX futures are always going to tend to stick towards that long-term mean, because that's just the long-term average of vol. So you're going to see a lot of movement on the front end as we have certain events affecting what the short-term forecast is for volatility, to where it's always kind of moving back towards that longer-term historical average. So contango tends to be a quiet market where you're upward sloping to that long-term historical average. Backwardation tends to be market is in distress, where you have some sort of a short-term event that's driving up implied vol, and then you're sloping down more to that long-term historical average.
Got it. So the front part of that curve, the nearer term part of that, that tends to be the little bit more flexible version of volatility. So that back end mean reverting piece that's way out in time, a little bit more of a stalwart, kind of nailed into the wall, and everything's moving closer.
That tends to be what we see for sure.
Yeah. Okay. Any thoughts on how? I guess maybe the retail world isn't using VIX so much as a hedge like the pros would do. But are you guys seeing any of that at all? Do you see any interesting hedging functionality for the retail portfolio? Maybe they don't even hedge volatility. I'm not sure.
Yeah, I wouldn't. I would say VIX is not a heavy retail product. It's definitely what I'd say more of we kind of use the term internally pro-tail and institutional. At the same point, there's a lot of different ways you can use the VIX. If you're a retail customer, I think sometimes it's just it's a good indicator, like I said, of what the market is expecting over the next 30 days from the index perspective. I think there's ways to use yield strategies where you're writing puts and calls in VIX and trying to capture the yield, just very similar to an SPX yield strategy. There's also the people have used the roll down strategy to try to capture the yield there as in a contango market, where you're kind of getting that VIX future rolling down the curve and capturing the yield spread there. And then there's plenty of people that use upside VIX calls, much like you would use downside S&P puts. If we get that correlation to where there's a negative market movement where the index sells off, generally, in most times we'll see implied vols increase. So you can benefit from holding a call position, whereas you see the implied vols increase and you have a natural hedge with your VIX calls. So a lot of different ways you can use both the VIX and the SPX together as kind of a toolbox when trading around different market movements, global, more macro market movements.
Yeah. Okay. Sometimes, and this was a question earlier that scrolled by, but sometimes we have down markets right? And VIX isn't necessarily elevated. It can even, sell off a little bit. And we
Correct.
typically think of down markets, VIX going higher, that sort of thing. What's going on in that environment, do you think?
I think a few things factor in. One tends to be the absolute level of the VIX. So there's times where you have a down market, but the VIX is already elevated quite a bit and trading, let's say, higher than its historical average. And there you'll probably see less movement to the upside because it's already at an elevated level. It also has to do with the way the move is happening, as I described earlier. So if you're having a market that's just slowly losing, call it 0.5% a day, there's not a lot of volatility to that in and of itself. So you can see the VIX underperform, whereas maybe you'll have days where, you're naturally rallying, which would cause you to think the VIX would be at the low end of the curve. But the volatility of that rally is very sporadic. You're up 2% one day, down % the next, up 2% the following day, down another %. Like, it's all about how the move happens, which is what you're looking at and how the VIX is responding. So once again, I think that's probably the most important piece that people need to look at is how is the move happening relative to the absolute level the VIX is at currently.
Okay. Maybe taking a step back here, but the relationship between actual volatility or historical volatility and implied it's not safe enough to say if implied is higher than actual, you should sell implied and buy actual, or vice versa, right? Because you can have components of, you can have super high implied and super high actual as well, right? So there can be factors. What kind of goes on there? Because we have a lot of tools with implied volatility. Everyone says, oh, well, if implies higher, you just sell it, right? I go, no, that's not always true. So what are your thoughts there, Rob?
Yeah, I agree with your statement. There's a lot of factors at play. Everything from, as you're trading that volatility from daily resetting of your trade, daily resetting of your delta effectively. Like I said, I don't want to get too into the weeds, but there's a lot of factors to where it's not just as simple as sell high implied and if it realizes less than you're set. I do think it's a great indicator. I do think it gives you valuable input into the kind of market you're trading. Whereas, are you trading in a market where implieds are super high and realized is low? So option premium is what we call rich. Are you trading in a market where implied is low and realized is high, to say optionality might be on the cheaper end of a range and maybe something you should look at? And when it comes to basically long short, I look at it more as an indicator, less of an absolute, hey, sell it here and we'll make money.
Okay, good. Let me put this question up here that scrolled by. Can you see that? I think that means, is there any research for intraday?
About what is that? Vol for intradays. We are working on it. It's a great question. Obviously, same day trading, zero DTE, all of that is a very recent trend. We are working on building tools that capture it. Even simple things, trying to capture, open interest of same day trading is a challenge at the moment because it disappears at the end of the day. So, Cboe Data Shop is probably the place I would send you. You can find the link online where you can see a list of all of the different tools that we currently have. And then I would encourage anyone interested to reach out. And if it's not there, we're definitely working most likely on developing it, or we can work on developing it. But intraday is something that's just a very new trend that I think we're trying to develop tools as fast as we can to track and as strategies become more and more prevalent.
Right. What are your thoughts on some of these other vol products, UVXY and that sort of thing? Is there any glaring thing that the folks should know? I know you've got to be kind.
Yes. The pit trader's not going to be talking. This is the Cboe trader talking at the moment.
Right.
I think once again, they all offer data points for things that you can look at. I think, leveraged funds you need to be careful with. We learned about that in the past. Inverse short can serve a purpose, but ultimately I look at them as various different data points that you can use as part of your strategy, where things are trading. At least when I was trading, the more information I can find, the better. The more data points into what the market is predicting in various different ways, the better. And so that is, how I would say, look at a lot of those products.
Mm-hmm. Okay, great. All right, well, good. Rob, thanks for coming on. I see we're right at time now. I appreciate it. That was awesome. Cboe continues to innovate on these types of things, and just fantastic. Our partnership is terrific. So really enjoyed chatting with you.
Thanks so much for having me. I really appreciate the time today. It was fun. Thank you.
Yeah, and get better. I know you're under the weather a little bit. Thanks for doing this.
I'm fighting a little bit. Luckily, anytime I coach basketball for my kids, and anytime you're around 20 different small kids, you're going to get something.
I remember the days. All right, Rob. Well, great seeing you. Great chatting with you. I appreciate it.
Thanks, Lex. Have a great day.
Talk soon.
Thank you.
Bye now. Okay. Wow, we're coming to the end of the day almost. My goodness, we have a couple more spots here. Our next guest is a friend of mine, Luis Silva. Now, I see a lot of comments here that I'm not understanding, and I know Luis is going to help me out when I bring him on. So let me bring Luis in. Luis, how are you, buddy?
Hey, hello, bro. Hello, Lex. How you doing, bro?
I'm doing good. I can't decide. Are you doing this in Spanish or are you doing this in English?
I'm gonna try to do it bilingually. So yeah, we'll figure it out. For respect to the English audience, I will do it in English.
And I'll do it as needed. You'll know what to do. So, Luis, tell the gang about you and Option Sigma, and give us a little color on that before I head out of here.
Well, I started this as a hobby. I started YouTube channel in order to teach my friends how to trade options. I've been trading options for about 9 years, for about 9 years, 2014. And some friends asked me, hey, could you teach me a little bit about options? Because they didn't find any content at all in Spanish. So I started posting YouTube videos in the Spanish language, and people start getting interested, and community started growing, and so far we had over 71,000 subscribers on the YouTube channel, and social media over 130,000+ across Instagram, TikTok. So I only talk about options actually, and I do SPX options most of the time. So I'm kind of analyzing the XPX every single day of my life. So that's basically, we're trying to put the knowledge in Spanish, whatever I learned in English, because when I had to learn about options, I did it in English. So I'm the middleman between the Spanish community and the English one. Yeah.
Okay, I got it. And I'm going to make a plug. We're getting our TradeHawk platform into Spanish too for the community as well. So we're in the process of converting that over to help out there, I think.
Yeah, that's really good news. People are eager.
Good. Well, we love it. Well, I'm not going to take any more of your time. So
I would like to say hello to everyone, to say hello to the community of Opción Sigma. Hola a todos, ¿cómo están? And I'm very honored, Lex, to be here with you and share some insights and knowledge for the benefit of the entire Tradier community. So thanks, Lex.
Appreciate it. Yeah, this is awesome. We really love it.
And as anecdote, I'm going to tell you, last year, I watched a video on the social network. It was from a 9-year-old whose name is Julian Alvarez. Mm-hmm. He was playing soccer. And he was at the soccer practice, and they asked him, what is the biggest dream? What is your biggest dream? Mm-hmm. And he replied to the journalist, and he said, I would like to play along Lionel Messi and win the World Cup. And last year, this guy, who I saw a video on the internet when he was 9 years old, he played the World Cup with Lionel Messi and won it. So dreams come true if you work hard for them. Yeah. Today, I feel like Julian. Around the biggest guy, the big guys in the options world. So thank you very much for the opportunity.
Oh, you're the best. Thank you very much for that. I appreciate it. So let me let you do your thing. I see you're going to share a screen. Is that right?
Yes, that's
let
my
me get
screen.
that in there. Okay, that's good.
Yeah, that's perfect.
Okay, perfect. Let me jump out. I'll be back in about a half an hour. Is that cool?
That's cool. That's cool.
Okay.
All right.
Feel free to, go back and forth, Spanish, English, whatever you think is best for the community. So
Absolutely.
all right, let me jump
So
out.
I really appreciate that Rob was before me because he's talking about high implied volatility. So I'm going to talk about a strategy that you can use in high implied volatility environments. So
Perfect. Okay, good. All right, let me jump out. You have at it.
All right. Okay. So we're going to talk about using a high implied volatility neutral strategy with no directional bias. What does it mean? I'm not going to take any direction on the market. So I'm going to tell you guys a little bit about myself. I just like a Latin person, family comes first. So I'm son of Hernan and Gloria, husband to Andrea, and father of Daniela and Manuela, Juli, Felipe, Juan, my siblings. I have a master's in administration and MBA for the National University of Colombia, and I studied marketing in the University of Western Ontario. I worked many years in the automotive industry and financial sector, working for General Motors, Derco, PNC Bank. I've been marketing professor for several years, and I recently, last year, I became a member of the adjunct faculty of the Cboe. I've been an options trader. I have 2 YouTube channels, and I try to teach the Spanish community about options. So that's a little bit about myself. So what we're going to talk about today is building strategies with no directional bias. But we need to talk about first about this concept. Well, Rob was talking about it, so he kind of stole my presentation. But anyways, we're going to talk about that implied volatility is a critical concept in options trading because it helps to determine the potential risk and rewards associated with an options contract. Implied volatility, what represents is the market's expectations of the underlying asset, the movement of the asset that we'll have in the future. So in options trading, the volatility has a direct impact in the price of an option. So when the market expects the asset to be more volatile in the future, the price of options, guess what? They increase. And when the volatility just comes down, guess what? The options price comes down as well. So as option traders, we can use implied volatility to get more informed trading decisions. For instance, if an option implied volatility is high, it might be an indication that the market expects a significant price movement in the underlying asset. So traders may use this information to purchase options or sell options in order to capture premium. So overall, implied volatility is very, very, very essential and a critical concept in options trading. So what I'm going to provide today is a way that you can use implied volatility in high implied volatility environments to get rewarded. How can I do that? So we're going to try to catch thunderstorms. So basically, you were mentioning, Lex, a few minutes ago when you were talking to Rob, that implied volatility is just the expectation of, you put the example of the expectation of the weather. So if we see that the weather is going to be warm, probably I'm just going to wear a t-shirt. But if I expect this is going to be cold, probably I will get a coat, right? So when implied volatility is increasing, so it feels like a thunderstorm is developing. So what if we know exactly when and where the thunderstorm is going to start and is going to finish? Guess what? We can sell punches and umbrellas. We can sell punches and umbrellas. So if we can sell punches and umbrella, take that as a metaphor. So when the storm is forming, when the storm is developing, we're going to sell premium. Basically, we're going to sell a strategy that pays premium. We're going to sell volatility. We're going to be short on Vega, and we're going to try to make the most of it. So there are some events when IV is increasing. I'm going to talk about the SPX. I know that if you're thinking, okay, the king or the queen of high implied volatility is when we have the earnings season. But we're going to talk about the SPX. So one of the first high implied volatility events that we have in the last couple of years was the presidential election. Remember back in 2000, that was 2020, the presidential election, we have a peak in implied volatility. So every month when they release, the Department of Labor release the unemployment report, we have an implied volatility that is increasing. Also, something happened with my presentation. Just give me 1 second. I'm going to open it up again. Let's try to open it. Okay, sorry about that, guys. There it is. So talking about the events where implied volatility is increasing. So we talk about the presidential election. We talk about the unemployment report. The other one is the inflation data, the CPI, the Consumer Price Index, and the Producer Price Index. And also, the last probably couple of years is the Fed meeting, the release of the decision of the Fed meeting. It changed from time to time. Probably a few years back, inflation data was not as important as it is today. So we need to monitor what is going on with the market in some, depending the context we're living in. I remember back in 2018 when Mr. President Trump was in the office. So whenever he tweet, implied volatility increased. So we need to be aware of what's going on in the market, because whatever I'm showing you today probably is not applicable in the near future. Let's say inflation data in 2016, when they released the inflation data, it wasn't important as it is today. All right. So we're going to talk about the Federal Reserve meeting, because it's an event that is captured the attention of the investors for the last couple of years. And being said, there is even studies in the last 20 years, academic papers in financial journals. I brought 4 of them, but there are probably hundreds of them. You can find them even in the Federal Reserve website. So they try to make a relation between the effects on the stock market in the context of public disclosure of monetary policy decision. So the results suggest that the stock market tends to be relatively quiet when on the days preceding the scheduled policy announcement. But when we have the policy announcement, we have a peak in volatility. I'm going to show you a graphic in a little bit. In 2010, there was a couple of guys whose name I can't even pronounce, Bahama and Jene Aigio, and they tried to put in paper the monetary policy decisions, how they affect implied volatility of the S&P 500. So the results show that the stock market's uncertainty is significantly affected by the Fed's policy decision. In particular, this study found that implied volatility generally decreases after the FOMC meetings, after the Fed meetings. So if we know when the storm is going to happen, right? If we know when the storm is going to happen, guess what? We can put together a strategy that benefit us from that decrease in implied volatility. That being said, so there were a couple more papers published in the last year, actually, for a couple these I guess Asian guys that show us how like this is happening every single time that the Fed is meeting. I'm going to show you what this is the strategy which I'm using right now, and I'm teaching the people who is learning from Option Sigma. The strategy is basically an iron condor. So an iron condor is an option strategy that consists in two puts, one long and one short, and two calls, one long and one short, which means that we have 4 strike prices, and all of them have the same expiration day. Probably you guys are very familiar with the iron condor, especially the community of Option Sigma, that we trade iron condors basically every single day. So the iron condor has a similar payoff as the regular condor. This is a net credit strategy versus the condor, which is a net debit strategy. But for the iron condor, we use puts and calls at the same time, but with the condors, we only use calls or puts. So the iron condor has limited upside and downside risk, and also it has the profit potential is also limited. So they have wings to protect the position against moves in either direction. Because this is limited risk, of course, this is going to be the profit potential limited as well. Profit is capped at the premium that we receive. Well, the potential loss is capped at the difference between the bought and the sold calls and the bought and the sold puts, less than net premium received. So an iron condor basically is a neutral options strategy that profits the most when the underlying asset does not move much. But I have to mention, the strategy can be modified with the bullish or a bearish bias. However, the purpose of using this event of high implied volatility, it is precisely sell volatility and be big as short. So the iron condor earns the maximum profit when the underlying asset closes between the middle strike at the expiration. In other words, the goal is to profit from low volatility in the underlying asset. So why? I'm going to show you a little bit of the historic volatility in the last 24 months. We have some peaks during the last 24 months. But guess what? Any guess what is this slide? Well, what I tried to do with this slide, it shows you guys that the peak of implied volatility, we find it most of the time when the Federal Open Market Committee is having its meeting. So I'm showing you on this slide the 2022 and the 2023 meeting we have so far. We have only had just one meeting this year. So you can see that we have peaks exactly at the moment when the FOM is holding the meeting. So if you see March 15 and 16, we have a peak and then a volatility crash. In May 3rd and the 4th, we have a peak and guess what? A volatility crash. And June 14 and 15, we have a peak in volatility and guess what? A volatility crash afterwards. July 26 and 27, guess what? What was happening? A Federal Open Market Committee meeting. We have a peak and then a volatility crash. Now, September 20th and the 21st, we have a peak and a volatility crash. November 1st and 2nd, we have a peak and a volatility crash. December 13 and 14, we have a peak again and a volatility crash. January 31st, the very last Fed meeting, and February 1st, we have a peak and then a volatility crash. So if we know when the storm is going to happen and when it's going to end, what are we going to do? Again, we're going to sell ponchos and umbrellas to cover, to protect people from the storm, right? So we're going to sell premium again. So what is the goal? Basically, the goal is capitalize the drop in volatility. That's the goal. So in order to achieve that goal, this is the plan. And this is a plan that I've been working for the last couple of years. What I'm going to do is trade SPX options 180 days to 270 days to expiration. I haven't even gone as far as a year of expiration. I'm going to tell you why. And some people are going to think, oh, okay, why so far? Why I'm going to sell those iron condors so far away? Because the time decay, most of the time decay, the fast time decay is going to happen in the last 45 days. So how come you're telling me that I should sell iron condors with 9 months away? I'm going to explain you that in a little bit. So how wide you can, I'll do it between 50 points and 100 points. I mean, the wings. So if I open an iron condor, the sell put is going to be in the 3,000 points for the SPX. My wing is going to be in 2,950 points. That's what I'm going to do. So 50 points wide or 100 points wide. The deltas I'm using right now is 0.12. And what I expect is to capture 1/4 of the risk allocation. What does it mean? That if I have a 50-point wide iron condor, that means that I'm taking a $5,000 risk, right? But I'm going to get around about $1,000. So basically, I'm risking and putting at risk $4,000. That's my buying power effect, right? Basically, we're taking 25% of credit in regards to my buying power effect. Is 1/4. That's why it's 1/4 of the risk allocation. When to trade? On the day of an important announcement, because we have seen peaks of those important announcements. I just show you the peaks that we have between 2022, most of the 2022, before and right after the Fed meeting. And guess what happened afterwards? Volatility crash. And what is a volatility crash? If you're wondering what is a volatility crash, is when the implied volatility suddenly drop because this setup is highly predictable, and is that we surely will have a change because we will change from a state of uncertainty to one state of certainty when the final event takes place. So let's put aside when we have extremely negative surprises. Even a bad outcome to this event will be a certain outcome. So which will lead to deflating volatility, to a contraction of volatility, because to the market, it is still preferable that the previous state of uncertainty. So case in this point, the Fed is announcing on Wednesday, even when they were fairly hawkish, for instance, and last year, can't remember, maybe September, October 2022, they signal a slowdown in the flow of unlimited central bank liquidity. This has been happening between 2022 after the COVID crash in 2020, that they took a more flexible policy. So we can see that the market prefer certain than the uncertain. So that's why it works. And if you're wondering when to exit this position, usually I target 30% of the initial credit. Let's say if I got an initial credit of $1,000, what I'm doing is I get out of the position when I have $300 in my pocket. I'm going to tell you this because I have backtested this strategy for the last, I went back from 2015. I didn't want to present the backtest because I didn't want to set unrealistic expectations. And I'm wondering if I should say that. But it has worked 100% of the time. So I put 1x stop loss. So if the credit received was $1,000, so I will stop out. I will get out of the position if I'm losing $1,000. Okay, but usually I close the position between 20 and 35 days from the day I open to capture the crush in implied volatility. This is a strategy, again, it closes again. This is a strategy that we don't have to assume any bias, any directional bias. I don't care what is going to happen with the market. I don't care whether it's going to move up or down. Because people say, why do you sell those iron condors so far, 9 months away, 1 year away? Because if I sell it in a shorter period of time, if something happened in the short term, I wouldn't have time to recover. But as we can see, if the market moves in either direction, in a really, really heavy direction, you still have time to the options do its work. This is the time the premium is going to contract, the time decay is going to work, and the volatility is going to crush. So basically, that's the reason because why I go so far in exploration. Is a simple setup. Make sure if you want to put this in place, you have options level 3 because you need to be approved for margin, and so you need to be approved for options level 3. So make sure you ask your broker to have level 3 approved in your account. So this is a strategy that you don't need to know where the market is going to move. Where we're going to sell is not time. Well, a little bit of time because we're going to close the position between 20 to 35 days. The longest position I hold of this strategy was around 45 days. But basically, if you do this, like if you find one of these events every single month, you can get a return of capital easy 40, 50% every year. That's what I want to tell you. Gracias a toda mi familia y la comunidad de Opción Sigma. Thank you for everything. I don't know if you have any questions. Let me know. Now you change your outfit again. I can hear you. I think you're mute. Lex, I think you're mute.
I know. That's so you can't hear me in the background. Yeah, no, I have one big outfit. I just keep stripping off layers. They just keep coming off. Put on 13 outfits today.
Is it cold up there?
It's always cold here. So a couple things. That was awesome. Great audience. They're very engaged. I can't understand a word they're saying yet, although I will say my Spanish is pretty good. So, we're going to find that out because to the audience, Luis was kind enough to invite me to Orlando to speak in a few weeks, right? So we're going to be together in Orlando.
You're coming to Orlando March 11 and 12 to the Sigma Summit 2023.
Yeah, I hope everyone's there and I get to meet everyone. That'd be awesome. And the other thing too, I want to get another plug in here. Don't forget to have the community to take a look at Tradier. There's all kinds of good stuff over there. So
Yeah.
And we would love to have everyone. So
Absolutely. That's why we're working on it, right?
That's perfect. That's perfect. Good. Great presentation. I don't know if you see any questions in here that you could answer.
Well, actually, I was so focused and
Yeah. So
I didn't see any questions.
There's a lot of praises. I can tell that. So that's great. You've got very loyal community here, Luis.
Yeah. you can see Spanish community is eager to have a broker that understand them.
I understand that. That's awesome. Let me ask a question or two, and then if you see anything that passes by in Spanish that you'd like to answer, have at it. So you said that you do these 200 up to 270-day iron condors, right?
Yeah.
Have you ever had a situation where one side was stressed, meaning the stock moved down there, and you had to kind of roll something, or you just take the loss and move on? You just reposition?
No, never. I have never had it. No.
Oh, okay.
Even during the last couple of days when we had this rally that the SPX got until 4,190 points, not even. Doesn't even no.
Yeah, didn't even matter, right?
No, it doesn't even matter.
Because
you have plenty of time. So
yeah. Well, that's a good point that you made, that you push these iron condors out in time so that you truly don't have to really tend to them too much because of the time that exists. So that's pretty good. That's clever. I like it. Well done there. What other kind of things would cause some uncomfortableness in this trade? Anything that you can think of? Obviously, if volatility goes even higher, I suppose that might hurt a little bit.
Yeah, right? I mean, it happened to me on the release of the CPI report. I think it was on January. Well, I guess everyone was expecting like a big movement. Never happened. I think the movement of the data release was probably the SPX moved like 0.2%, real low. So after the inflation data, like 3 weeks from the inflation data release, was going to take place the Federal Reserve meeting. So I think that didn't help too much. So it took a little bit longer. So usually, like I said, I close those positions between 20 and 35 days, but this took a little bit longer. So actually, I closed most of those positions, which I opened in January. I closed them this week.
Okay.
But they expire September, December, January 2024, and I was able to close it at 32% of the initial credit.
Okay, got it. And that's what's your goal on these iron condors? How much are you trying to take out of them again?
Like 1/4 of the risk I'm taking.
I gotcha. Okay, so 1/4 of the risk you're taking. Once you get there, you're taking it off.
Yep.
And then doing another one.
Exactly. I just close it and doing another one because I'm always looking at the calendar and looking for these events that probably will like stress the market. Yeah.
Do you see that question there, Luis? Do you close the put call spread separately or the whole iron condor at once?
Whole iron condor at once. Yeah.
Always? Okay. Yeah. Got it. Good. All right, cool. Wow, that was great. Really excited about it. So Orlando on the 12th, right?
Orlando on the 12th.
I got to bone up on my Spanish. It'll be ready.
Yeah. You sharpen your Spanish.
I will sharpen my Spanish. I hope to see, like I said, I hope to see everyone there too. So that's great. Really appreciate your coming. So this was fantastic. Great job with that. I didn't plan the dovetail of talking about volatility into your presentation. It happened that way. That worked out great, I thought.
Yeah, but it was great because people were on the same page. Yeah.
Great. Good. All right, Luis. Well, good. So that's all awesome. Thanks again. We'll catch up afterwards. I'll give you a call and we'll chat.
Yeah, absolutely.
For Orlando. Thank you. Okay. Thanks to Luis. So now we're coming to the very end. I'm going to bring Dan back in. Hi, Dan. How are you?
Hey, Alex. How are you?
Good. Are you ready to close this down?
How many offers did you change today?
It was a lot. There's a lot of close. I'll tell you.
You're certainly keeping the dry cleaning industry afloat.
That's right.
Oh my God!
All
Hey,
right.
that presentation with Louise was amazing, huh?
That was awesome. That was, I tell you, he's got an eager community. I think that that's terrific. They want to learn, they want to trade. So that's perfect, right?
Yeah,
So
I mean, I still remember you came to me like I think maybe a few months ago, maybe like almost like 4 months ago, and said, "Hey, it's just for everyone, right? Serving the Spanish community is something that we have been trying to focus on for a long time, right? It's been a point of interest. It's a point of aspiration. It's kind of what we stand for as a firm. So we always wanted to do, get. I agree with what Luis said, and on that community needs the support and an aspirational broker they can work with. So that's pretty clear. And when you came to me and talked about Luis, and I looked at some of his videos, I mean, he was like, it's awesome. I'm so glad we're all partnering together. From a trader perspective, right? I know we just have taken Trade Hawk and tried to make it create a Spanish version out of that, which we're going to get out very soon. But as a firm too, I think you'll see more and more us trying to actually cater to that market. So,
yes,
Luis, I see Luis is back. So
I
hey,
brought
Luis,
him back to say hi. I saw you still in there.
Hey Dan, how you doing?
oh my God, look at this mic. Look at that.
That's legit.
That's legit.
All
Yeah,
right.
hey, thanks, man. Luis, your presentation was awesome. Really enjoyed it.
Yeah, I heard that. Thank you, and thank you guys for the opportunity to show the war what we have, what we're doing right here.
That's awesome. Yeah, really
Thank you
good.
so much.
Look forward to working with you guys a lot. So that's awesome. All right, Dan, I'll let you take the floor. Okay, we're gonna Release and I are gonna run for a little bit, and I'll come back on to kind of say a few thank yous, and then we'll go.
Hey, thanks everyone. What an amazing day it has been, right? I couldn't step off for a minute. I mean, this presentation was really, really amazing, right? Like I was telling earlier today, when we started this a year ago, we had no idea where it was going to take us. But one thing we were sure that we wanted to get education into the hands of the traders. So long way. I think we've come a long way. So thanks so much, right? And I hope everyone enjoyed it. And I really hope more important than enjoying, I hope everyone actually benefited from it, right? So so that's amazing. So, I mean, see, one thing is Lex and Tim and Peter and Stefan and Paul and all the guys and Kayla, they spend so much amount of time trying to make sure that we bring you the best content, right? I mean, there's a lot of effort, there's a lot of thought. We kind of want to be that broker who's really trying to make a difference. I mean, we're not in here just to give you an app and have you trade with it, right? I mean, that's one way to be a broker, but we are basically going to create the new unbroker where we basically are, trying to do things differently, trying to touch you where it really makes a difference. So thank you. So Lex, I think you guys did an amazing job of putting this great show together, and each of the speakers. I mean, the amount of effort it goes into putting these presentations together, and the speakers are amazing. The amount of effort it goes, they each of them tries to actually bring value. So, and we've always surrounded ourselves with those influencers, those educators, those platforms, those partnerships where the net intention is to create value. So, I also wanted to thank all the great presenters, right? I mean, all the way, starting with Bill this morning, right? We tried to bring Bill today because we thought that it'll be great to actually get a more industry perspective into it. But after that, Bill did an amazing job, and after that we had Markus. Then we had I never thought I would use the words psychological capital in trading, but I think Sheehy-Kelly was amazing, right? And then Guy, Fausto, Kirk, my friend, Option Alpha, you nailed it every time, right? Scott Martin, and Ed and all the folks, right? And Bubba, you nailed it. Robert from Cboe was amazing, and then finally Luis, I think you topped it all off. So it's amazing. So I really think that we love doing this. So I think we'll try to we plan to put a few more events together. So I really want you guys to check out Tradier as we go through. We're going to put more events like this together in partnership with Cboe. We're also trying to create events locally where you folks are more and more. So I think we love the idea of serving these active traders with a touch. So thank you so much. We have some amazing products too. So just keep watching. The product team, Peter and the folks are launching an amazing thing called the Tradier Hub. I mean, it's going to be so different. It's a one location where you can go, where great innovators can present their products, and also traders can get access to all the products. It's a very, very content-driven world. We've got some amazing partnerships with some of the biggest hosts, CNBC hosts who are coming in. We'll be doing some great amount of work with Tradier as a part of the Tradier Hub. So looking forward to that. So keep watching. We're trying to do everything we can. We're working hard. And, and just like I said in the beginning of the call today, we take our relationship very seriously. And thank you for trusting us. So once again, I'm not going to speak anymore or put any more presentations. I'm the last guy between you and your ride home or you're getting done with the trading day. So once again, thank you. And Lex, you're awesome, man.
Thanks.
Awesome.
It's all in the close. That was great, Dan. Appreciate all you do for this. This was awesome. Let me say a couple of thank yous. Obviously, I want to thank Cboe for their support of this. Can't thank Tim and Kayla enough on our marketing team. Just a fantastic job, you two. Really great. And everyone else behind the scenes on ops side and what have you. So really great event. Thank you for that. Other thing I forgot to mention, Options Brew TV. Don't forget to follow us and subscribe. We do these kind of presentations every Thursday morning live, and then we have some special ones too. So we'd love to have you subscribe and check out the content there. And there's more coming with the hub down the road. So stay tuned for some great things coming out of us, especially on the content side as well. So Dan, thanks. Awesome.
Thank you.
Thanks everyone. Bye.